In late 2021, some of the most sophisticated energy companies in Europe basically woke up to this terrifying reality.
Yeah, a complete nightmare.
Right, because on paper, their books were perfectly hedged, but in reality, they were bleeding billions of euros in cash, like by the hour?
Exactly.
They were facing these massive margin calls that genuinely threatened to bankrupt firms that were, fundamentally solvent. So today, we're looking at how a gas trading desk can do everything theoretically right and still just completely blow up.
It is a brutal paradox.
Yeah.
And it happens because the financial models people rely on, they fundamentally misinterpret the physical reality of the commodity itself.
Which brings us to the mission for today's deep dive.
Right.
We are officially kicking off the Natural Gas Trading Desk Master Program.
Which is exciting.
It really is. This is a massive sequenced journey for you guys listening. It's across 9 modules and 120 chapters. We're covering everything from market structure and the actual physical mechanics of pipelines, all the way through trading strategy, valuation, risk.
Execution, ETRM systems, desk leadership, all of it.
Exactly. And every single module is built around real markets, real numbers, and these desk-ready applied builds. Because we're focusing purely on modern professional practice, how a desk actually survives in the wild.
Yeah, this isn't just theory.
No, not at all. And to guide us through this, I am joined by a true veteran, a natural gas trading and risk management consultant from Durga Analytics. You've spent decades, literally decades, trading physical and financial gas across both European and North American markets, right?
I have, yeah. Seen a lot of things go right and a lot of things go very wrong.
Right, and you've built desks, designed ETRM systems, and taught analysts, quants, and risk managers how to navigate these exact crises we're going to talk about. So we're starting right at the foundation today, Module 01, Chapter 1, which is titled, What a Gas Desk is Accountable For.
And if you're managing a desk out there or, aiming to, the core rule for our time together in this deep dive is this: every concept we cover will be tested against both a North American and a European example.
Always both.
Always. We never drop one for time. We test both because the structural differences between them mean these two markets fail in entirely different ways.
I love that rule. So I want to start with a baseline question just to frame this whole investigation for you listening. If we walk onto a trading floor, right, and we strip away all the flashing screens, the yelling, the jargon bull, what actually is a gas desk at its core?
Well, underneath all the technology, a natural gas trading desk is simply a small group of people inside a company who are permitted to enter into commitments about gas the company does not yet have.
Okay.
At prices that are not yet known, for delivery at times that have not yet arrived.
Wow.
Yeah, it is a highly concentrated stack of 3 uncertainties: volume, price, and time.
Volume, price, and time. Okay, so if a desk is managing that massive stack of uncertainty all day, what are they actually held accountable for?
There are 3 non-negotiable pillars here: profit and loss, risk, and reputation.
P&L, risk, reputation.
Right. And a desk head who cannot see all 3 of those at once, they aren't actually running a desk. They're just, babysitting a set of positions waiting for an accident.
I do have to push back on that a little bit, though.
Sure.
Because if I walk up to a junior trader on the floor and ask them what their primary job is, they aren't going to say managing reputation and risk metrics. They are going to say, my job is to make money.
No.
Like P&L is king on the floor, isn't it?
That is exactly the mindset that destroys desks.
Really?
Yes. Making money is the loud, visible part of the job, sure. But optimizing purely for P&L is a massive trap. Let's look at the reality of how desks actually fail. Say a junior trader has a highly profitable year. P&L is just through the roof.
Everyone's happy, high fives all around.
Right. But to get there, they took massive undocumented risks that the system couldn't see. The risk team was blind to the exposure. That isn't a successful desk. That is a lucky desk.
Ah, I see.
And the market eventually punishes luck.
Because next time, that invisible risk bites them and the whole firm blows up.
Precisely. Or take the third pillar, reputation. Say the profit is real and the risk was, somewhat measured. But the desk achieved it through trading patterns that a regulator later judges to be market manipulation.
Oh, wow. Yeah.
Your license to operate is revoked. The profit is disgorged. The regulatory fine is double the profit, and the individuals face personal liability. So no, desk heads are not paid to maximize P&L.
They're paid to maximize P&L strictly subject to hard constraints on risk and reputation.
Exactly.
That reframes the entire job for me. It's not just generating cash, it's generating cash safely and legally. So where does that reliable P&L actually come from then?
There are four structural sources of P&L on a gas desk. The first is location spread, or basis. Basically, gas at point A is simply worth more than at point B because the pipeline between them is bottlenecked.
Makes sense.
The second is time spread, leveraging storage. Gas is usually cheaper in the summer than the winter. The third is optionality, which comes from physical assets. So that's the embedded right to inject, withdraw, or divert a cargo if the market spikes.
And the fourth is flat price direction, right? Just like taking outright bet that the price of gas is going up or down.
Yes. And here is the irony of flat price direction.
What's that?
It consumes by far the largest share of risk capital on a desk, yet it typically delivers the smallest share of reliable, repeatable return.
Wait, really? The biggest risk for the smallest reliable reward?
Yeah. Mature, durable desks earn the vast majority of their money from structure. So that's location, time, and optionality, not from guessing direction.
Which perfectly transitions us to the math, actually, because understanding the structural spreads requires understanding the physical constraints. And you mentioned we always test North America and Europe. So let's look at how these two markets actually measure this physical substance.
Well, the golden rule of gas is that it is physical. It takes up space.
Yeah.
It moves through pipes at a finite speed. Because of that physics, the two most important words in gas trading are where and when.
Where and when?
Okay, if a trader says, I'm long gas, that statement is literally meaningless until you define the location and the delivery window. So let's build out the desk-ready arithmetic here. In the U.S., gas is priced in U.S. dollars per MMBtu. In Europe, it's priced in euros per MNWH.
Both are measures of energy, though, right? Not just physical volume.
Correct. Both are energy.
And the fixed conversion factor between those two, because you can't just compare them one-to-one.
Right. You need the factor. It is 0.293071. So 1 U.S. MMBtu equals roughly 0.29 mWh.
Okay, let's walk through a basic mark-to-market calculation so you listening can see how deceptive these numbers can be. Let's start with a standard North American trade. Say the desk buys 50,000 MMBtu of March Henry Hub gas at $3.42.
Yeah.
2 weeks later, the market moves up to $3.67.
What does the P&L look like on that?
It's pretty straightforward, right? The price moved up by 25 cents, multiply that by our 50,000 MMBtu volume, and we're looking at a $12,500 unrealized profit.
Spot on. Now, let's mirror that exact same physical energy exposure in Europe using the Dutch TTF benchmark. First, you have to convert your 50,000 MMBtu to MWH.
Using the factor, 0.293071, that gives us roughly 14,500 MWH.
Let's say we bought that European position at 31.40 euros per MWH. And 2 weeks later, the TTF market moves to 33.55.
So that's a price move of 2.15 euros.
Exactly. Multiply that by your 14,500 MWH volume.
And we get an unrealized profit of roughly 31,500 euros.
Right. And this right here is where a desk head has to be incredibly vigilant.
Why?
Because you have a U.S. profit in dollars and a European profit in euros. You cannot directly compare them, and you certainly can't add them together on a risk report without normalizing the data first.
Oh, right, because of the currency difference.
Exactly. So let's convert that European profit into U.S. terms to see the real risk picture, assuming an exchange rate of, say, $1.09 per euro.
Okay, let me do the math. So 2.15 euros per MWH multiplied by 1.09 gives us about $2.34 per MWH.
Right.
Then we apply our energy conversion factor, and the equivalent move is roughly 68.7 US cents per MMBtu.
And here is why those numbers are so absolutely critical. The Henry Hub price only moved 25 cents. The European price, for the exact same amount of energy over the exact same 2 weeks, moved nearly 69 cents.
Wow. That is a massive discrepancy. I'm seeing two huge dangers here. First, by trading the TTF, foreign exchange risk-like, the euro to dollar rate just quietly sneaked into your gas book.
Yes, it did.
But second, the volatility. The European position was like 2.7 times more volatile. Equal notional size across those two markets does not mean equal risk.
That is the crucial insight. If a risk manager sizes a portfolio based on notional volume instead of actual volatility and risk metrics, they are completely setting the desk up for failure.
Because it's not apples to apples.
Exactly. A 50,000 unit position in Europe requires significantly more risk capital than a 50,000 unit position in the U.S. because the European market has historically experienced much tighter physical constraints.
It really emphasizes how strange natural gas is compared to, a stock or a bond.
Oh, it breaks traditional financial modeling entirely. Gas is highly seasonal. Winter delivery is structurally a different product than summer delivery. So forward curves are these complex shapes, not just flat levels.
Right.
It's locationally fragmented. A bottleneck in a pipeline means gas in Texas, and gas in Chicago might as well be on different planets. And the price response is nonlinear. You can't just instantly manufacture more gas when a blizzard hits.
Right, the pipes can only hold so much.
Right, and when the physical system maxes out, a tiny increase in demand can trigger a 1,000% price spike.
Which brings us to storage, the great shock absorber of the gas market. We mentioned earlier that time spreads rely on buying summer gas and storing it for the winter. But storage isn't just a bank account, right? You can't just withdraw your exact balance on demand.
Far from it. We have to understand the storage ratchet.
The storage ratchet.
Yes, this is pure physics. A natural gas storage facility, like a depleted underground reservoir, does not deliver gas at a constant rate. The pressure pushing the gas out of the ground is driven by the volume of gas inside.
Oh, I see.
So as the inventory falls throughout the winter, the pressure drops. Therefore, your maximum daily withdrawal rate steadily declines.
I always think of this like a tube of toothpaste. In November, when the tube is completely full, a tiny squeeze gives you a huge amount of paste.
Yeah, great analogy.
But by late February, when the tube is at like 20%, you can squeeze with all your might, roll it up from the bottom, and you can barely get a drop out.
The toothpaste analogy is dead on. Now, put that toothpaste tube on a trading desk. Imagine you sell a physical winter supply contract to a city, promising to deliver up to 40,000 MMBtu a day on demand. To hedge this, you lease a storage facility that has a 40,000 MMBtu nameplate withdrawal capacity.
Okay, so in November, the risk system says you are perfectly hedged.
Right, but the risk system isn't reading the physics.
Oh, no.
Fast forward to February, you've been pulling gas out to meet demand all winter. The storage inventory is down to 25%. The ratchet mechanically binds. Suddenly, your maximum physical withdrawal is only 20,000 MMBtu a day.
But your contract still obligates you to deliver 40,000.
Exactly. You are now short 20,000 MMBtu a day in the dead of winter, during the most expensive market conditions of the year.
You thought you were fully hedged, but the physical constraints of the asset just changed underneath you. So how does a modern trading desk even track all this? The ETRM, the Energy Trading and Risk Management System, must have to process this in real time, right?
Well, it tries to. But let's map out how a trade actually lives inside these systems. From the moment a trader forms a market view to the final cash settlement, there are 7 distinct steps. What people think of as trading like the actual execution is just step 3.
Okay, so where's the danger?
The real danger lives in the plumbing of steps 4 and 5. Deal capture and risk limit checking. We call this the control lag.
Walk me through the mechanics of that lag. How bad is it?
A trade becomes economically real at T+0, the exact second the trader says done on the phone or clicks the screen. But the firm's ETRM system doesn't instantly know that.
Right, and it has to be recorded.
Yeah, the trader has to book it, or an API has to batch the data from the exchange. For complex physical shapes, this can take time. The ETRM might not actually capture the deal until T+12 minutes.
Okay, so 12 minutes just to get into the central database.
Yes, but then the risk system has to actually calculate the new exposure. To compute value at risk, or VAR, for a complex gas portfolio, the system doesn't just do basic arithmetic.
What does it do?
It has to run thousands of Monte Carlo simulations, shocking hundreds of forward curves across thousands of positions to see how the portfolio behaves under stress. That computational heavy lifting takes a lot of time. The limit check might not finish until T+35 minutes.
Wait, hold on. In an era where algorithmic high-frequency trading executes and shifts markets in literal milliseconds, how on earth does a multi-billion-dollar trading desk accept a 35-minute delay on their basic risk data?
Because the physical complexity of the commodity demands heavy computation. It's just a structural reality of the technology. On a calm Tuesday, a 35-minute delay is fine.
But on a crazy day.
On a highly volatile day, say a pipeline explodes, or a geopolitical crisis hits, trade volumes spike 10x. Traders are frantically adjusting positions, the APIs bottleneck, the Monte Carlo simulations queue up, and that 35-minute gap can well into hours.
So the market is grappling violently, the firm is literally bleeding cash, but the risk manager is staring at a green screen because they are looking at a ghost of the portfolio from 2 hours ago.
That is the exact mechanism of failure. You are flying blind inside that lag. Management is making critical survival decisions based on stale data. Almost every major gas desk blowup we study lives inside that data gap.
Wow. Okay, this is where we need to look at real-world survival. Let's move to the case studies. And to be clear for you listening, both of these are drawn directly from the public record to show how these exact failures manifest. Let's start with North America. Winter Storm Uri in February 2021.
Uri is the ultimate case study of physical reality shattering financial assumptions.
Set the scene for us.
A severe cold snap hit Texas and the mid-continent. Gas demand for heating and power generation naturally spiked. But simultaneously, the physical supply completely collapsed because the wellheads and gathering pipes physically froze.
Literally froze solid.
Yes. The water vapor in the raw gas turned to ice, blocking the valves.
So demand rockets up and supply drops to zero simultaneously.
Absolute physical scarcity. Now, the main U.S. financial benchmark is the Henry Hub in Louisiana. But the physical gas was desperately needed at regional delivery points in Texas and the mid-continent.
And the pipes couldn't handle it.
The pipeline network between them was totally constrained. So regional prices gapped to 2 orders of magnitude higher than the Henry Hub price.
So how did this destroy desks that, thought they were hedged?
Imagine a desk that had an obligation to supply 20,000 MMBtu a day to a Texas utility. The desk bought a long financial position at Henry Hub thinking they were perfectly hedged. They were long the benchmark, short the regional physical.
Makes sense on paper.
But under the stress of Uri, this created catastrophic basis risk. The regional pipe bottlenecked. The two prices completely decoupled.
So the Henry Hub price barely moves, while the price they actually have to pay to buy physical gas in Texas goes to the moon.
Exactly. The flat price hedge at the hub provided almost zero financial cover for the massive cost of sourcing physical gas locally. It wouldn't have mattered if they tripled their hedge at Henry Hub. The financial instrument itself was the wrong tool for the physical risk they were carrying.
They were perfectly hedged against a flat price move, but totally exposed to a locational dislocation.
Man.
Now let's look at Europe, the 2021 to 2022 dislocation. Uri was what, a 4-day physical freeze? The European crisis was a multi-quarter liquidity nightmare.
It was. The European episode was driven by declining pipeline flows from the east and critically low storage heading into winter. The Dutch TTF benchmark price rocketed. It went from the high 20s toward 300 euros per MWH.
Which is just an unthinkable move.
Totally unthinkable. And so look at the major European utilities. They have these, long-dated physical contracts to supply gas to municipalities and industrials at fixed prices.
Right.
To hedge that massive long physical position, they went to the financial exchanges and sold forward gas contracts. As the price goes up, the value of their short exchange position drops, but the value of their physical gas increases.
Yeah.
Economically, they are perfectly balanced.
Right. They locked in their margin. The physical gain offsets the financial loss.
On a spreadsheet, yes. But in the mechanics of a clearinghouse, it was a disaster.
Why?
Clearinghouses guarantee the trades, and they manage their counterparty risks by demanding variation margin. Every single day, they mark your financial positions to market. If your short position loses value, you must wire them cash by the end of the day to cover the gap.
And because the price was going to 300 euros.
Let's do the arithmetic. Say a utility sold 1 million MWH forward at 30 euros, and the market spikes to 180 euros. That is a 150 euro difference per MWH. Multiply that by 1 million, and the exchange calculates a 150 million euro mark-to-market loss.
Oh my God.
The clearinghouse demands that 150 million euros transferred in cash that afternoon.
But wait, the utility has the physical gas. Their physical portfolio just gained that exact same 150 million euros in value. Can't they just point to that and say, look, we're good?
They cannot. You cannot post an unrealized physical gain as collateral to a clearinghouse. Solvency and liquidity are two entirely different concepts. The physical gain will take months or even years to actually realize as the gas is delivered and the customers pay their invoices. But the margin call is due at 4:00 p.m. today.
It's like buying a house, right?
Yeah.
You might have $1 million of equity in the property because the market went up. You are perfectly solvent. But if you don't have the cash in your checking account to pay the monthly mortgage bill today, the bank still forecloses on you. You lose the house despite having the equity.
That is a brilliant analogy. These firms face liquidity gaps not in the millions, but in the billions of euros. They were economically sound, but cash flow bankrupt. The German government ultimately had to step in and stabilize Uniper for tens of billions.
Just staggering numbers.
The brutal lesson here is that cash settlement timing mismatches will kill a desk just as quickly as a naked speculative bet. If you run a desk, you must know exactly how much hard cash you will need if the market moves 3 standard deviations against your hedge.
This completely changes how you look at a trading floor. To recap Chapter 1 for everyone, P&L is just one leg of the accountability stool alongside risk and reputation.
Right.
You literally cannot trade gas without understanding the physical constraints, like the storage ratchet we talked about.
All right.
And the true silent killers of a desk aren't usually reckless speculation. They are basis risk and liquidity mismatches hiding deep inside books that the system calls hedged.
Which perfectly sets up our next step in the master program. In Chapter 2, we are going to take all of these physical and financial realities and use them to separate physical gas desks from financial gas desks.
No, that's going to be interesting.
Yeah, the physical desk will focus on managing the deliverability, nomination, and locational risks we saw in Winter Storm Uri, while the financial desk will take on the concentrated basis, volatility, and clearinghouse margin risks we just saw in Europe.
I am really looking forward to getting into that structural divide, but as we wrap up today's deep dive, I want to leave you listening with a final thought to mull over. We've established that the control lag, that 35-minute blind spot where complex risk calculations are still processing, is exactly where a desk is most vulnerable.
Very vulnerable.
Right. So in an industry rushing toward AI-driven execution and millisecond latency, ask yourself, is your organization's multi-million-dollar risk system actually built to measure reality, or is it just highly optimized to tell you what was true half an hour ago?
So, picture this. It's February 2021. There's this perfectly hedged gas trader at a merchant desk, and they just close their books for the day.
Assuming they're in the clear.
Right, they're expecting to lock in this really tidy $105,000 profit for the month, but just days later, that exact same supposedly perfectly hedged position hands them a catastrophic $50 million loss.
Yeah, that's a tough one.
It's insane. And the culprit wasn't, some sudden price swing they missed. It was a complete failure to understand the physical plumbing beneath their spreadsheet. So, welcome to this deep dive. I'm your host, and today we're stepping into our roles as natural gas trading and risk management consultants from Durga Analytics.
It's great to be here.
And we're here to guide you through the Natural Gas Trading Desk Master Program.
Yeah, and that story you just told, that perfectly illustrates exactly why we built this program. Because if you are an aspiring or working professional in the gas markets, whether you're an originator, an analyst, a scheduler, or dealing with ETRM systems, you really need to know how these markets actually break.
Because they rarely break the way the textbooks tell you they will.
Exactly. Yep. Textbooks are too clean.
Right. So to master a gas trading desk, you can't just memorize market structures. You have to really understand valuation, survive the operational heavy lifting of execution, navigate the regulatory landmines, and, grasp the leadership required to build a durable desk.
It's a massive undertaking.
It really is. And our course is a sequenced journey across 9 modules and 120 chapters.
Mm-hmm.
We start with the foundation of what a desk is actually accountable for in Module 1, and we move through senior trading playbooks, curve construction, risk, survival, all the way through to desk legacy in Module 9.
And each step is built around real markets, real numbers, and desk-ready applied builds.
Yeah, and today we are anchoring right at that foundation. So we are in Module 1, specifically unpacking Chapter 2, physical versus financial gas desks.
Which is such an important chapter, because newcomers to the industry, they're usually taught this very clean, simple distinction.
Oh yeah, they're told a financial trade settles in cash and a physical trade delivers gas. Just simple and clean.
Right. But in practice, that definition is dangerously misleading. It describes the settlement mechanism. It tells you how the paperwork finishes on a normal sunny day.
When everything goes right.
Exactly. But it tells you absolutely nothing about the actual obligation you've taken on when things go wrong.
Which is exactly what happened to that trader in our opening story.
Yeah, they found out the hard way. The defining question that every desk must ask is this. If the market becomes physically constrained on delivery day, does this position require me to do something in the physical world that I might not actually be able to do?
Right.
If the answer is yes, then you are holding a physical position, regardless of what your confirmation paperwork says.
Okay, let's unpack this practically for a second. It's like, it's the difference between holding a financial ticket to a concert versus being the actual production manager.
Oh, I like that.
Right. If you just have a ticket and the concert gets canceled, you get a cash refund. It's annoying. You don't get to see the show, but it's a clean financial settlement.
That's the production manager.
Yeah. They're contractually obligated to physically build the stage, wire the lighting, set up the sound system. If a blizzard hits and the roads are closed, they don't just lose money. They literally cannot perform the physical task they promised to do.
That is a brilliant way to frame it, because the legal definitions in gas trading, they're really just illusions. To survive, a real desk uses a completely different framework, which we call the obligation ladder.
The obligation ladder.
Yeah. It's not this binary choice between physical or financial. It's actually a spectrum of 5 distinct rungs. And the crucial rule here, and you have to remember this, is that each time you step down a rung, you inherit all the failure modes of the rungs above you, and you add a brand new one.
Okay, so it gets progressively more dangerous. It starts at rung 1, right? The financial swap or future.
Right. Safe and clean. This is just cash settled against a published index. No gas moves. You are literally just trading price exposure.
But then you take one step down to rung 2. This is a physical trade at a liquid virtual hub. So think of the Title Transfer Facility, or TTF in Europe, or the National Balancing Point, NBP, in the UK.
Economically, this feels almost identical to rung 1.
It does feel identical.
Yeah.
But you've introduced title transfer, haven't you?
Yeah.
Even though the hub operator is handling the balancing behind the scenes, you are now tangling with the physical realm.
Exactly. You're trusting the hub's virtual machinery. But then you step down to rung 3, which is a physical trade at a specific pipeline point, and now the training wheels are completely off.
No more hub operators saving you.
Nope. Now you must submit daily nominations. You have to ensure transport capacity actually exists. And if your physical flows don't match your nominations, well, you get hit with imbalance penalties.
But it gets heavier, right? We're only on rung 3.
Oh, it does. So rung 4 is firm supply to an end user. Now you are obligated to deliver whatever that industrial customer or municipality takes, whenever they take it.
Regardless of the weather or pipeline conditions.
Exactly. And finally, you have rung 5, which is an asset-backed obligation. Your delivery depends on your own physical plant, your own storage facility, or your own pipe performing under intense pressure.
Okay, so let me ask the obvious question here. Why would a desk willingly move down this ladder? I mean, if I'm sitting at rung 1 making money trading price, why take on the massive headache of rung 4?
Because the profit margins at rung 4 look fantastic on a spreadsheet.
Oh, of course. It's always the spreadsheet.
Commercially, desks love to capture that premium. They start at rung 1, they see those juicy margins at rung 4, and they just jump right in. But here's the trap. They do it without updating their operations or their staffing.
They bring a rung 1 team to a rung 4 fight.
Precisely. And this is honestly one of the most reliable predictors of a desk blowing up. A rung 1 desk just needs, a trader, a risk system, and a clearing relationship. But the second you step down to rung 4,
It's a whole different ballgame.
you suddenly need 24-hour shift rotas, dedicated schedulers, physical credit monitoring to make sure your counterparties don't default, capacity management, and real-time imbalance tracking.
Wow. So when a desk gets this wrong, when they take on a rung 4 obligation with rung 1 infrastructure, how exactly does it break?
Well, they fail on 2 very distinct paths. Financial desks fail on cash. They get caught in a margin spiral and literally run out of liquidity before their hedge even pays out.
And physical desks.
Physical desks fail on flow. The gas simply cannot be delivered, and they are forced to buy replacement molecules at whatever catastrophic price the market demands to avoid breaching their contract.
Okay, here's where it gets really interesting. Let's actually look at the math behind those rung 4 margins, because it completely shatters the illusion of the screen price. If you aren't prepared for the physical frictions, you're just going to bleed money. Walk me through the European worked example from the chapter.
Let's do it. So, say your desk needs 24,000 megawatt hours of gas delivered in Germany at the EC across January. Option A is you just buy a January TTF future financially. The screen price is, say, 32.80 euros per megawatt hour. You lock in the price.
But I don't actually have gas in Germany yet.
Right. You just have price protection.
Right.
To get physical gal there, that's option B, you have to build what physical traders call the delivered cost stack.
Okay, so what's in the stack?
First, you pay that commodity price at TTF, the 32.80. Then you need to book capacity to actually move it from the Dutch facility to the German hub. That costs you roughly 0.65 euros.
And moving gas isn't free energy-wise, right? To push gas from point A to point B, the pipeline compressor stations literally have to burn some of your natural gas to power the system.
Exactly. The pipeline takes a cut in kind. This is known as fuel and shrinkage retention. And that costs you about 0.4% of your volume. Then you have to price in your expected imbalance cost, because in the real physical world, your flows will never match your nominations perfectly.
Right. There's always a discrepancy.
Always. Let's assume a 1.5% volume risk at a 0.30 penalty factor. And finally, because physical gas takes longer to settle than a daily futures contract, you have credit carry. So let's say 4.5% interest over 45 days.
So practically, you're buying flat pack furniture at a warehouse. You look at the price tag on the showroom floor, that's our 32.80 screen price,
Yeah.
and it looks incredibly cheap.
Yeah, it looks great.
But it's a complete illusion until you factor in, renting the truck to get it home.
Yeah.
That's your capacity booking. Paying for the truck's gasoline, that's your fuel retention. And then the inevitable headache and wasted time of discovering you're missing 3 crucial screws when you put it together. That's your imbalance penalty.
That is a really, really accurate way to visualize it, because when you add all those frictions up, your actual delivered unit cost jumps to 33.91 euros per megawatt hour.
Wow.
The physical desk is paying a 3.4% premium over the screen price just to make the transaction real. If your trader sold that gas at 33.50, thinking they beat the 32.80 screen price, they actually lost money on every single megawatt hour.
Ouch. That is painful. And the North American market operates completely differently, doesn't it?
Entirely different plumbing. Let's say a U.S. desk needs 800,000 MMBtu delivered to a U.S. Midwest city jade in January. Henry Hub, down in Louisiana, is trading at $3.55 per MMBtu.
But U.S. pipelines charge point-to-point, right? They don't use Europe's entry-exit system.
Correct. The U.S. model charges a firm transport reservation fee, which you pay whether you flow gas or not. Then they add a usage charge when you actually flow. They take fuel retention in kind, too, but it's usually higher than Europe's, say, 1.8%.
Right.
And finally, you have locational basis, which is simply the cost difference to get that gas from Louisiana all the way up to that specific Midwest city gate. So when you factor all this into the U.S. delivered cost stack, your cost to deliver isn't 3.55, it's 4.281 US dollars per MMBtu.
Wait, that is a 20.6% premium over the screen price. Why is the gap so much wider in the U.S.?
What's fascinating here is the structural contrast. If you normalize the prices and convert the European price to dollars, European gas is roughly 2.5 times the absolute cost of U.S. gas.
Okay.
But the nature of the friction is totally different. In Europe, the delivery premium is driven by regulatory and contractual friction, like complex imbalance rules and capacity bookings across borders.
And in the U.S.?
In the U.S., the friction is almost entirely locational. You are just trying to push physical molecules across vast continent-sized distances.
Which naturally creates a massive headache for the desk head. Because if you are running a global portfolio, you have to look at both the U.S. and European markets simultaneously. You can't manage risk by looking at euros per megawatt hour on one monitor and dollars per MMBtu on the other.
Exactly. And they inevitably ask their analyst for a single consolidated view of the desk's risk. To do that, the analyst has to run an applied build to normalize a mixed book.
Right.
In this chapter's applied build, we are tasked with normalizing 7 different positions spanning TTF, DHE, NBP in the UK, and Henry Hub. We have to convert everything to MMBtu in US dollars to compare apples to apples.
And this is where the math crap happens. Because it seems simple enough. To convert a European price in euros per megawatt hour to US dollars per MMBtu after you adjust for the foreign exchange rate, or FX, you multiply by a factor of roughly 0.293.
Yes, because an MMBtu is a smaller unit of energy than a megawatt hour, so the price per unit is lower. But, and this is where analysts blow up the spreadsheet, when you convert the physical volume of gas from megawatt hours to MMBtu, you are going from a larger unit to a smaller unit.
Right, so the number gets bigger.
Exactly.
Yeah.
So you must multiply by a factor of roughly 3.412.
Let's talk about how this mistake actually happens on a desk.
Oh.
Because nobody intentionally mixes up those numbers. But it's 5:00 p.m., the junior analyst is rushing to generate the end-of-day report, and they're dragging formulas down in Excel.
That is exactly how it happens. The two conversion factors are reciprocals of each other. The analyst writes the formula for the price conversion, the 0.29, and accidentally drags that exact same cell over the volume column.
Or vice versa.
Right. And if you apply the volume factor to the price, you just artificially inflated the risk profile of your book by a factor of almost 12.
Which is terrifying. How do you even catch that before handing it to the boss?
The chapter provides a critical invariance test. Volume multiplied by price must be invariant. It must yield the exact same underlying notional financial value regardless of what unit you express it in. assuming your FX is correct.
Okay, so if the total value changes.
Yeah, if your euro book is worth €1 million before the conversion, and your new dollar book is worth $12 million after the conversion, and the exchange rate is 1.1, you dragged the wrong cell.
Okay, so let's say the analyst gets the math right. They pass the invariance test. The net position of this global book is 463,000 MMB2 long against a $4 million notional value. They hand that one single number to the board. So what does this all mean? Are we good?
No, giving the board that one single number is dangerously misleading. We call it the one-number fallacy.
Wait, why? If the math is verified and the notional value is accurate, why isn't it a true picture of risk?
Because you are mathematically netting U.S. length against European length. Those are physically distinct commodities on different continents. You cannot use excess gas in Texas to turn the lights on in Berlin. They do not offset each other in the real world.
That makes total sense.
Plus, you are aggregating basis swaps, which are just price differentials with flat price levels. And worst of all, you are hiding physical deliverability risk a rung 4 obligation behind financial futures on rung 1.
You're basically telling the board, we're fine, while the plumbing is rigged to explode. And we don't have to guess what that explosion looks like because we saw it happen to European utilities in 2021. Let's dig into the first case study from the chapter, which is drawn directly from public records of European utility disclosures.
Yes, this mechanism is very similar to what required the German government to step in and stabilize Uniper in 2021 and 2022. The setup is a massive corporate utility group running 2 separate legal entities.
Okay, 2 entities.
Right. The supply entity has physical rung 4 obligations to deliver gas to municipal customers for years to come. It is structurally short physical gas. So the separate trading entity buys forward futures on the exchange to hedge the price.
So economically, the corporate group as a whole is perfectly hedged. If prices go up, the trading arm makes money to cover the physical loss.
Correct. Then prices skyrocket. The total corporate group is indeed perfectly hedged, sitting on a net €50 million economic gain. But the structural failure reveals itself. The physical gains of €1.2 billion accrue very slowly over years inside the supply entity as customers pay their monthly utility bills.
But the short hedges sitting in the trading entity, those are financial.
And the exchange demands its margin today, in cash.
Right. So the trading entity faces an immediate cash margin call of negative €1.15 billion. But let me stop you there. If the corporate group as a whole is sitting on a €50 million gain, why doesn't the exchange just look at the consolidated corporate balance sheet and waive the margin call?
Because exchanges do not care about your consolidated corporate dreams. They care about legal entities. The trading entity is legally ring-fenced to prevent a trading blow-up from taking down municipal power supplies.
I see.
But that ring fence is exactly what traps the cash. The trading entity cannot pay the €1.15 billion margin call because it legally cannot reach the physical assets sitting in the sister company.
So they become operationally insolvent despite being economically hedged.
Exactly. This is an entity mismatch. Any desk holding financial hedges against physical obligations across different legal entities must rigorously model intercompany liquidity.
That's a perfect example of the cash failure path. Now let's look at the physical flow failure path, which takes us back to the trader in our opening story. This second case study is a constructed composite based on public findings from regulators like the Federal Energy Regulatory Commission, FERC, and the North American Electric Reliability Corporation, NERC, during the February 2021 cold weather event.
This is a textbook flow failure. We have a merchant marketer operating at rung 4 on the obligation ladder. They have firm supply contracts to industrial customers. They don't own their own assets, so they hold firm transport capacity on a pipeline to move the gas.
And they are perfectly hedged on price using Henry Hub financial futures.
Right. They expect a tidy $105,000 margin for the month.
Then the freeze hits.
Upstream production at the receipt point physically stops. The wellheads freeze. There is literally no physical gas to put into the pipeline. And this raises a brutal lesson about market infrastructure. Firm capacity is a right to move gas. It is not a right to have gas.
Going back to our earlier metaphors, holding firm capacity without actual physical gas is exactly like having a reserved, paid-for, first-class seat on a train. But the train itself has run out of fuel. That first-class ticket does absolutely nothing to get you to your destination.
Exactly. So the marketer has no gas, but they still have a rung 4 physical obligation to their industrial customers. They are legally forced to buy replacement gas at the destination point at absolute crisis prices.
Which averaged $185 per MMB2.
Yeah. Their financial hedge at Henry Hub did its job and protected the hub price, but they were short deliverability.
They just couldn't get the molecules.
Right. The replacement cost wiped them out. Instead of a $105,000 profit, they suffered a $49.9 million loss. That is 475 times the expected margin, destroyed in a matter of days.
Which brings us back to our core mission for today's chapter. A Rung 1 financial desk and a Rung 4 physical desk might hold identical price exposure on a spreadsheet, but they fail on completely different paths. Your ETRM systems, your mathematical models, your cash liquidity, and your operational staffing must accurately reflect your actual rung on the obligation ladder.
If you are managing risk, you cannot treat physical and financial as the same thing just because the numbers net out in Excel.
Well, you've made it to the end of Chapter 2. Next time, in Chapter 3, we are going to look at asset-backed versus portfolio gas trading. We are stepping fully onto the perilous rung 5 of the obligation ladder, where you don't just book pipeline capacity, you have to operate the physical plants and storage facilities yourself.
But before we wrap up, I want to leave you with a final thought to mull over. We saw how deliverability risk, the sheer physical lack of molecules during a freeze, destroyed that U.S. merchant desk. There is no listed financial instrument you can buy on an exchange to hedge deliverability. You can hedge price, but not physical existence.
So wait, if that risk can't be hedged on a screen, you're essentially saying they aren't generating alpha on those trades. They're just selling insurance against a hurricane and hoping it doesn't rain.
That is exactly what they're doing. Ask yourself, how much of a physical trading desk's profit on a normal sunny day is actually just an unpriced premium they are secretly pocketing for taking on catastrophic weather risk?
That is something to think about the next time you look at a desk's P&L and assume they're just really good at trading. Thank you for joining us on the desk today. Keep questioning the plumbing beneath the numbers. And remember, don't sign up to build the stage in a blizzard if all you really wanted was a ticket to the show. Take care, and we'll see you in the next deep dive.
Picture this. You're sitting on a gas trading desk. Your team is staring down the barrel of a freezing winter. And you hold this massive physical storage asset.
Right.
You look at your screen, and the theoretical models, the spreadsheets are screaming that you're sitting on millions in locked profit. It looks like a sure thing. But here's the million-dollar question, right? Will that cash actually materialize, or is your model quietly lying to you?
Yeah, that is the exact question every desk has to answer.
Exactly. So today we're taking a deep dive into a massive stack of source material to figure that out. We're unpacking the Natural Gas Trading Desk Master Program. Our mission is to extract the survival tactics hidden in these modules, and we have the perfect guide to help us navigate this. Sitting with me is a natural gas trading and risk management consultant from Durga Analytics, someone with decades of experience building desks and, teaching traders how to actually survive these markets.
Thanks. Yeah, it's great to be here. And just to give you some context on this program, it's essentially a sequenced journey. It spans 9 modules and 120 chapters.
Wow, that's massive.
It really is. It covers everything from what a gas desk is actually accountable for, how European and North American markets are built, all the way through, trading playbooks, curve construction, execution, ETRM systems, and even market conduct. We're grounding everything today in modern professional practice. So real numbers, real verified arithmetic.
Love that. And for this deep dive, we're zeroing in on Module 1, which is running a gas trading desk. Specifically, Chapter 3, titled Asset-Backed versus Portfolio Gas Trading. So to kick us off, what is the fundamental difference between these two types of desks? Because you can't just treat a physical asset like a normal paper trading
You
desk.
really can't. And honestly, treating them the same is where the trouble usually begins for most firms. The distinction isn't about the size of the firm. A portfolio desk holds positions. An asset-backed desk holds positions plus a physical capability. So a storage facility, pipeline capacity, regasification slots, things like that.
Right.
The fundamental difference is the shape of the return. A portfolio return is symmetric.
So symmetric, meaning it's sort of like a coin toss. Like you take a position, and you can win or lose roughly equally based on which direction the market moves.
Yeah, that's the core of it. But an asset-backed return is asymmetric.
Wait, asymmetric, does that mean owning a physical asset is basically like buying an option?
Exactly.
Like your downside is capped by the fixed costs of holding that asset, but your upside is tied to market volatility. If the spread is good, you run the asset, and if it's terrible, you just sit on your hands.
Yeah, we call that the senior view of the desk. From a risk and capital perspective, an asset-backed desk is short cash. You have to pay that option premium up front.
Ah, right, in the form of capacity fees and storage rentals.
Exactly. Reservation charges, all of that. But you are long optionality. You only turn the asset on when the market spread actually exceeds your variable cost to operate it. Whereas the portfolio desk, they're flat cash and they're long or short duration. They require entirely different risk systems, different limits, and honestly, different kinds of people running them.
So if an asset is effectively an option, how does a trading desk actually prove its worth to management? I mean, I imagine that conversation can get pretty heated during budget season.
Oh, it does. Almost every dispute between a trading desk and management comes down to how they categorize value. In the program, we decompose storage value into 4 distinct layers.
Okay, lay them on me.
Layer 1 is intrinsic value. This is what you can lock in today on the forward curve. So you buy summer gas, sell winter gas. Right now, it's fully hedgeable.
The guaranteed money, basically, assuming you don't mess up the execution.
Right. Then layer 2 is rolling intrinsic. This is the value a disciplined desk captures by re-optimizing and re-hedging as the forward curve moves over time.
Makes sense.
Layer 3 is extrinsic value. This is the pure volatility value. You cannot lock this in today. It requires a really skilled desk with excellent tooling to capture it as the market moves dynamically intraday.
Wait, let me stop you there for a second. I'm a bit confused. If my traders are making real money off this extrinsic volatility, why wouldn't my CEO want to put that in the official annual budget? It's real cash arriving in the bank, isn't it?
It is real cash, yeah. But budgeting, it's one of the most dangerous things a management team can do.
Really? Why?
Because if you budget extrinsic value at the start of the year, you convert a discretionary upside into a mandatory target. You force the desk to chase a manufactured number. So when the market is quiet, volatility is low, traders will start taking reckless, unbacked risks just to hit that budget.
Oh, wow. Rather than waiting for genuinely good trades.
Exactly. The best practice is to budget only the intrinsic value, the lockable part, and report the extrinsic value later as a measure of actual realized skill against a historical capture rate.
That makes total sense. Keep the baseline safe, measure the genius later. So what's the fourth layer?
The fourth is operational leakage. And this is a crucial concept for anyone in risk management or those running ETRM systems.
Real quick, ETRM, let's just define that for the listener.
Oh, sure. Energy trading and risk management systems. It's the software infrastructure that tracks your trades, positions, and risk exposures.
Got it.
So operational leakage is a cost, not a value. This is the money destroyed by things like facility outages, fuel retention, imbalance penalties, nomination errors. It's essentially reporting a theoretical profit in your ETRM system that will simply never arrive in reality.
Let's ground this in reality, actually. The notes mention a worked example in Europe to show exactly how intrinsic value can trick a desk into reporting these fake profits. Before we do the math, you mentioned terms like winter strip and nameplate volume in the source material. Can we clarify those?
Of course. The winter strip is simply the forward price of gas for the upcoming winter months. And nameplate volume is the theoretical maximum capacity printed on the asset's brochure, like the total amount of gas the facility can technically hold.
Right, the marketing numbers.
Exactly. So let's look at a European depleted field storage facility. It has a nameplate working gas capacity of 600,000 megawatt hours. The forward curve offers a summer gas strip at, let's say, 25.4 euros per megawatt hour and a winter gas strip at 34.90 euros.
Which gives us a gross seasonal spread of 9.5 euros, but we have to account for those fixed costs you mentioned earlier.
Right. We subtract a 2.9 euro capacity fee and 0.35 euros in variable costs for injecting and withdrawing. That leaves us with a flat net intrinsic margin of 7.05 euros per megawatt hour.
Okay, so to simplify this for everyone listening, after all the fees, we're looking at roughly 7 euros of pure profit per unit. So if I'm a junior analyst, I take my 600,000 megawatt hours of brochure capacity, multiply it by those 7 euros, and I proudly announce to my boss that we have a locked theoretical profit of roughly 4.2 million euros.
And if you do that, you are walking your desk directly into a trap.
No.
Yeah. That naive calculation assumes you can actually withdraw all 600,000 megawatt hours precisely when you need them at top speed during the tightest winter window. It completely ignores the physical reality of the deliverability ratchet.
The ratchet.
Yeah. As a storage facility empties out, the physical pressure inside the underground reservoir drops.
Oh, I think I see where this is going. Is it sort of like a tube of toothpaste? Like when the tube is completely full, you barely squeeze it and the toothpaste just flies out fast and easy. But when you get down to that last 10 or 20%, you have to roll it, flatten it against the bathroom counter, put your whole body weight on it. Getting that last bit out requires immense effort and time because the pressure is just gone.
That is exactly the physics at play. Because of that pressure drop, the achievable deliverability across the withdrawal season might only be 78% of the volume your flat calculation assumed.
Wow, just 78%.
Yeah. Your real deliverable volume is only 468,000 megawatt hours.
Which means your actual realizable intrinsic value isn't 4.2 million euros. It's just under 3.3 million. Over 900,000 euros of that locked theoretical value is entirely illusory.
It is destroyed by the physical reality of the asset.
That is terrifying for a risk manager. What happens when a desk ignores the toothpaste tube reality and trades purely on that flat math? Do we have a real-world example of this going wrong?
We do. The material provides a constructed composite case study. And just to be clear, this is built from the structural patterns of European storage operations that were publicly discussed by AZO, the Agency for the Cooperation of Energy Regulators, and the European Commission during the 2021 and 2022 refill debates. So it's not a single identifiable operator, but it represents a structural reality of how these desks fail.
Got it. Walk us through the disaster.
Okay, so a trading arm leases storage and treats it as guaranteed margin. They hedge 100% of their nameplate volume on day one. They buy the summer gas, sell the winter gas, and book that 4.2 million euro intrinsic as a locked profit in their ETRM system.
Just taking a victory lap before the winter even starts?
Exactly. Then a cold December hits. They draw down the facility faster than anticipated to capture some spot volatility. But by late January, the ratchet binds hard. The physical pressure drops and their deliverability falls way below their contracted withdrawal schedule.
Because they sold winter gas, they now physically cannot deliver. The toothpaste tube is flat and they're out of time.
Yes. They find themselves short 132,000 megawatt hours. And because they sold it on the forward curve, they have a strict obligation to deliver it. They're forced into the spot market during the coldest, most expensive days of the year to buy replacement gas.
Oh, that's brutal.
Buying that spot gas to cover the shortfall cost them over 6 million euros, against a hedge that was only worth 4.6 million.
Ouch. So the net cover loss is nearly 1.5 million euros. The realized value of the asset plummets and they completely miss their annual plan.
The lesson here for risk professionals is absolutely critical. The error wasn't the hedge. The error was hedging a volume the asset could not physically deliver. Booking intrinsic at inception on nameplate volume is a massive governance failure. You must never do it. You only ever hedge the deliverability adjusted volume. The rest of the gas is just optionality, to be monetized only if physical conditions allow.
Okay, so how do we actually stop this from happening? If I'm running a desk, how do I build a tool that prevents my traders from making this exact mathematical error?
The master program includes an applied build for this. You have to build a deliverability-adjusted intrinsic calculator.
Okay, what do I need for that?
The inputs you need are your working gas capacity, your injection and withdrawal curves, your capacity and variable fees, and the most critical component, a ratchet table. This table maps the inventory percentage to the maximum daily withdrawal rate.
So the table maps exactly how flat the toothpaste tube is against how hard it is to squeeze.
Perfect analogy. Step 1. Compute the flat intrinsic, so the winter strip minus the summer strip minus fees. Step 2 is where the magic happens. You simulate the withdrawal path day by day in your code. At every single step of the winter, the model checks the current inventory level against the ratchet table to cap the withdrawal.
Okay, so it builds a realistic path.
Right. And step 3, you sum up that constrained path and report your intrinsic value only on that deliverable volume. You explicitly label the difference as ratchet leakage.
Code can be incredibly messy, though. If a junior analyst builds this, or if I'm a risk manager reviewing it, how do I verify this model actually works and isn't hiding some disastrous bug?
We use a very simple acid test. You manually go into your model and set the ratchet table to a constant 100% deliverability no matter what the inventory level is. You run the simulation. If your simulated day-by-day model does not output the exact same number as your simple flat intrinsic calculation, you have a bug in your code.
Oh, that's smart.
Yeah, this simulation is foundational. It actually becomes the core of the multi-cycle storage valuation engine we build later in the course in Chapter 46.
That is a brilliant safety check. So that covers the European depleted field, which fails due to physical ratchets. But the notes highlight a North American worked example that fails for a completely different reason. Let's look at the structural market contrast there.
Let's shift to a U.S. salt dome facility holding 2 million MMB2 million British thermal units. The summer injection strip is 3.05 US dollars, and the winter withdrawal strip is 4.62.
Okay.
After factoring in a storage fee of $0.28 and fuel retention costs, the flat net intrinsic margin is roughly 1.24 US dollars per MMB2.
Wait, let me do a quick conversion here. Earlier, our European depleted field had a margin of about 7 euros per megawatt hour. If we normalize that European asset into US dollars and MMB2, its margin was roughly $2.25 per unit.
Correct.
This US salt dome is only yielding 1.24. Why would anyone want the US asset if the margin per unit is almost half?
The answer is cycling. A European depleted field is huge, but it's physically slow. It typically cycles, meaning fully injects and withdraws its capacity about 1 to 1.5 times a year.
Right.
A U.S. salt dome, on the other hand, is built in a hollowed-out salt cavern. It has incredible deliverability. It doesn't just cycle once. It can cycle 5 to 12 times a year.
Ah, so you multiply the margin by the number of cycles, you might make less per unit, but you're turning it over 7 or 8 times a year.
Exactly. And when you multiply that out, the annual value of the U.S. asset is massively higher. But this brings us to the critical structural contrast. That high value comes with a terrifying level of operational intensity.
Which leads us directly into how North American desks fail. They buy the asset because they see this massive annual value on a spreadsheet, but they don't buy the organizational capability to actually run the thing.
Spot on. We have another composite case study for this, reflecting patterns from FERC, the Federal Energy Regulatory Commission, and NERC, the North American Electric Reliability Corporation, regarding winter performance failures. We have a Rung 1 financial trading firm.
For context for the listener, rung 1 on the obligation ladder means this firm is used to trading purely financial paper. They don't do physical gas deliveries.
Exactly. And this financial firm decides to acquire leased physical storage capacity, which is a Rung 5 physical asset to, add optionality to their portfolio. But they treat it like a paper trade. They do not upgrade their ETRM systems. They don't hire specialized physical scheduling staff.
That sounds like a recipe for disaster.
Oh, it is. Nominations for injection and withdrawal at a high deliverability salt dome require daily, cycle-aware scheduling and constant babysitting. The firm just hands that job to a junior trader who's already stretched thin, and worst of all, nobody's rostered to work after 1800.
You're kidding. So it's 6:00 p.m., the junior trader goes home, the lights are out, and I assume the market decides to do something crazy.
A brutal winter cold snap hits. The local grid goes into emergency mode. Intraday renominations are required to flow gas to the pipelines that desperately need it, but it's after hours. The firm entirely misses the nomination deadline.
Let me guess, the pipeline hits them with massive imbalance penalties.
Massive penalties. 310,000 US dollars worth of imbalance charges. But that isn't even the worst part. Because they missed the intraday nomination, they completely miss withdrawing their gas on the 2 highest-priced peak demand days of the entire year.
They were holding the gas exactly when the market desperately needed it, and they just couldn't get it out of the ground because nobody was awake to push the button.
Yeah. That operational failure resulted in a $4.3 million opportunity cost. When the dust settled, an asset that was budgeted to yield a $2.5 million intrinsic profit ended up with a negative outturn of over $2 million.
So an option you cannot exercise at the moment of maximum value is worth close to zero. You can have the best asset in the world, you can have the math perfectly calculated, but if your operations team isn't built for the physical reality of the asset, it's worthless.
The asset was correctly valued in theory. The firm simply couldn't operate it in practice. Moving down the obligation ladder from financial paper to physical assets requires moving the whole organization, not just signing a lease contract. The ultimate pre-acquisition question every senior manager must ask is not, is this asset cheap?
What is it then?
The question is, can we operate it on the worst day of the year?
Can we operate it on the worst day of the year? That is the real test. Let's synthesize all of this. We've covered incredible ground today on how asset-backed desks operate, how they value their assets, and how they fail in both Europe and North America.
Yeah, to pull it all together first, you must value your physical assets as options. You are short cash for the fees, but long the optionality to run it when the market spread dictates.
Right.
Second, never hedge undeliverable volume. Always adjust your intrinsic calculations for the physical reality of the deliverability ratchet, run that simulation, and verify your code. Otherwise, you'll find yourself buying expensive spot gas to cover a physical shortfall.
The toothpaste tube rule.
Exactly. And third, never step down the obligation ladder without bringing your risk systems, your ETRM technology, and your operational staff with you.
It all comes back to the difference between a theoretical spreadsheet, and physical reality. So if the systems are in place, the math is right, and the asset is sound, who is actually pushing the button? Like, how do you govern the humans making these high-stress calls?
Asset optionality is ultimately exercised by individuals making judgment calls in real time on the desk. The difference between a trader capturing rolling intrinsic and a trader just taking a wild punt is often only visible in hindsight.
Right.
That brings us to Chapter 4 of the program, where we will cover decision rights, how to design your governance and capital allocation so you can make that difference visible before the trade ever happens.
I cannot wait to dive into that one. Governance sounds like a dry topic until you realize it's quite literally the only thing keeping your firm out of a multi-million-dollar crater. Thank you so much for walking us through this masterclass.
It was my pleasure.
And for you listening, I want to leave you with a final thought to mull over as you head back to your own desk this week. We started by talking about a freezing winter and a spreadsheet claiming you've made millions. Look closely at your own daily processes, whether you trade gas, manage risk, or write code. Based on what we just discussed, how much invisible operational leakage is hiding in your organization right now, quietly destroying the theoretical value your models claim you have. Until next time, keep digging deeper.
It's wild how a gas trading desk can run perfectly for years. Just, managing risk, capturing value, everything clicking,
Oh, absolutely.
and then boom, it fails catastrophically in a single afternoon. And the craziest part about all of this, it is almost never because of bad math.
Right. Or a broken pricing model.
Exactly. It usually comes down to, well, a really simple, fatal confusion between seniority and authority. So let's unpack this for today's deep dive.
I'm thrilled to be here to do just that because I've seen this happen so many times.
And with your background, you've definitely had a front row seat to this stuff.
Yeah, I mean, in my consulting work at Durga Analytics, I've spent decades trading physical and financial gas across European and North American markets, building desks, running them, designing ETRM systems,
Right.
and really just teaching everyone from traders and schedulers to risk managers how to actually survive in this market. And watching these exact desk failures play out is, well, it's sobering.
Which is why this is such a critical starting point for the listener today. Just a quick reminder of the overall course structure we're working through here. This is the Natural Gas Trading Desk Master Program.
Yep. A sequenced journey across 9 modules and 120 chapters.
Right, covering everything from, what a gas desk is actually accountable for, down to market structure, curves, risk, scheduling, all the way to desk leadership.
And that's exactly why before we even touch pipeline physics or the complexities of trading software in later modules, we have to start right here in Module 1.
Module 1, Chapter 4, specifically, Senior versus Junior Trader Decision Rights.
Exactly. Because if you get today's topic wrong, none of the rest of those 120 chapters matter. I mean, the best strategy in the world, it collapses without clear governance.
It's where the rubber meets the road. Because when we talk about a functioning desk, authority seems totally obvious on, like, a normal Tuesday.
Right, when nothing's going wrong.
Yeah. But then a high-stress, contested situation hits, and suddenly that implied authority, that unspoken idea that everyone just knows the senior trader decides, it evaporates.
It completely evaporates. On most desks, the words senior and junior, they really just describe compensation and tenure.
Wow. Yeah, that's a good point.
Right. They do not automatically describe who gets to decide what. When a desk relies on implied authority, it is essentially a ticking time bomb.
So how do we diffuse it?
To fix this, we need to break decision rights down into 4 very distinct verbs, and these must be explicitly assigned to every single action on a desk.
Okay, let's hear them.
Those verbs are decide, consult, inform, and veto.
Wait, let me just push back on this for a second. Why do we need all this bureaucracy?
It sounds like a lot, I know.
Yeah, like, if I've been on a desk for 10 years and a junior trader just started 6 months ago, shouldn't common sense dictate that I make the final call? Why do we need a complex matrix for what our job titles already tell us?
Well, because tenure doesn't equal mandate. And honestly, common sense just disappears under extreme stress.
Fair point.
Let's look at those verbs. Decide means you make the call and you own the outcome. Consult means you must be asked before the decision is made. Now, you can disagree, but you cannot block it.
Got it.
Inform means you just get told after the fact. And veto means you can block a decision, but you cannot instruct an alternative.
Wait, so a veto stops action, But it doesn't create new action.
Precisely. That last point on the veto is critical. It's often really misunderstood by risk departments, but the golden rule, the one structural rule that truly matters here, is that every single decision must have exactly one owner of decide.
Okay, this reminds me of driving a car. If two people try to steer the car at the same time, you crash.
Yep.
If nobody steers the car, you crash.
Yep.
You need exactly one person with their hands on the wheel. But earlier in your notes for this deep dive, you mentioned something that caught me totally off guard.
Oh, what was that?
You said having zero owners of a decision is actually worse than having two. Why is that?
Ah, right. Let's look at the psychology of panic. When there are zero designated owners, the decision doesn't just hang in a vacuum. It gets made anyway.
By who?
Usually by whoever happens to be nearest the keyboard when the clock runs out.
Oh, wow.
Yeah. And that person might be, a junior scheduler who doesn't have the mandate, the context, or the capital allocation to make that call. They just act out of pure panic to do something.
Which brings us to a bigger question. Why do gas desks, in particular, fall into this trap so often? Like, what makes gas different from, say, trading equities?
Gas markets have really unique, intense pressures. First, the time pressure is extreme.
Okay.
Nomination cutoffs and intraday balancing windows, they force multi-million-dollar decisions in a matter of minutes.
Right, the clock is always ticking.
Exactly. Second, you have the physical and financial split. A trader owns the financial price, a scheduler owns the physical flow, and very often, nobody clearly owns the combination of the two.
That sounds incredibly dangerous.
It is. And third, gas assets have massive optionality. Like deciding whether to inject gas into storage or transport it down a pipeline, that invites continuous judgment calls without a clean, obvious, right answer.
Okay, let's slow down and ground this with some hard numbers, because you provided a European worked example about limit utilization that it perfectly illustrates how this breaks down in practice.
Yeah, let's dive into that one. Let's look at a European gas book. It has a value at risk, or MAR limit, of 5 million euros.
Okay, 5 million.
Currently, the desk is using 4,150,000 euros of that limit.
So doing the math, that means their utilization is at, what, 83%?
Exactly, 83%. Now, a trader wants to execute a trade that the desk's ETRM software, the energy trading and risk management system that acts as the nervous system of the operation.
Right.
The system estimates this new trade will consume another 900,000 euros of VAR.
Okay, let's do the math on that. We're at 4.15 million. We add 900,000. That brings the new total to 5,050,000 euros. Since the hard limit is 5 million, our post-trade utilization hits 101%. It breaches the desk's limit by 1%.
Yep. And the question here isn't whether it's a highly profitable trade. The strategic question is who is actually permitted to authorize it.
Right.
On this desk, the matrix bands dictate that from 0 to 70% utilization, the trader decides. From 70 to 85%, the senior trader decides.
Okay, got the bands.
From 85 to 100%, the desk head decides. And above 100%, the head of trading decides, with risk holding a veto.
So hold on. If they are currently sitting at 83% before the trade happens, doesn't the senior trader just make the call? I mean, 83% falls right in their designated band.
What's fascinating here is a concept called post-trade determination. The authority must always be determined by the post-trade state, not the pre-trade state.
Oh, I see.
Because the post-trade level lands at 101%, the decision skips the senior trader, skips the desk head, and moves 2 bands up directly to the head of trading, with the risk department having a veto.
But I can totally see why traders would argue against that. If a desk uses pre-trade rules, the senior trader could just authorize the trade because they were at 83%. Inadvertently, or let's be honest, intentionally, push the desk into a breach and then just report it retrospectively.
Precisely. If you use pre-trade determination, you have basically built a control system that authorizes its own breaches.
That is wild.
Think about the psychological temptation there. A trader can just inch their way past the limit, book a massive position, and ask for forgiveness later, claiming they had pre-trade authority. It destroys the control framework entirely.
So how do you fix it?
Post-trade determination costs nothing to implement in your ETRM system, and it removes the loophole completely. It forces the escalation before the risk is taken.
That is a subtle but massive distinction. It shifts the entire power dynamic. Now, the European example showed how authority fails around mathematical limits. But let's cross the Atlantic.
Let's do it.
Because in North America, authority often fails not because of the math, but because of the clock.
Oh, the North American gas market clock is incredibly unforgiving. Let's look at an intraday nomination decision. A U.S. desk holds firm transport on a pipeline and has to submit an intraday nomination before the pipeline's cycle deadline.
Okay, fed in the scene.
It's 13.4, just 20 minutes before the absolute cutoff, and the scheduler suddenly sees that a supply counterparty has only confirmed 18,000 MMB2 against a nominated 26,000 MMB2.
Yikes. So we have an 8,000 MMB2 shortfall, and the clock's ticking down fast. People are sweating. What are the actual options here?
There are three active options. Option A, the desk head decides to cut the downstream nomination to match the 18,000. This causes a customer shortfall and incurs $20,000 in contractual damages.
Ouch. Okay, what's action B?
Option B, the senior trader decides to buy 8,000 MMB2 on the spot market at receipt. At a $6.20 spot price, that will cost the desk $49,600.
Even worse. And option C?
Option C, the desk head and risk department decide to nominate the full $26,000 anyway and just eat the imbalance penalty, which is $6,800 plus the risk of triggering an operational flow order.
Wait, what's an operational flow order?
Pipelines issue those when the physical system is strained. It brings massive, unpredictable penalties.
Okay, so none of those are great. You're either paying damages, paying a premium on the spot market, or risking massive pipeline penalties. But, I mean, they're all survivable business decisions.
Right.
But then there is option D, the non-decision.
Yes. Option E is doing nothing and missing the nomination cycle entirely. And on badly governed desks, option D is the one that actually happens.
Why?
Because in a corporate environment, doing something and being wrong gets you fired. Doing nothing and being wrong gets blamed on circumstances or, market volatility.
Wow. Human nature at its finest.
Exactly. When nobody is clearly authorized to make the call in that 20-minute window, waiting just feels safer than acting. The scheduler freezes because they are terrified of being the single point of failure in tomorrow's postmortem review.
But waiting removes all the other options. It guarantees the worst possible outcome because you lose control of the flow completely.
Exactly. Missing a nomination cycle is strictly the worst outcome. So the governance fix here isn't about telling people to be faster traders or braver schedulers.
What is it then?
It's about documenting what we call an unreachable case default. You write it down before the day you need it.
Like what? What does that look like?
Something like, if no decision is reached by cutoff minus 10 minutes, the scheduler nominates to confirm supply and informs the desk head.
That is brilliant. That single sentence turns a panic-induced non-decision into a pre-authorized business decision. It bounds the risk and completely removes the fear of blame from the scheduler.
This is the operational expression of control lag. You must have a designated path for when the person with the decide authority is simply not there or not responding.
So you've built this bulletproof logic for the clock and the math. But I mean, I've been on desks where the matrix exists in a binder somewhere, and literally nobody looks at it. What happens when the paper says one thing but human nature does another?
This is where we get into our first case study. Now, before we detail this, a quick sourcing note for the listener. This European case study is a composite scenario.
Okay, good to know.
It reflects governance findings publicly discussed in European energy regulatory enforcement. So it does not describe any specific identifiable firm, but it represents a very real structural failure.
Right, so paint the picture for us.
Yeah.
How does the paper matrix fail?
Imagine a European gas desk that has a perfect decision rights matrix. It was approved during a governance review, it's filed away, it looks fantastic to the auditors.
Checking all the boxes.
Exactly. On this matrix, the desk head resolves limit breaches, but in reality, the desk head is always traveling, they are flying to client meetings, presenting to the board, and they're frequently unreachable during the core European trading day.
But the market doesn't stop just because the boss is at 30,000 feet. The desk still has to function. So what happens?
The senior trader steps up. They start resolving limit breaches informally based on precedent. They just make the call and inform the desk head afterward via email.
Just getting the job done.
Right. And over 8 months, this becomes the operating norm. The matrix is never updated. It just gathers dust. Then, one day, a significant breach occurs. The desk head is on a flight. The senior trader resolves it as usual, increasing the position because that's what they've always done.
And let me guess, this is the day the market violently moves against them.
It does. Heavy losses occur. And in the subsequent regulatory review, the firm cannot demonstrate that any individual actually held the authority for the decision that caused the loss.
This is exactly like a building where the blueprints show a state-of-the-art fire escape, but in reality, that door opens up to a solid brick wall. It passes the audit on paper, but in an emergency, It is an absolute liability.
Exactly, and when the alarm rings, you're trapped. And the crucial lesson here is that the failure wasn't the trader.
Wait, really?
Yeah, the trader acted in good faith, completely consistent with 8 months of precedent and desk culture. Sanctioning the individual trader would be unjust. The true defect was the lack of that unreachable case default we just talked about, combined with a total failure of management to update their governance to match reality.
And the regulators care about this, because if a firm can't prove who is accountable, the firm is a systemic risk, not just a victim of a bad trade. Their regulatory exposure is massive, completely independent of the financial loss itself.
Exactly. You must review your matrices against your actual decision logs, not against your intentions. If practice has diverged from the paper, you have two choices.
Which are?
You either strictly enforce the matrix or you change the matrix to reflect the new reality. You cannot leave the gap open.
That makes total sense. Now, if the European case study was a catastrophic failure of having zero active decide owners, the North American case study shows the exact same disaster resulting from having two decide owners.
Right. And again, a quick sourcing note. This is a teaching composite drawn from structural patterns described in public findings on winter operational performance.
Got it. Set the scene for us. Why would two people think they are both in charge?
It's a bitter cold winter morning in the U.S. Spot gas prices have spiked to $41 per MMBtu due to massive heating demand. The desk holds a storage hedge, gas they bought and injected earlier in the year, executed at just $4.60.
Okay, so at a $41 spot price against a $4.60 hedge, that is a $36.40 spread. The economics are screaming to pull every single molecule out of the ground.
It is a massive commercial opportunity. Now, this desk splits responsibility for storage withdrawal between two groups.
Oh.
Yeah, the trading desk, which owns the economics and P&L, and the operations group, which owns the physical plant and the pipeline integrity. Crucially, both groups genuinely believe they own the final withdrawal decision.
That is recipe for disaster. You have two totally different incentive structures colliding.
Exactly. The trading desk assumes operations will withdraw at the maximum physical capacity of 150,000 MMB2. Because from a P&L perspective, it's a no-brainer. You sell everything you can at a $36 spread.
Makes total sense from a commercial perspective. But operations isn't bonused on P&L, are they?
No, they are evaluated on reliability and safety. The operations group is looking at the physical inventory. They see it approaching a level where a regulatory ratchet binds, meaning if they pull too much, the pressure drops, and they might not be able to meet obligations later.
Right.
So conservatively, they decide to withdraw only 60% of just 90,000 MMT2 to preserve deliverability for a forecast colder day later in the week.
And because both groups think they own the decide right, neither party feels the need to inform the other. They both assume their logic is the final logic.
Correct. And to make matters worse, the forecast cold day later in the week turns out to be milder than expected. That preserved deliverability is never needed. The gas just sits there.
Okay, let's run the math on this opportunity cost because it's staggering. Maximum available was 150,000. Operations only pulled 90,000. So that is 60,000 MMB2 left in the ground. You multiply that foregone volume of 60,000 by the $36.40 spread. That is $2,184,000.
Yeah.
Over $2 million lost.
Yeah.
Not because of a bad trade, not because of market volatility, but purely because of an internal communications failure.
If we connect this to the bigger picture, the tragedy here is that neither party was logically wrong. Operations preserving deliverability based on a weather forecast is entirely defensible.
Sure.
Trading maximizing a $36 spread is entirely defensible. The failure was purely structural. Two decide owners on one decision, with each assuming the other was aligned.
How do you fix that structurally? I mean, you can't just tell them to communicate better. That never works when the pressure's on.
No, it doesn't. The correct design gives the decide right to exactly one party, with the other holding a consult or a veto. In this specific case, trading should own the decide because the withdrawal decision is fundamentally an economic optimization of an asset.
Okay, that makes sense.
But operations must hold a veto, and this is key exercisable only on physical integrity or regulatory grounds, not on commercial judgment.
So ops can't veto just because they think prices will be higher on Thursday. They can only veto if the pipes are actually going to freeze.
Exactly. If operations had vetoed on physical grounds and trading disagreed with their assessment, that conflict would have escalated to the desk head in minutes. Instead, the failure was only discovered in a month-end P&L review long after the $2 million had vanished.
Wow. So we've seen how badly things can go wrong on both continents. The math of post-trade limits, the tyranny of the clock, the danger of paper authority, and the chaos of duplicated authority. If you're a listener running a desk or building one, how do you actually implement this?
If you're listening to this and want to stress test your own desk tomorrow morning, here is exactly what you should do to build this matrix. First, list every recurring decision type. You should aim for 12 to 20 rows.
Okay, 12 to 20.
Granularity is what makes this tool useful. Don't just write trade gas. Write roll a storage hedge or override a model-generated curve price or declare force majeure.
Once you have those 12 to 20 highly specific rows, what's the next step?
For each row, assign exactly one decide. Then assign the appropriate consults and informs. Only assign a veto where a genuine blocking right exists, like risk or compliance. Once you've mapped it out, you run what we call the ambiguity test.
I love this test. It's so binary, you can't fake it.
You really can't. You look across every single row. Any row that has 0 decide cells or 2 decide cells is a defect. You have just found exactly where your next desk incident will originate. You must fix it before publishing.
And we can't forget the clock. You have to add that column for the unreachable case default.
Absolutely. What happens if the decide holder is on a plane within the 20-minute operational deadline? Most desks have never written this down, and it is their greatest vulnerability. Finally, run a stress test.
How does that work?
Take the last 3 incidents or near misses on your desk and run them through your new matrix. If the matrix wouldn't have changed the outcome of those incidents, your matrix is too coarse. You need to get more granular.
So what does this all mean? It means that a decision rights matrix isn't just corporate bureaucracy or an exercise to keep an auditor happy. It is the actual, literal physics of how a trading desk survives under pressure. It dictates whether your desk acts with precision or collapses into costly paralysis.
Which brings us perfectly to the next step in the master program. This matrix we just built operates inside a broader mandate. In Chapter 5, we will explore desk mandates and capital allocation.
Oh, looking forward to that.
We are going to take the limit utilization bands we learned today and use them to define what a desk is actually permitted to do before any individual decision even arises.
Well, before you move on to Chapter 5, I highly encourage you to sit down, build a 3-row matrix for your current role, and put it through that ambiguity test. I'll leave you with this final thought to mull over. What if the biggest, most expensive risk hiding on your trading desk right now isn't the market volatility outside your building, but simply the silence between two people who both assume the other is in charge? Take a hard look at your desk, and we will see you in the next deep dive. So whether you are a junior analyst just starting out, or maybe a scheduler trying to navigate complex pipeline flows, or even a seasoned risk manager keeping an eye on the books.
I have a really crucial question for you today.
Oh, I think I know where you're going with this.
Yeah, think about the trading desk you work on right now. Do you actually know what your desk is allowed to do, or, do you just know what it usually does?
Right, and that is a question that usually gets a lot of uncomfortable silence if you ask it in a room full of traders.
Exactly.
Because there is this massive gulf between tradition and actual governance. I mean, one is just a habit, right? A habit that works fine until it suddenly doesn't.
Yeah.
But the other is a legally and financially binding boundary.
Right.
It basically dictates your survival in the market.
And defining that boundary, that's exactly what we are unpacking in this deep dive today. So to set the stage for you, we are continuing our journey through the Natural Gas Trading Desk Master Program, which, as a quick reminder, is drawn from the methodology of Durga analytics, right? It's based on decades of real-world trading, building desks, and risk management consulting across both European and North American markets.
Right. It's a huge sequence. 9 modules, 120 chapters in total. It takes you all the way from understanding what a gas desk is actually accountable for, through market structure, the physics of the pipelines, trading playbooks, curve construction, risk, execution.
ETRM systems, regulation, conduct, everything.
Exactly. All the way to the leadership and legacy of a durable desk. In today's mission, we are currently anchored in Module 1, which is running a gas trading desk. And specifically, we're diving into Chapter 5.
Chapter 5, desk mandates and capital allocation.
Right. So in Chapter 4, we looked at decision rights, basically who gets to make the call. But today, we're tackling something even more foundational.
Yeah, what can actually be decided in the first place?
Exactly. The objective here is to extract desk-ready, practical insights on how to build enforceable mandates, how to spot this thing called mandate drift, and how to properly allocate capital so your trading desk actually survives and makes money.
Well, to do that, I mean, we have to establish a very sharp distinction right out of the gate. A mandate is not a strategy document.
Right.
It is not a performance target. It's not a business plan. A mandate is a boundary, period. So if your strategy document is, your roadmap for where you want to drive, the mandate is the guardrail keeping you from driving off the cliff.
I always like to think of it like the physical boundary lines on a sports field.
That's a good way to look at it.
Right, like the lines don't tell the players what plays to run. They certainly don't tell them how to score.
Yeah.
But they clearly define where you are going to get penalized for stepping out of bounds.
Exactly. And to be genuinely useful, this text argues that a mandate must constrain a desk on 4 essential axes at the exact same time.
And leaving even one of those axes unconstrained, that creates an exploitable gap.
Right.
Yeah, a massive one. So the 4 axes are product, tenor, size, and market.
Let's break those down a bit for a gas desk. So, product.
Right. Product dictates which specific instruments you can trade. Are you allowed to trade physical gas or just financial swaps or, complex options?
Okay, and tenor.
Tenor is how far out into the future you can trade them. So can you only trade the prompt month, or are you allowed to lock in prices 5 years down the curve?
Got it. Then size is pretty obvious how much volume or financial risk you can take on.
Right. And finally, market, which specifies where exactly you are allowed to transact geographically.
Let's look at how that actually reads on paper, though, because the distinction between a weak mandate and an enforceable one,
Yeah.
it basically comes down to precision.
Oh, absolutely. A weak mandate might just broadly say, the desk can trade European gas.
Which is terrible.
It's awful. An enforceable mandate, on the other hand, says the desk can trade TTF, DHE, and NBP futures and swaps, physical at TTF and the only, and no options without separate approval. It leaves zero room for interpretation.
And that size constraint, I mean, that is notoriously plagued by vague language, right?
Right.
You frequently see these legacy mandates that say something like trade in prudent levels.
Yes. But, what does prudent even mean? It's entirely subjective. An enforceable version relies on hard metrics.
Like what?
It will say, value at risk. Basically, the maximum amount we expect to lose on a normal bad day is capped at 5 million euros, and maximum volume is 250,000 megawatt hours in any single delivery month.
Which brings up what the text calls the ultimate test of a mandate. And I love this test.
The compliance officer test.
Yes, if I'm a compliance officer with absolutely zero trading knowledge, I should be able to look at a trade ticket, look at the mandate document, and know instantly if the trade is permitted.
Right.
If I have to walk over to the desk and ask the trader for context or, some complicated explanation to figure out if they broke a rule, the mandate isn't a control mechanism. It's literally just a suggestion.
It's the perfect operational test.
Yeah.
A control that requires the person being controlled to explain it to you is a broken control.
I do want to push back on this rigid structure just a little bit, though.
Okay, go for it.
If you restrict a desk on 4 distinct axes at once, aren't you kind of strangling a trader's ability to react? I mean, gas markets are incredibly volatile.
Sure.
So if a geopolitical event happens and prices spike, shouldn't a trader have the agility to pivot into a new market or a new instrument to capture that value, or even just defend their book?
That is probably the most common objection you hear from the trading floor. But we have to separate agility from blindness.
How do you mean?
Well, these constraints don't strangle the trader. They protect the firm from uncalibrated risk. Let's say you leave the market axis unconstrained just to allow for that flexibility you mentioned.
Oh.
During a crisis, a trader might take a massive position in some highly illiquid, obscure peripheral hub because they see an arbitrage opportunity.
Right. They think they're being smart.
Exactly. But the problem is the firm's risk models might not even be calibrated to measure the blow-up risk of that specific hub. Your back office ETRM systems might not even be set up to schedule the physical gas there. So flexibility without boundaries usually just results in a massive blind spot.
Okay, that makes sense. But if these rigid constraints are there to protect the firm, how do desks still end up holding these unauthorized catastrophic risks?
Because boundaries rarely get shattered in one dramatic rogue trading event. They get quietly stretched.
Right, which brings us to mandate drift.
Yes. Mandate drift is the silent killer of trading firms. The mandate gets stretched through a series of individually defensible, totally logical steps.
So every single decision makes commercial sense in the moment, but the cumulative effect over time is this massive unauthorized portfolio. Let's actually put ourselves in the trader's shoes for a second to see how this happens mechanically.
Great idea.
So imagine you have a strict mandate for Northwest Europe, And one day, you execute a one-off trade at an Italian delivery point. You do this specifically to hedge an existing Northwest European position. It's just a hedge. It makes total commercial sense, your risk goes down, and nobody yells at you. What happens next?
Well, human nature takes over. That Italian position worked well. It did its job.
Right.
So a few weeks later, the desk does a second one. And suddenly, they aren't just placing a one-off hedge anymore. They are actively managing a small Italian book.
Just a little one, though.
Right, just a little one. But then an Italian counterparty offers them an incredibly attractive structured deal. It technically fits within their overall volume size limits, so the risk system doesn't flash red.
And fast forward 18 months, the desk is now holding a material, highly complex Southern European book.
Yep, and no mandate actually ever authorized this.
But wait, if every single step made commercial sense and no hard limits were technically breached, why is this so dangerous? Isn't this just traders being smart and finding alpha?
It's dangerous because of the infrastructure. The firm's ETRM systems, the price verification processes, the risk models, they were all built and calibrated for Northwest Europe.
So the models can't see the new risk.
Exactly. When you drift into a new region, you are holding risk that your models fundamentally cannot see accurately. You are flying blind. And that is why the text emphasizes monitoring the composition of your risk, not just waiting to see if you hit a hard size limit.
So how do you actually combat this? The text talks about 3 specific drift detectors.
Right. So the simplest one is a new point report. Any delivery point, virtual hub, or instrument that gets transacted for the first time in a 12-month rolling period gets automatically flagged to the desk head.
That sounds pretty easy to implement.
It is. It's cheap, and it immediately highlights when a trader steps into new territory. Then, building on that, you have composition drift tracking.
How does that one work?
It looks at the share of risk by market and product on a monthly basis. So if your risk profile shifts by more than 5 percentage points in a single quarter...
Say, suddenly 10% of your risk is in Italy, when it historically hovered near zero.
Exactly. That requires a formal written explanation.
Got it. And the third detector?
Mandate reconciliation. Every single quarter, you list every open position and strictly map it to a specific clause in the mandate. If a trade cannot be mapped to a clause, it either gets formally authorized by expanding the mandate or it gets closed out.
It's a ruthless hygiene practice, but I can see why it's necessary. And, if we zoom out to the broader global market, this rigorous mapping reveals a fundamental truth from the course.
Which is that you cannot just copy and paste a mandate from one region to another.
Right. The physical reality of the infrastructure demands entirely different governance language, which perfectly sets up the structural contrast between European and North American markets.
We always have to look at both.
Yeah, let's look at Europe first. Why are the mandates so different there?
Well, in Europe, mandates typically bind on named virtual hubs. So think of the TTF in the Netherlands, the DFEE in Germany, or the NBP in the UK.
Okay, so virtual hubs.
Right. The reason we use virtual hubs is because within those market areas, the gas is treated as fungible. The capacity is based on entry-exit bookings. As long as you get the gas into the zone, it can be traded freely within it.
And regulatory-wise?
The regulation focus is primarily on REMITE, the framework monitoring wholesale energy market integrity. And of course, size is measured in megawatt hours in euros.
Okay, so trading in Europe is basically like swimming in a giant community pool. All the water mixes together freely within that designated area.
That is a great analogy.
But if you take that same mindset to the U.S. market, you're in real trouble. Trading in the U.S. is much more like managing a massive, complex plumbing system, where one single blocked pipe can back up and ruin the entire house.
Yeah, highly accurate. And because of that physical plumbing reality, U.S. mandates must bind on individually listed pipeline points and city gates.
Every single one.
Yes, because every single physical delivery point represents a distinct, unique basis risk. Capacity isn't just a general booking into a zone. It relies on firm transport paths between specific receipt and delivery pairs.
So the regulators are watching that physical path.
Exactly. Regulators like FERC and the CFTC are watching those specific physical and financial movements closely. And everything is measured in MMB2 and US dollars.
This ties directly back to something covered in Chapter 1 of the program, actually the catastrophic losses during Winter Storm Uri.
Oh, absolutely.
If a U.S. desk operates under a lazy mandate that simply permits trading, quote, U.S. natural gas, unquote, without actually enumerating the specific delivery points, it implicitly allows traders to play in highly illiquid, obscure regional points.
And under the stress of a massive freeze-off like Uri, The pricing behavior of those obscure points disconnects violently from the benchmark Henry Hub. A broad U.S. mandate isn't agile, it's a structural vulnerability.
You must enumerate the specific points.
Always.
To solidify how these governance failures actually play out, the chapter walks us through two constructed composite case studies. And we should note clearly for anyone listening that both of these are teaching composites.
Right. They reflect broad industry patterns and regulatory observations from Durga Analytics. They are not descriptions of any specific identifiable firms.
Right. So let's start with the European case, which is a total masterclass in the dangers of vague mandate language. We have a desk with a mandate that permits trading European gas hubs and related hedging instruments.
Those last four words, related hedging instruments, that becomes a massive loophole.
Yeah. So the desk finds itself long 400,000 megawatt hours of physical gas. They decide to hedge it using a German power contract, arguing that because gas is burned to make power the spark spread, it counts as related.
Which is a stretch, but okay.
Right. But then later, they hedge a storage position using EUA carbon allowances.
And here is the danger. Neither power nor carbon are in the risk model's calibration set for this specific gas desk. The desk's systems don't understand the volatility of carbon. Yeah, both of these new instruments are being booked at market value with zero independent price verification. So over time, the desk accumulates a massive cross-commodity book, all operating under the guise of a simple natural gas mandate.
And then the underlying physical fundamentals disconnect. Gas prices drop, which should theoretically be offset by their short power position. But power prices don't behave as expected, maybe due to alternative generation stepping in or some grid issues.
The correlation breaks.
Exactly. The desk had assumed a hedge ratio of 0.3 a year. In reality, the realized ratio during the market move was a dismal 0.08.
Ouch.
So the unhedged gas loss would have been 1.64 million euros. The so-called hedge in power only gained back 312,000 euros. That leaves a net loss of over 1.3 million euros. The hedge effectiveness was a mere 19%.
It is a devastating bleed of capital.
But let me play devil's advocate for a second here. A 19% hedge effectiveness is obviously poor. But we've seen worse in this course, like the 3.6% hedge effectiveness from the Winter Storm Uri composite in Chapter 1. So couldn't a trader argue they were somewhat vindicated here for at least dulling 19% of the pain? I mean, isn't some protection better than none?
No, it's actually much worse than having no protection because it creates a false sense of security.
Now,
A hedge functioning at a fraction of its assumed capability, while simultaneously tying up your precious allocated risk capital in margin, calls for the power and carbon positions that is a massive governance failure.
because of the margin call.
Right. The firm thought they were protected, so management didn't mandate other defensive actions. Vague language like related instruments authorized an entirely uncalibrated risk profile that consumed capital while failing to provide cover.
So the fix is strict enumeration. List the exact instruments permitted and require explicit documented approval for literally anything else.
Exactly.
That concept of consuming capital perfectly bridges into our second composite case study, which focuses on the U.S. market. If the European case was about vague language, the U.S. case is about allocating capital based on the totally wrong metrics.
Yeah, this U.S. desk made a structural error in how they rewarded performance. They allocated their capital annually based on trailing absolute P&L.
Meaning they just looked at the raw dollar amount each book made at the end of the year.
Yes. Let's look at how this compounds behaviorally. You have two books on the desk. Book A is a flat price book. It brings in a solid chunk of change in year one, about $8.2 million.
Okay, sounds good.
But it requires a massive amount of the firm's cash to hold those positions. It consumes $95 million in capital.
Wow, okay.
Right. And next to it, you have Book B, which is a basis book trading the price differences between locations. Book B makes slightly less raw profit, $5.9 million, but it uses a tiny fraction of the capital, only $28 million.
But because management is only looking at the absolute dollar signs.
Exactly. They reward the flat price book with even more capital for year two. The behavioral loop is set. In year two, the flat price book makes a bit more absolute money, consuming even more capital, while the highly efficient basis book is held flat.
And then market conditions change in year three.
Oh, they do. The flat price book suffers a massive loss of over $22 million, wiping out its previous gains while holding $160 million in capital.
And the basis book.
The basis book quietly churns out another steady $6 million.
When you zoom out over the 3 years, the tragedy of absolute P&L is just so obvious. Management essentially starved the highly efficient low-variance basis book, which maintained a 65.7% multi-year return.
Yep.
Instead, they continually funneled the firm's capital into the worst risk-adjusted book on the desk just because it had a higher raw dollar output initially. They rewarded the size of the outcome, rather than the quality and efficiency of the process.
And to avoid this trap, a desk must rely on ROAC return on allocated capital. This is really the only ratio that matters when comparing the performance of different trading books.
ROAC. So it's simply the return contribution divided by the capital allocated to generate that return.
Yeah.
It basically measures efficiency.
Right, and the text gives us another really powerful example of how to use ROAC. Imagine you are comparing an LNG arbitrage book generating a massive 30.7% ROAC against a U.S. flat price book generating only 4.7%.
The naive conclusion there, especially if you're a manager just staring at a spreadsheet, is to instantly drain all the capital from the flat price book and dump it into the LNG ARB book.
Naturally.
But if you have a junior analyst aggressively presenting a chart showing that 30.7% return and demanding more capital, how exactly do you test if their strategy scales without risking the firm's money?
You have to ruthlessly interrogate the assumption that returns scale linearly, because in physical gas, they rarely do. The text gives us 4 specific dangers to blindly reallocating that capital.
What's the first one?
The first is capacity constraints. That LNG arbitrage might only be available on 3 physical cargoes a quarter due to shipping bottlenecks.
So if you double their capital, you don't double the return.
Right, the extra capital just sits idle, which actually halves your ROAS.
Okay, what is the second danger?
Hidden correlation. What if your LNG ARB book and your European basis book both secretly depend on the exact same TTF to JKM price relationship? JKM being the Asian benchmark price.
Then you don't actually have 2 diversified, uncorrelated books. You basically have one massive, concentrated bet wearing 2 different hats. If that spread collapses, both books blow up simultaneously.
Exactly. The third danger is ignoring optionality and franchise value. That low-returning U.S. flat price book. It might be executing a high volume of flow trades that keeps the desk incredibly close to the market.
So they are generating the crucial real-time intelligence that allows the other books to be so profitable in the first place. You kill the flat price book, you lose the information flow.
Yes. And the fourth danger is sample survivorship. 1 year of a 30% ROAC is not evidence of enduring trader skill. It might just be a highly favorable, volatile market regime that won't repeat for another decade.
Which is why you must evaluate ROAC on a multi-year rolling basis before making drastic capital reallocations.
Spot on.
We've covered a lot of the mechanics and the common failures here. Let's transition to the practical, hands-on portion of the chapter, because the program always provides an applied build exercise.
Yes, the build it yourself section.
How do you actually implement these concepts on your desk tomorrow? Today, we're building a ROAC and drift dashboard.
This is where governance transforms from a dusty PDF policy into a visible daily operational tool. To build this dashboard, you need 4 specific inputs from your ETRM and finance systems.
Okay, what are they?
You need your position data grouped by book, the allocated capital by book, the realized P&L, and crucially, your mandate document fully parsed into specific permitted products, tenors, points, and sizes.
And with those inputs, the dashboard generates 3 vital outputs for the desk. First, you get a ranked ROAC table using a 12-month rolling series to smooth out the noise of a single lucky quarter.
Right.
Second, you get a composition drift chart showing the exact share of risk by market and product over time, so you can clearly see if a book is slowly migrating its focus.
And the third output is really the most critical one, the exception list. This automatically flags any open position that cannot be mapped directly to a specific clause in your parsed mandate.
The ultimate test of this dashboard is a great exercise. You inject a synthetic, completely fake delivery point into your system data.
Yes.
If that fake trade doesn't immediately flash in bright red on your exception list the next morning, your mandate parsing is way too loose and your controls are failing. For anyone listening, this is exactly the kind of structural governance thinking that elevates you from a back-office reporting role to a future desk head. It is a killer interview artifact.
It proves you understand that risk management isn't just about calculating VAR, it's about enforcing structural discipline across the entire portfolio.
Let's synthesize the core lessons here for you. The professional gas trader or risk manager. First, a mandate is a boundary that must constrain all 4 axes simultaneously: product, tenor, size, and market.
Second, mandate drift is a silent killer. You monitor it by tracking portfolio composition, not just waiting for hard limit breaches.
Third, European and U.S. markets require fundamentally different compliance language. because their physical bottlenecks and regulatory frameworks differ. You cannot copy and paste.
And fourth, capital must be allocated based on a multi-year return on allocated capital, never on raw absolute P&L.
Which perfectly positions us for what comes next. In Module 1, Chapter 6, the program shifts to when not to trade gas.
Because while Chapter 5 builds the boundary of what is legally and technically permitted, Chapter 6 is going to teach you how to decide if a permitted trade is actually a good idea.
Right. A mandate can't make that decision for you. It just keeps you in the game long enough to make it. But as you head back to your desks today, I want to leave you with a final thought to mull over regarding the realities of desk culture.
Oh, this is a good one.
We've talked extensively about how to spot mandate drift using data and dashboards. But ask yourself this. What happens to a trading desk's culture and its ultimate survival when the desk head, the very person responsible for catching composition drift, is having their own year-end bonus driven by the uncalibrated, out-of-mandate risks their juniors are quietly taking? Keep an eye on your boundaries, and we'll see you for the next deep dive.
Have you ever asked yourself a really fundamental question about your daily work? Something along the lines of, just because you can do something, does it actually mean you should?
Oh, absolutely. And that single question, it trips up a staggering number of, highly intelligent people, especially in environments where the stakes and the stress are just perpetually high.
Right. And today, we're looking at this specifically through the lens of a natural gas trading desk. Because in that high-pressure world, a trading mandate is merely a boundary, isn't it?
Yeah, exactly. It tells a trader what they are technically allowed to do. It is absolutely not a recommendation of what they should do.
Which is wild to think about.
It is. Honestly, the hardest discipline for any trader to master is learning when the absolute most correct action to take is to just sit on their hands and do nothing at all.
Which is so counterintuitive for someone who's spent, their entire educational and professional life being rewarded for taking action.
Exactly. As a consultant with Durga Analytics, I see this dynamic play out constantly across both European and North American markets. You build a trading desk, you train the analysts and originators, you give them all these sophisticated tools.
And they just want to use them.
Right. Their default instinct is to constantly push buttons and make trades.
So to give you some context on where we are today, we're diving deep into Chapter 6. It's titled When Not to Trade Gas, and it's from the Natural Gas Trading Desk Master Program.
Which is such a vital chapter.
There really is. And just a quick reminder, this program is a massive 120-chapter curriculum. It spans 9 modules, covering literally everything from what a gas desk is actually accountable for, straight through to market structure.
Yeah, and then into senior trading playbooks, valuation, risk, execution.
ETRM systems, regulation, all the way to desk leadership. Yeah. But right now, we were still in Module 1, so we're zeroing in on a very specific moment, right? The exact seconds before a trader hits. Yeah. Execute.
Laying that groundwork is critical. Before we get into complex curve construction or quantitative playbooks later in the course, we really have to establish this fundamental discipline of restraint.
So the mission for our deep dive today is to equip you with a structured pre-trade veto sequence. We're going to explore the mathematical reality of sizing your trades for an exit.
And hopefully help you build the operational maturity to recognize when holding cash is actually the best active position you have available.
Let's start with that psychological hurdle of doing nothing that we just mentioned. Because if you tell a desk full of ambitious traders to just stand down, they usually interpret that as passivity, right?
Oh, 100%. It sounds like a personality trait to them. And, you cannot manage a risk book based on personality traits.
So how do you reframe it?
Yeah.
How do you get a hyper-competitive trader to actually buy into this concept?
You have to establish not trading as an active, mathematically backed position. You're making a calculated decision that the risk-adjusted return currently available out there in the market is objectively worse than the risk-adjusted return of simply holding cash.
Ah, I see.
Yeah.
A trading desk understands direct mathematical comparisons.
Exactly. When you frame cash as an active position, it changes the entire conversation on the desk.
Cash is a position. I love that. So to figure out when to take that cash position, the material outlines 5 pre-trade vetoes. Let's look at this dynamically.
Sure.
Say a trader is staring at their screens, and they see a really wide bid-offer spread. There is absolutely no news driving it, the market's totally quiet, but a counterparty is suddenly super eager to transact massive size with them. What is the framework telling the trader to do?
Okay, so that specific scenario triggers the information asymmetry veto?
Information asymmetry.
Right. In natural gas, if someone is aggressively crossing a wide spread just to trade with you, and you can't explain why based on public fundamentals or weather forecasts, you are probably the target of someone who knows something you don't.
So it's not a lucky break.
No, an unexplained eagerness to trade big size is a warning siren. It is not a sudden opportunity.
Got it. So you veto the trade and step back.
Okay.
But what if the setup looks entirely normal, but the proposed position size is massive relative to the specific pipeline or hub they are trading at?
Then we hit the exit cost veto. The core question the desk must answer here is whether they can exit the position in one day at a known cost.
Because if you can't,
If you are too big for the local liquidity, you're just trapping yourself in a corner. You might get into the trade easily, but you'll only be able to exit at a severe punishing discount.
and we are definitely going to get into the terrifying math of that trap shortly.
Mm-hmm.
There's also a veto regarding rules and regulations, right?
Yes, the rule dependency veto. Like, if the profitability of a trade requires a specific market rule or a pipeline capacity tariff to stay exactly as it is, that sounds like a major red flag.
Because it is. You are effectively holding an unhedgeable short option on regulatory change.
Right.
You're basically betting that a bureaucracy won't act, and bureaucracies are notoriously unpredictable.
Yeah, that's a bet I wouldn't want to take. Then there's the sizing veto. The test here is whether the trader would still hold the exact same trade at 3 times the size. If the answer is no, what does that reveal?
Well, it reveals that the current size is based purely on the trader's personal emotional comfort level. It's not a genuine mathematical assessment of the market risk.
Which is bad for the desk overall.
It scales terribly across a desk. It means the trader is guessing, not deciding based on robust analytics.
Makes sense. And the final veto is operational capability. Basically, can the operations team physically perform if the trade goes all the way to physical delivery? Right. A theoretical financial option is only worth its value if your desk can actually exercise it in the physical world. If you lack the overnight schedulers or the specific pipeline access to move the physical gas molecules.
The paper profit is just a mirage.
Exactly. The paper profit on your screen is a total illusion.
You know, this whole sequence reminds me of an airplane pre-flight checklist.
Hmm.
When a pilot is sitting on the tarmac, running through the list, it's decidedly not a weighted scorecard.
No, not at all.
You can't say, well, the left engine is literally on fire, but the tray tables are securely stowed and the coffee is hot, so we've got a passing score, let's fly.
That is the perfect analogy for how risk frameworks fail. Weighting a checklist invites a trader to offset a hard no with a couple of soft yeses. That is exactly how trading desks inevitably blow up.
Wow.
Any single no on these 5 vetoes means you stand down, period.
Okay, let's test that rule dependency veto with a European worked example from the course.
Let's do it.
Imagine you're on a European desk and you're offered a structured deal at a specific hub. The volume is 180,000 megawatt hours. Under the current tariff structure, the margin is 1.85 euros per megawatt hour. So the expected value is a beautiful 333,000 euros.
I mean, it looks like an easy win on paper. That's the kind of trade an originator would be very eager to book.
But the economics completely depend on a capacity tariff structure that is currently under regulatory consultation. We have to price that dependency. If the rule changes to what the regulators are proposing, that margin flips to negative 0.95 euros.
Ouch.
Yeah. Suddenly, the value of the trade is negative 171,000 euros. That is a 504,000 euro swing, based entirely on a bureaucratic decision.
Which brings up the crucial question of how a professional desk handles a binary risk exactly like that.
Well, let me push back analytically here, because I know exactly what an aggressive trader would argue.
Oh, I've heard it many times. What's the argument?
They'd look at the political landscape and say, look, our analysis shows there is only a 25% chance of that rule actually changing. The math still works. We have a 75% probability of making 333,000 plus a 25% probability of losing 171,000.
Right, calculating the EV.
Exactly. That still gives us a positive expected value of 207,000 euros. Why on earth would I not take a mathematically favorable bet?
It is a completely rational question, and honestly, it's exactly how entry-level analysts are taught to think. But here is why a positive expected value is not sufficient for a survival-focused desk.
Okay.
Because that regulatory dependency acts as an unhedgeable short option. Risk management, the entire foundation of a trading desk, relies on your ability to adjust after entry.
Meaning, if the world changes, I need to be able to dynamically change my position to protect my capital.
Precisely. If that regulatory consultation goes against you, what is your action? There's no financial instrument you can buy in an exchange to hedge a tariff consultation, and your counterparty is certainly not going to graciously unwind the trade at par once the new rule is published.
Right. They're going to hold you to it.
So, an unhedgeable position with a positive EV is still a bet you cannot manage once you are in it.
What is the professional move then? Do you just walk away and leave 333,000 euros on the table?
You either decline the trade entirely, or if your mandate allows it and you really want it, you book it explicitly against a dedicated regulatory exposure sublimit. You size it knowing you might eat the full 504,000 euro swing.
But never as standard margin.
Never. You never book it as a standard margin trade alongside your normal hedgeable business. The moment you mix unmanageable risk with manageable risk, you lose control of your desk's survival.
That distinction between manageable and unmanageable risk is huge. Let's shift our focus to the exit cost veto. We have a North American example for this one that focuses heavily on liquidity.
Yes, liquidity is a killer in regional U.S. markets.
So we're looking at a U.S. regional point, and there is a really attractive basis relationship. The trader proposes a position size of 420,000 MNMP2. But we have to look at the average daily volume, the ADV at that specific point, which is only 310,000 MME2.
Right, so immediately, the proposed position is 1.35 times the entire average daily volume of that market.
The course introduces this metric called days to exit. If you want to exit a trade without totally tanking the market price against yourself, you can really only participate in a modest share of the daily volume.
The course assumes a 25% participation rate, yeah.
Right, so 420,000 divided by a quarter of the daily volume. Do the math, that means it would take 5.4 days just to exit this trade.
Which is an absolute eternity in natural gas markets. I mean, physical dynamics change by the hour.
So true. Now compare that 5.4 days to a highly liquid benchmark like Henry Hub. If you have the exact same position size there, but the ADV is maybe 1.2 million, you're out in 1.4 days.
Very manageable.
But back at our thin regional point, it takes over a work week. If you are forced to exit and you suffer a slippage of just $0.28 per MMB2, you have lost $117,600 just to get out of the position.
And that calculation assumes an orderly exit. It doesn't even factor in a panicked market where everyone else is also aggressively trying to sell at the exact same time.
It's like trying to leave a crowded stadium after a concert. If you parked yourself right by the exit doors, you slip out smoothly. But if you placed yourself dead center in the middle of a mosh pit and suddenly you need to leave quickly, getting out is going to be incredibly painful and you're going to get bruised.
That visualization perfectly captures the brutal mechanics of market liquidity. The golden rule the course provides for this exact scenario is profound, really. The answer is not to abandon the trade entirely. The answer is, do not size your trade to your conviction, size it to the exit.
Size it to the exit. That fundamentally changes how you view position building.
It does. If you reduce that proposed position from 420,000 down to 150,000 MMB2, your days to exit drops under 2 days. You preserve the core thesis of the trade. You still capture the opportunity, but you eliminate the risk of catastrophic slippage if you need to bail. Sizing to the exit is a hallmark of a really mature trading operation.
Okay, so those vetoes stop us from getting into a bad trade in the first place. But what happens if we're already in a good trade and the world changes around us? Does this system have a mechanism for pulling the ripcord and reducing our overall gross exposure?
It does, yeah. There are 5 specific conditions where a desk must actively get smaller rather than just tweaking their hedges. The first is a correlation breakdown.
Meaning the mathematical relationships between different gas hubs or different time periods stop working the way they historically do.
Yes. If the relationships your entire book relies on stop holding true, you reduce gross exposure. You don't try to build a new, untested hedge out of broken relationships.
That makes sense. What's the second?
The second condition is an infrastructure failure. If a compressor station goes down or a pipeline blows up, physical reality is suddenly moving much faster than the pricing curves. You have to reduce positions built on the old physical reality before you try to optimize for the new one.
Physics always beats paper in commodity markets. The third condition is model disagreement. If a desk's complex pricing model and the actual market are disagreeing materially, and the quants can't explain why, What usually happens?
Human nature takes over. Traders and analysts often assume the market is temporarily irrational and their highly tuned model is right. But the honest professional reading is that the model is missing a critical variable. When that happens, you reduce your size until you identify exactly what you are missing.
The fourth condition is one I bet people hate admitting: personnel gaps.
Oh, absolutely.
Like, if your key staff are on vacation or sick during a period of wild volatility, you have a genuine reason to run a smaller book. Desks rarely say this out loud because it feels like admitting weakness, right?
Right.
But it's a massive hidden risk.
It's huge, and the desks that survive the long term act on it. Managing risk requires human capital. The final condition is after a large financial loss. Judgment degrades measurably after a significant hit. The psychological desire to win it back causes traders to take on more risk, not less.
So management has to step in.
The operational response here cannot be a discretionary choice left to the trader. It must be a mandatory size reduction enforced systematically by the desk's management.
And to actually enforce all of this philosophy, the course walks you through an applied build. You're instructed to build a specific tool inside your ETRM, your energy trading and risk management system. It's a pre-trade veto checklist with liquidity sizing built right into the software architecture.
This is where theory becomes actual practice. You input the proposed size, the point's ADV.
The expected profit assumes slippage.
Exactly. And you flag any regulatory dependencies. The system then computes your multiple of ADV, your days to exit, and mathematically spits out a recommended maximum size that keeps your exit under a 2-day default.
It turns philosophy into hard binding code. It also adds the 5 vetoes as explicit yes or no software checks. And if a trader wants to override a veto, they have to type in a free text justification.
Which is brilliant.
What fascinates me about this is the override log it generates. That log becomes the ultimate data set. It proves whether a trading desk's risk culture actually binds them, or if it's just, corporate theater where traders rubber stamp overrides all day long.
Oh, if you are auditing a desk or evaluating its long-term viability, that override log is the very first thing you want to pull. It shows you exactly how the desk behaves under pressure, independent of what their glossy risk manuals say.
Let's cement these lessons by looking at 2 catastrophic failures provided in the text. And just to be clear with everyone listening, both of these are composite case studies. They are drawn from public market monitoring and regulatory findings, so they represent real failure mechanisms, but they aren't describing any specific identifiable firms.
Right, they're archetypes of failure.
Let's start with the European case study, the trade nobody could exit.
Okay, so a desk builds a position at a peripheral European hub. The thesis is completely sound. It's a convergence trade, betting that a historically wide spread will eventually narrow back to normal.
The local liquidity is thin, but adequate for normal days. The traders size the position based on their high conviction and their VAR limit. To quickly clarify for you, VAR is value at risk, a metric that effectively caps their maximum theoretical daily loss under normal statistical conditions.
So they buy 240,000 megawatt hours, completely ignoring the specific liquidity constraints of that peripheral hub.
And then severe market stress hits.
As it always does.
As always happens, liquidity at peripheral points evaporates first as participants flee to safety. The ADV drops from 95,000 down to just 28,000. Suddenly, without the desk trading a single additional lot, their position balloons to 8.6 times the stress daily volume.
And remember our 25% participation rate for safely exiting a trade. They are now trapped in a 34-day exit scenario.
34 days. Their margin requirements are skyrocketing to cover the position, and they literally cannot reduce their exposure without moving the price aggressively against themselves.
So what happens?
They are forced to exit at a massive loss just to free up capital. The slippage alone cost them 396,000 euros. And the kicker: the market subsequently converged exactly as they originally predicted.
This is a classic lesson in market mechanics. The fundamental thesis was right, but the sizing was entirely wrong. And being right and insolvent is indistinguishable from being wrong. Liquidity is not a constant.
Really isn't.
The rule of thumb here is you must always size your trades to stressed liquidity, not normal liquidity. You have to assume liquidity will fall by 2/3 in the exact conditions that will make you desperately want to exit.
Being right and insolvent is indistinguishable from being wrong. That is brutal, but necessary. Let's cross the Atlantic for the U.S. case study. This one is about the capability veto being completely ignored.
Ah, yes. The operational miss.
A desk is offered a physically demanding supply arrangement with massive margins during a severe cold weather forecast.
It is roughly 4 times their normal basis margin, the typical profit they make on the price difference between two physical locations. It looks incredibly lucrative.
But the desk has no operational scheduling capability overnight. This specific arrangement requires an intraday renomination, adjusting the physical flow of gas with the pipeline during a cold event. So the capability veto fails.
Mhm.
But the trader looks at that massive margin, assumes the counterparty is reliable, and hopes the weather forecast is slightly exaggerated. They do the trade anyway.
And the severe weather forecast materialized.
Of course it does.
Yes, yeah.
At 2:20 a.m., a renomination is required by the pipeline. The desk has no overnight scheduler. Nobody is there to handle it.
Physical reality and pipeline pressures do not wait for standard business hours.
Nope. They missed the renomination. The expected margin was supposed to be $84,600. But because nobody was at the wheel, they were hit with steep pipeline penalties and had to buy replacement gas at exorbitant destination prices to balance their physical position.
Ouch. What was the damage?
The net outcome was a loss of $526,400. That is a loss 6.2 times larger than their entire expected profit.
Which perfectly illustrates two vital concepts. First, unusually attractive margins in natural gas are almost always just payment for taking on a risk that someone smarter or better equipped declined to take.
That's a great point. And the second,
Second, the veto sequence is not a weighted score. 4 vetoes passing does not offset 1 failing. They had the mandate, the sizing was fine, but they lacked the operational capability.
the mandate permitted the trade, but as we said at the start, permission is not advice.
It never is.
So to distill all this down for you, a trading mandate is a boundary. It's not a recommendation. You must size your trades to your exit, assuming stressed liquidity conditions, never just to your conviction. And you have to recognize that an unhedgeable regulatory dependency cannot be managed post-entry. It is a toxic short option.
This sets us up perfectly for where the course goes next, actually. Chapter 7 distinguishes between speculative points and flow control points. The vetoes we learned today are vital for a speculative desk where the danger is at entry. But for a flow desk, the dangerous ground shifts entirely. The true risk for them lies after execution rather than before it.
I can't wait to get into that. But before we go, I want to leave you with a final lingering thought to apply to your own work today. Take a close look at your own most profitable strategies right now. Are they genuinely generating alpha because of your unique insight? Or are you secretly holding a hidden, unhedgeable short option on a rule or a relationship that simply hasn't broken yet?
So if you were hired to design a security system for a massive underground bank vault, you know exactly what to do, right? You install 3-foot solid steel doors, thermal imaging, laser tripwires, the whole 9 yards.
Right, you build the absolute heaviest controls right there at the entrance before anyone even gets inside.
Exactly. But imagine your very next job is designing a security system for a busy metropolitan subway station during morning rush hour.
Oh, wow. Yeah, that is a completely different operational reality.
It is. Because if you put retina scanners and 3-foot steel doors at every single turnstile, the station just completely stops functioning.
I mean, commuters would riot.
Right.
The fundamental business of moving people completely dies.
Right. Welcome to another deep dive. Today, we are bringing you straight onto the trading floor to look at how massive energy trading desks completely misunderstand this exact security concept.
It happens all the time.
It really does. To unpack this, we are stepping into the mindset of a natural gas trading and risk management consultant from Durga Analytics. Someone with decades of experience trading physical and financial gas across European and North American markets.
Yeah, building desks, designing ETRM systems, and teaching traders and risk managers to actually survive in this business.
Exactly. And we are framing all of this around a massive educational journey, which is the Natural Gas Trading Desk Master Program.
Right, and just to give you some context on that program, it is a comprehensive sequence spanning 9 modules and 120 chapters.
It covers literally everything, right?
It really does. From what a desk is accountable for to the physical physics of pipelines, all the way through curve construction, execution, software systems, and ultimately desk leadership.
And for this deep dive, we are zeroing in on Module 1, which is all about running a gas trading desk. Specifically, we are exploring Chapter 7.
Yeah, Chapter 7, which is speculative versus flow control points. This actually builds directly on Chapter 6's pre-trade veto sequence.
Right. And our mission today is to figure out how to design controls that actually protect a trading desk's P&L without just suffocating its ability to operate.
We are going to look at real arithmetic, build a desk-ready control map, and explore why European and North American markets fail in completely different ways.
So let's break down the mechanics of this. We have two very different businesses that often sit back to back in the exact same trading room.
Yeah, the speculative desk and the flow desk.
Right. Help us understand the mechanical difference in how these two desks actually generate revenue.
Well, the fundamental distinction lies in their source of return. I mean, speculative trading relies entirely on being right about market direction, or maybe a price spread.
So they are taking a stance.
Exactly. The trader takes a position and holds it deliberately, waiting for the market to move in their favor. Flow trading, on the other hand, earns a very, very thin margin by intermediating massive volumes of gas between counterparties.
Like buying from a producer and instantly selling to a utility.
Right, exactly. If a flow desk holds a position, it is held incidentally. It's usually just a temporary residual of trying to match up those massive volumes.
When you look at the desk data from your consulting work, the math really highlights this divide, doesn't it?
Oh, absolutely. Let's walk through the numbers for a typical mixed desk. We could look at a standard monthly performance report.
Okay, let's hear the real numbers.
So the speculative book might trade 180,000 MMB2, which is million British thermal units, the standard North American volume metric.
Got it.
That volume generates $1.45 million in profit, which breaks down to a massive margin of roughly $8.06 per unit.
Wow, over $8 a unit.
Yeah. But then you look at the flow book. The flow book trades 2.4 million MMB2.
So that's, what, over 13 times the physical volume?
Exactly. But it only generates $890,000 in profit. That is a unit margin of just 37 cents.
Man, it paints such a clear picture. The speculative trader is essentially a big game hunter. You know, low volume, massive patience, but a huge payout every time they pull the trigger.
Right. And the flow trader is more like a toll booth operator. They are making literal pennies per car, but the traffic is relentless.
But here is a common trap, and it's one I imagine a lot of people listening might fall into.
Let's hear it.
Well, if the market looks at that unit margin, $8 versus 37 cents, doesn't the consensus assume the speculative book is just, I don't know, a structurally superior business? Like 20 times better?
It is a very common trap, yeah.
Yeah.
Most people look at that high speculative profit per unit and just assume it's the golden goose.
Right, it seems obvious.
But they are completely missing the mechanics of variance. That $8 margin is simply compensation for massive variance and for deliberately holding capital at extreme risk.
I see.
You cannot evaluate it on a per unit basis. The mathematically correct comparison is return on allocated capital, or ROACE, calculated over a multi-year rolling series.
So the metric isn't just what you made, it's what you had to risk to make it.
Precisely. And the flow margin is thin by design. Its return comes from high-frequency repetition. Furthermore, intermediating all that volume generates immense market information.
Because you're seeing everything happen in real time.
Exactly. That constant flow of deals tells you where the market actually is at any given second. We call that the franchise value. Flow has much lower variance. So on a risk-adjusted basis, flow can often be the much better business.
Okay, so this massive difference in how these desks make money dictates exactly where you need to place your security cameras, so to speak.
Yeah, this brings us to the concept of control density. Figure 7.1 in the chapter maps this out perfectly.
And the governing rule here goes right back to our intro analogy, doesn't it?
It does. Speculative desks need the heaviest controls before the trade happens, while flow desks need the heaviest controls after the trade happens.
The bank vault doors versus the subway turnstiles.
Right. For a speculative desk, the primary risk is that a single massive decision is fundamentally wrong. So you build heavy pre-trade density.
Like what? Strict mandates.
Yeah. Strict mandates, hard capital limits, and rigorous management veto sequences before the trader can even execute.
But for a flow desk, that doesn't work.
No, because the risk isn't a single directional view. The risk is that thousands of routine operations are executed slightly incorrectly at a massive scale.
So your density must sit post-trade.
Exactly. At the points of deal capture, position refresh, and physical settlement. Let's run the arithmetic on why those thin flow margins demand such heavy post-trade scrutiny.
Yeah, let's go back to the toll booth operator.
If you are only capturing 37 cents per MMB2 on the flow desk, consider the impact if your deal capture software has a tiny systematic glitch of just 2 cents per unit.
I mean, 2 cents feels like a rounding error. It feels completely insignificant.
It feels insignificant until you apply it to 2.4 million MMB2. That 2-cent error destroys $48,000.
Wait, really? Just from 2 cents?
Yep. That is 5.4% of the entire flowbook's profit, wiped out by a single microscopic capture error.
Oh, wow.
Now, apply that identical 2-cent error to the speculative book, which traded a fraction of the volume. It cost them $3,600, which is barely 0.25% of their profit.
So thin margin flow businesses aren't destroyed by spectacular Hollywood-style rogue trader blow-ups. They just bleed to death from 1,000 paper cuts.
Exactly. Therefore, post-trade controls, the daily reconciliations, the automated settlement matching, those are your tourniquets.
And applying the wrong control profile creates a massive structural vulnerability.
It really does. The master program provides 2 composite case studies to illustrate this, starting with the European market.
Which perfectly demonstrates what happens when controls actively stifle flow. Let's dive into that scenario.
So we're looking at a composite case study of a flow desk intermediating across major European virtual trading points, like the TTF in the Netherlands and the UAD in Germany.
Okay, and management makes a classic architectural mistake here.
They do. They take the control framework from their speculative book, the heavy bank vault doors, and they just bolt it onto the flow book.
Which creates an immediate operational bottleneck.
Right. Suddenly, any trade above a very modest volume requires pre-trade management approval. But if you are intermediating flow, speed is your primary competitive advantage.
The market is moving in milliseconds.
Exactly. If a trader has to pause for a manager to click approve on a standard flow transaction, the price moves and the deal is gone. The control architecture is literally suffocating the business model.
So to survive and actually generate revenue, the traders adapt. They begin deliberately splitting large flow trades into smaller sub-threshold pieces just to bypass the approval limit.
Yeah, they break a big trade into 5 little ones so the system doesn't flag them.
Now, if you are listening to this and mapping out your own compliance rules, you might think, wait, isn't deliberately splitting trades to bypass limits a massive conduct violation? Shouldn't these people be fired?
It's a natural question. But as a consultant coming in to evaluate a desk's health from Durga Analytics, I look at that entirely differently.
How so?
Well, assuming there is no active concealment, meaning the traders aren't hiding the split trades from the risk system's trade splitting, is a diagnostic signal of bad control design, not a conduct issue.
So it's a symptom, not the disease.
Exactly. When an entire desk systematically works around a control just to function, the control is miscalibrated for the business model.
The system is fundamentally broken, so the operators are basically creating their own patches.
Right. But because management forced these heavy pre-trade controls onto the flow desk, they entirely neglected the post-trade environment. The speculative book never needed heavy post-trade controls, so management didn't build them for the flow book.
Which led to severe deal capture drift.
Yes. In a modern energy desk, your ETRM, your energy trading and risk management software, needs to pull the exact execution price instantly via an automated API.
But they didn't have that.
No. Because they didn't invest in this post-trade density, traders were manually keying in prices from memory at the end of the day, or just using a daily average.
And the mechanics of that failure are just brutal. Because those post-trade reconciliations were weak, a systematic capture error of just 0.035 euros per megawatt hour crept into their German hub trading.
And it was completely invisible. It went undetected for 9 months.
Wait, run the math on that. Across 9 months, how much volume are we talking?
Across 4.1 million megawatt hours.
No.
So they leaked 143,500 euros.
Wow, over 11% of the book's entire margin just vanished into thin air.
And no single error ever exceeded an alarm threshold. The entire loss was composed of amounts deemed too small to investigate.
So what's the structural fix here?
The fix requires shifting the control density to the right. Management must remove those pre-trade thresholds for the flow desk and institute automated execution time price capture.
Integrated directly into the ETRM.
Right, and backed by independent end-of-day reasonability checks.
Okay, so pre-trade limits suffocate European flow desks because speed is their main advantage. But let's shift geographies to North America, because the trap there isn't just about speed, is it?
No, it's buried in the physical plumbing of the pipelines themselves. The North American composite case study highlights completely different failure modes, which is a crucial contrast in the curriculum.
Right, because North American gas markets operate on highly complex entry-exit physical systems.
Natural gas isn't just a financial number on a screen. It is highly pressurized methane moving through thousands of miles of physical steel tubes.
And two mechanical realities really dominate U.S. flow desks, right? Operational flow orders, known as OFOs, and capacity utilization.
Yes, and the utilization mechanics are staggering once you unpack them. If a desk buys firm transport capacity on a U.S. pipeline, they pay a reservation charge.
Meaning they pay for that space whether they put gas in the pipe or not.
Exactly. Let's run the daily arithmetic. Say a desk reserves 40,000 MMBtu of capacity a day for a 31-day month.
Okay, so that is 1.24 million MMB2 reserved.
Right. And let's say they reserve it at 21 cents a unit. The desk is paying $260,400 to the pipeline no matter what.
But operationally, matching that perfectly every single day is impossible.
Completely impossible. Let's say the desk only actually schedules 980,000 MMBtu of gas for the month. They only utilize 79% of the capacity they paid for.
So that 21% underutilization, it doesn't just vanish, does it?
No, it acts as a massive invisible tax on their trading. It effectively raises their true transport cost by over 5.5 cents per unit.
And when your total flow margin is only 37 cents to begin with.
Exactly. That desk just forfeited 15% of their entire book's margin to a post-trade metric they weren't even tracking. They lack the control to reconcile scheduled physical volume against reserved financial capacity.
Which feeds directly into the U.S. composite case study, the mixed desk trap.
Yeah, this is a dangerous one. We have a trading desk running both flow and speculative activity, but the two are not rigorously separated.
And because of those pipeline realities, specifically the operational flow orders, the desk is terrified of pipeline penalties.
Right, because if a pipeline loses physical pressure, cities lose heating. So pipelines issue OFOs, which force shippers to perfectly balance what they inject with what they withdraw.
The financial penalties for violating an OFO are just draconian.
They are. So to avoid these penalties, flow desks constantly adjust their physical schedules, which naturally leaves tiny little daily residuals.
Imperfect matches between the buy and sell legs, usually under 5,000 MMB2.
Right. Individually, they are trivial.
But the desk had no post-trade process to sweep them up, and this introduces one of the most dangerous myths in energy trading.
The narrative that a book is flat by construction.
Right. The risk system was accurately calculating the flow book's net position every single evening. But nobody bothered to look at the dashboard.
Because the internal story was, oh, it's a flow book, it's flat by construction, it doesn't hold directional risk.
Internal descriptions are not controls.
No, they are not. This is a classic zero-decide owner failure. Because no specific individual was accountable for monitoring that dashboard, those trivial daily residuals silently accumulated over 4 months.
Think of this like sweeping dust under a rug every single day because you don't have a dustpan. Eventually, you trip over the lump and break your neck.
That is exactly what happened. They compounded into a massive net long position of 265,000 MMB2, concentrated at two highly volatile regional pricing points.
Like a tiny, undetected leak in a highly pressurized pipe. For months, it just looks like a bit of condensation on the steel. Nobody worries about it.
But the pressure is accumulating, and eventually the structural integrity fails, and the whole system blows apart. The blow-up was inevitable.
What was the trigger?
A regional basis move of $1.85 went against their accumulated position. The resulting loss was $490,250.
Good grief. They wiped out 55.1% of their annual flow margin in a matter of days.
More than half a year of grinding out pennies, completely destroyed.
And the ultimate tragedy is that this massive loss came from a position that no trading mandate ever authorized.
Exactly. No speculative trader ever consciously chose to hold it, and no risk limit ever constrained it. It was entirely unowned risk.
So how do you fix this on a mixed U.S. desk? What's the tourniquet?
The tourniquet requires a specific operational mechanism, the daily residual sweep. You mandate that the ETRM calculates the absolute net position by physical point every single day.
And you establish a hard volumetric threshold.
Right. If the residual drifts above that threshold, you force the desk to make a binary choice. Either flatten position immediately in the physical market or explicitly transfer it to the speculative book.
And a transfer requires full management authorization and a dedicated capital allocation.
Yes. What must absolutely never happen is allowing the position to sit in the dark, unowned and unmonitored.
To bring this out of the theoretical and onto your actual desk, the chapter includes a desk-ready applied build.
Yeah, if you are listening to this and trying to land a job on a gas desk, or maybe trying to fix the one you are currently on, this is a highly recommended exercise to bring into an interview.
Walk us through how to build this control map.
This is where the theory translates into commercial reality. You begin by mapping the 6 stages of the trade life cycle.
Pre-trade, execution, capture, position, scheduling, and settlement.
Right, and for every separate book your desk runs, you map the controls that actually execute at each stage. You completely ignore the dusty compliance manuals. You map only what the software systems actively enforce today.
And the crucial step is the financial translation that follows, right?
Exactly. You compute the expected annual cost of a systematic one-tick error at every single stage, utilizing that volume arithmetic we discussed earlier.
So you calculate what a 1 cent or 2 cent drift would cost the flow book compared to the speculative book.
Yes.
I have to say that translation is brilliant. Management teams are notoriously unresponsive to abstract compliance gaps.
Oh, totally. If you walk into a meeting and say, our control density is misaligned, their eyes will just glaze over.
But if you present the math and say, our lack of automated ETRM price capture is currently exposing 11% of our annual flow margin to invisible leakage.
You suddenly have the budget approved for a software upgrade, translating risk into dollars forces action.
It really does.
And this build provides a vital litmus test. When you compute what a tiny 0.01 unit error costs each book annually, if the dollar cost to your flow book isn't materially larger than the cost to your speculative book, something in your architecture is deeply flawed.
So either your initial volume assumptions are entirely wrong,
Or your controls are fundamentally misaligned to your commercial business model. Executing this map proves to management that control design must follow the business model, never the reverse.
so we can distill the core lesson of Chapter 7 down to this. Applying speculative controls to a flow book guarantees uncompetitive trading and a desk that bleeds to death from unchecked post-trade errors.
Right. And conversely, applying flow controls to a speculative book ensures you will eventually accumulate massive directional risk that nobody authorized.
You must separate the books and apply the appropriate density. Heavy in the front for spec, heavy in the back for flow.
That structural alignment is the absolute foundation of survival. And now that we have established all the individual components from this first module, accountability, decision rights, mandates, the veto sequence, and today's control density, we are finally prepared for Chapter 8.
Oh, this is going to be good.
Next time, we assemble chapters 1 through 7 to answer one ultimate, terrifying question. How do gas desks actually fail?
Because in the real world of energy trading, a catastrophic failure is never just a single defect.
No, it is always a complex cascade.
That cascade is going to be fascinating to unpack. But before we get to Chapter 8, I want to leave you with a thought to apply to your own professional environment, whether you are trading physical natural gas or managing software development.
It applies everywhere.
It really does. Think back to that undetected leak in the pressurized pipe. Look closely at your own daily operations. What risks or operational drift are currently being ignored simply because they are casually described as flat by construction or not our primary risk?
What tiny residuals, those microscopic, unowned errors, are quietly compounding in your blind spots right now, just waiting for the pressure to break the system?
It is a question you absolutely must ask yourself before the market decides to ask it for you. Thanks for joining us on this deep dive. We will see you in Chapter 8.
You know, whenever pop culture tries to show us, like a catastrophic financial collapse at a trading firm, they always use the exact same Hollywood template.
Oh, yeah. Always. The sweating rogue trader.
Right, exactly. It's always this one single rogue trader. Sweat is just pouring down their face. They're staring at this, wall of blinking red monitors.
And they just click one button?
Yes. In a moment of pure panic, they make this one wild, unauthorized bet on the market direction. And it just brings the entire company down in seconds.
I mean, it makes for incredible cinema, I'll give it that.
It definitely wins awards.
Yeah, but it is almost entirely fiction when we talk about how a real commodities desk actually dies.
Wait, really? It's never just one bad bet?
No, I mean, being wrong about market direction is just not a fatal failure. That is a normal, fully budgeted cost of doing business. If you are going to trade natural gas, you're going to be wrong sometimes. That's just the job.
Okay, let's unpack this, because today we are taking you on a deep dive into what is basically the absolute gold standard of industry training. We're looking at the Natural Gas Trading Desk Master Program.
It's a fantastic program.
It really is. And for anyone navigating this space, this is a massive, carefully sequenced journey. I mean, it spans 9 modules, 120 chapters in total.
Taking you literally from market structure and physical pipelines all the way through to, ETRM systems and desk leadership.
Exactly. And our mission today is we're diving into Module 1, which is all about running a gas trading desk. And specifically, we're looking at Chapter 8, which has this very ominous title, How Gas Desks Actually Fail.
It's a great title. And it synthesizes basically everything from chapters 1 through 7 into this entirely new framework.
And to guide us through this, we have a natural gas trading and risk management consultant from Jurgen Analytics with us. You spent decades trading physical and financial gas, right?
Yeah, across both European and North American markets. I've built trading desks, designed the ETRM systems for them, and spent a lot of time teaching everyone from traders to risk managers how to actually survive in this market.
So with all that experience, when you see this chapter completely shatter that Hollywood myth of the rogue trader, what's the actual reality?
The reality is that real desk failures are never a single event. Never. They're always a mechanical sequence of structural defects.
Structural defects. So it's not a sudden explosion?
No, it's a slow-moving, latent process. The trader who ultimately clicks the button and loses the money, they're just the final domino to fall in a very, very long chain.
Okay, so it sounds less like, a rogue employee busting through a locked vault with dynamite and more like a series of unlocked doors in a bank vault.
That's a great analogy.
Like if even one door is locked, the robbers just can't get the money.
Exactly. Or you can think of it like the Swiss cheese model in aviation safety. The holes in the different layers of defense have to perfectly align for the disaster to strike. And the program lays out a very specific 6-link failure chain. Every major desk collapse follows this exact structural shape.
Let's walk through those dominoes then. What is the very first structural failure, link 1?
So link 1 is a vague mandate. The desk's rules of engagement permit a certain activity, but the boundaries are just, slightly too broad or undefined.
So they have permission, but it's blurry.
Right. Which leads to link 2, where the control profile is wrong for that activity.
Meaning what, exactly?
Well, say the business model drifts into a new area, like trading a new geographical region, but the risk controls and the software systems don't update to match it. They're still using the old controls for the new trade.
Got it. Okay, so that's 2 links. What's the third?
Link 3 is ambiguous decision rights. When something weird happens, nobody knows exactly who holds the ultimate authority to halt the activity.
Oh, I see. So everybody just assumes someone else is monitoring it.
Exactly. Oh, the risk guy is watching that. Oh, the desk head has it, and nobody actually pulls the plug.
I am noticing a pattern here. We are 3 links deep into this failure chain, and nobody has actually lost a single dollar yet. Everything is just entirely structural.
Yeah, the money hasn't moved yet. That brings us to link 4, which is where the financial risk really enters the picture. The position is size to conviction rather than to the exit.
Size to conviction. So, they really believe they're right.
Right. It's a classic behavioral trap. A trader has a strong market view of their convictions, so they build a massive position. But they do not size it based on the market's liquidity.
They don't check if they can actually get out.
Precisely. They don't calculate if they can exit that massive position without crashing the market if their thesis turns out to be wrong.
Which leaves the desk completely exposed for link 5, I'm guessing.
Right. Link 5 is the arrival of a stress event.
Like a market shock.
Yeah, a sudden cold snap, a pipeline explosion, a major geopolitical shock, something external.
And then the final domino.
Link 6. That external stress event converts all of those latent, invisible structural defects into a massive, realized financial loss. The desk just dies.
But wait, if this sequence is so mechanical, if all 6 links have to be present every single time, why do the industry postmortems almost always get it wrong? Like, you read the official reports after a blowout, and they inevitably point the finger at one specific person.
Mostly because human nature, and particularly corporate human nature, just demands a single root cause.
Right. Someone to fire.
Exactly. Investigators look at the financial wreckage, and they end up blaming the person standing nearest to the final link, which is usually the trader who is executing at the moment of stress.
But that trader was operating inside a structure that already had 5 catastrophic failures baked into it.
You've got it. But the positive takeaway here, the operational consequence that actually matters, is that because failure requires the entire chain to complete, breaking any single link prevents the loss.
So layered controls really do work.
They absolutely work. And the earliest links, like tightening a vague mandate, those are incredibly cheap to fix compared to the cost of a catastrophic blowout.
Okay, this raises a massive question for me, though.
Yeah.
If desk failures are just this predictable sequence of structural flaws, why don't our highly sophisticated, multi-million-dollar risk models catch them? I mean, every modern desk uses ETRM, right? Energy trading and risk management software.
Yeah, of course.
And they all run VAR, value at risk, which is basically supposed to be the gold standard of risk measurement. So why doesn't VAR see the holes in the Swiss cheese?
Ah, well, because standard risk measures like VAR are mathematically blind to how natural gas actually behaves in the physical world.
Blind, how so?
In traditional financial markets like equities or bonds, prices tend to gently drift up or down, but natural gas prices do not drift, they gap.
They gap, meaning they violently jump from one level to another.
Exactly.
Wait, why do they gap so violently? Is it just because it's a physical commodity you have to actually move?
That's the core of it. It comes down to the physical constraints of the grid. Pipeline and storage constraints bind nonlinearly. Look, you can push gas through a pipe up to 100% capacity with relatively stable pricing,
Okay.
but the very moment the market demands 101% of that pipe's capacity, the price doesn't just go up by 1%.
What does it do?
It goes to infinity.
Wow.
The gas physically cannot move. The pipe is full. And the statistical consequence of this physics is what risk managers call a fat left tail in the profit and loss distribution.
A fat tail. So meaning extreme catastrophic events happen way more often than a normal symmetrical bell curve would predict.
Right. A standard VAR number is usually calibrated on historical calm periods. It describes the middle of that bell curve perfectly. But here's the thing, the middle of the distribution does not matter. Desks do not die in the middle. They die in the fat left tail. And standard VAR completely fails to describe the magnitude of that tail.
Okay, I need to see the actual math on this.
Let's look at the arithmetic of the exception ratio. This really shows what it looks like on a real desk. Let's run the numbers.
Okay, so say a desk reports a 99% one-day VAR of 2.4 million euros. In plain English, the model predicts that 99% of the time, your worst daily loss will not exceed 2.4 million.
Got it.
So over a standard 250-day trading year, you would mathematically expect the actual loss to exceed your VAR on about 2.5 days. That's your expected exception count.
Okay, 2.5 days a year, you have a bad day that breaks the model. That honestly sounds like a pretty reasonable margin of error.
It sounds reasonable, sure, but the gas desk reality is far more brutal. In our example from the chapter, the desk actually observes 9 exceptions that year, not 2.5.
Oh.
So the exception ratio is 3.6 times what was expected. The model is wrong 3.6 times too often.
Yikes.
And we haven't even talked about the magnitude of the losses on those 9 days.
I have a feeling that 2.4 million euro limit didn't hold up.
Not even close.
Yeah.
On the worst day of the year, the actual loss was 11.8 million euros. That is 4.9 times the theoretical VAR limit. Okay, mathematically, if my model is telling me 2.4 million and I am losing almost 12 million, my model is fundamentally broken.
Yep.
My initial instinct here would be to go straight to the risk committee and say, hey, we need to raise our VAR limit to 12 million to reflect reality.
And that is a very common instinct, and it is absolutely the wrong move.
Really? Why?
Because if you have a model that is wrong 3.6 times too often and misses the magnitude by a multiple of almost 5, that model is not giving you a conservative approximation. It is giving you a false sense of a bounded downside. You do not fix a fundamentally blind model by just cranking up the limit number.
Oh, because doing that just gives me a much bigger blindfold. I'm still not actually seeing the risk.
You hit the nail on the head. The correct response is to supplement VR with intense scenario-based stress testing, which the program actually develops heavily in Module 5. You must stress test the physical constraints of the grid, like what actually happens when the pipe freezes, not just the statistical history of the price on a spreadsheet.
Okay, mathematically, I understand why VAR fails. But I want to see what this looks like when a real desk actually hits that fat tail in the physical world.
Well, the source material provides 2 really distinct case studies to show exactly that. One European, one North American.
Perfect. And I want to emphasize a quick sourcing note for you listeners. The program explicitly states that these are teaching composites. They are assembled from real structural patterns and public market governance findings, not descriptions of any one identifiable firm.
Right, they're composites to show the mechanics. Let's start with Europe. This is a case where the entire 6-link chain completed, and the desk took a massive hit.
Let's map it to the 6 links.
Okay, link 1, the mandate. It was vague. It simply allowed European gas and related hedging without enumerating specific trading hubs or instruments.
Way too broad.
Exactly. Link 2, the control profile. The desk evolved into a physical flow business, but they kept pre-trade controls that were designed for financial speculation.
Which didn't match.
Right. Link 3, decision rights were informal and ambiguous because the desk had basically traveled constantly.
Okay, the holes in the Swiss cheese are really lining up perfectly here.
Yeah. And Link 4, sizing. They sized their positions against that calm period VAR we just talked about, with zero liquidity constraints applied.
Oh, no.
Then Link 5 arrives, the stress event. A major supply disruption hits the grid. Peripheral hub liquidity completely evaporates, and the normal correlations between gas, power, and carbon just break down entirely.
And because they sized to their conviction and not to the exit liquidity?
They physically cannot get out of the position. Link 6 is realized. The desk takes the loss.
And the source lists some very specific math for this loss. Let me pull this up. It says the cross-commodity hedge shortfall cost 1.33 million euros.
Right.
The forced exit slippage cost 396,000 euros. And flow capture leakage added up to a final aggregate loss of 1,869,500 euros, which was 2.2 times their VAR. Wait, back up. Let's translate some of this into plain English. Forced exit slippage is that basically the massive premium you pay when the whole market knows you are desperate to sell and there is literally nobody left to buy.
That is exactly what it is. When liquidity vanishes, the gap between the price you want and the price you actually get forced into, that's the slippage.
Ouch. And the cross-commodity hedge shortfall.
That means they thought they were protected by holding related assets like power or carbon. But under stress, those statistical relationships broke down, so the hedge just failed.
And flow capture leakage.
That simply means they were so busy putting out fires that they missed out on the normal, everyday profits they should have been making.
And the real tragedy here is that the intervention to stop all this could have been incredibly cheap.
So cheap. I mean, no individual acted maliciously here. Every step was defensible in isolation. But breaking any one link would have prevented the 1.8 million euro loss. The absolute cheapest intervention would have been a simple monthly composition report.
Just a report.
Yeah, an automated, practically free report that would have surfaced the vague mandate drift and the sizing issue within a single quarter. It breaks link 1, and the rest of the chain just never happens.
Wow. So if I'm understanding this correctly, the European market failed at the very front of the chain, the mandate and the definition links.
Yes.
But what happens when we cross the Atlantic? The second composite case study is a North American desk. And this is actually a story of a broken chain, a successful intervention.
Right, this is a save. We have a U.S. desk holding firm physical supply obligations at 3 regional delivery points ahead of a massive cold forecast.
Okay, a storm is coming.
Links 1 through 4 are all present. The mandate is loose, decision rights are ambiguous, and the positions are sized way above their ability to exit them in 2 days. The storm is coming. The holes in the cheese are aligning.
But then a layered control actually works.
It does. 11 days before the cold event hits, an automated new point report triggers within their ETRM system.
What does that do?
It flags that the desk is holding a position at a specific physical delivery point they haven't transacted at in 12 months.
Oh, so anomaly.
Exactly. This triggers a review. Management looks at it and asks a highly specific operational question. They say, can our schedulers actually confirm flow at this specific point on the worst day of the year?
And they realized the answer was no.
Right. They had no overnight scheduling cover for that specific point.
So what happens?
Management forces the desk to exit that position early before the storm arrives. They take a small financial loss to get out 78,000 US dollars. Then the cold event arrives and regional prices go absolutely supernova, just gapping infinitely like we discussed earlier.
Let's do the arithmetic of the save here because it is just staggering.
It really is. If they had held that position, the replacement cost during the event would have been over $31.2 million.
Wow.
Even after subtracting their contract revenue and hub hedge gains, the net loss they avoided was $27,225,000 USD.
Let that sink in. They took a $78,000 hit to avoid a $27 million wipeout. That is a 349 times return on the cost of the exit.
Best $78,000 they ever spent.
Absolutely. But looking at these two cases, I can really deduce a massive structural difference here. Europe operates on virtual, regulated entry-exit hubs, like the TTF, which is why their failure was definitional, like bad correlations and mandate drift.
Right.
But the U.S. is incredibly fragmented. It's a point-to-point physical pipeline model.
You have identified the core structural contrast in global gas trading. You cannot take a European risk control framework and just transplant it onto a North American book. They fail in completely different ways.
Because the physics are different.
Yes, the U.S. market's fragmented physical nature pushes failure toward the operational and control end of the chain. Can your scheduler actually move the physical gas at 2 in the morning on a Sunday at this specific pipeline interconnect?
Right.
In the U.S., your controls must heavily emphasize operational capability assessments, deliverability verification, and point-level basis limits.
So if you are a desk leader listening to this, the obvious next step is to figure out where your own specific chain is weak. And the chapter doesn't just leave us with theory, right? It provides an applied build exercise called the Incident Chain Analyzer.
That's right.
How do we actually construct this to find our blind spots?
Well, it answers the ultimate question every board of directors will eventually ask you, which is, how do you decide what to fix first?
Which is a tough question.
It is. So you pull the last 5 incidents on your desk, no matter how small, and crucially, you must include near misses. You map those 5 incidents against the 6 links. You literally put check marks next to which links were present for each incident, and you count the frequencies to see which link is structurally failing most often.
Wait, let me push back on that for a second. Why spend resources analyzing near misses, things that didn't actually cost us money? Like, we got lucky, the disaster didn't happen, shouldn't we just move on and focus on the actual realized losses?
I get that question a lot. But you have to analyze them because near misses are the richest, most undersampled controlled data available to you.
How so?
If a near miss didn't lose money, it means a stress event happened, but one of the earlier links held. You need to know which link almost broke. The link that appears most frequently across all incidents, even the near misses, is where your next control investment goes.
Ah, I see.
Not necessarily the link that caused the most expensive historical incident, but the one that is structurally the weakest overall. Then you add a column for which cheap detector, like that automated new point report in the US case, would have caught it.
That is so practical.
It is, and the program note's a really great test for this. If you run this analysis and your output says your controls are strong everywhere, you either mapped it way too coarsely or you completely ignored your near misses.
Your vault doors are wide open, you just aren't looking at them. So as we wrap up this deep dive, let's just distill the core takeaways for you. Number 1, failure is not a sudden explosion. It is a mechanical 6-link chain, and breaking any single link, especially the early cheap ones, prevents the catastrophe.
Yep, that's number 1.
Number 2, do not trust calm period VAR to protect you from the fat tail physics of natural gas. If your model is blind to the pipeline constraints, you need scenario stress testing, not just a higher limit.
Couldn't agree more.
And number 3, North American and European desks require entirely different control frameworks because their physical infrastructure forces them to fail differently.
Spot on. And this analysis directly sets up Chapter 9, which zooms in on the 4th link of our chain, authority, overrides, and escalation.
Oh, that sounds intense.
It is. We all know who makes the decisions in normal, calm conditions. But Chapter 9 covers what happens under extreme stress. When the screens are actually blinking red, who holds the veto? Because under extreme stress is the only time the answer to that question actually matters.
I love that. But before you jump into that next chapter, I want to leave you with one final lingering thought. Think back to that U.S. case study. The desk took a guaranteed $78,000 loss to exit a position early, which ultimately avoided a $27 million wipeout.
The save of the century.
Exactly. But remember, prevention is invisible. If that cold storm had missed, or the pipeline just hadn't frozen, that correct risk decision to exit early would have just looked like a random $78,000 mistake on the P&L.
Just a loss on a spreadsheet.
Right. So ask yourself this. Does the culture at your desk reward the risk manager who took that $78,000 hit to fix a hole in the Swiss cheese? Or do they punish them for wasting money, thereby guaranteeing that nobody ever raises their hand again, leaving you wide open for the $27 million loss next time? Something to mull over before our next deep dive. So imagine you're a pilot, right? Flying this massive commercial jet.
Okay, I'm with you.
And you're just on autopilot cruising along on this sunny Tuesday afternoon. The engines are humming. The sky is clear. I mean, everything is perfectly fine.
Right, sounds ideal.
But then suddenly, severe turbulence hits. The alarms just start blaring. There are red lights flashing everywhere in the cockpit.
A nightmare scenario.
Exactly. But instead of the system, automatically handing the controls over to the seasoned captain to actually navigate the storm, it just keeps flashing those lights. and it leaves the panicked, completely exhausted co-pilot in charge of the yoke.
Yeah, that's not going to end well.
No, if you were sitting in the back of that plane, you'd be absolutely terrified. I mean, it's a recipe for a crash.
It really is a terrifying scenario. And, it is also a surprisingly accurate description of how the vast majority of natural gas trading desks handle extreme market stress.
Wait, really? The vast majority.
Oh, absolutely. I mean, they spend millions building these highly sophisticated systems that flash red lights and send out these urgent warning emails, but they completely fail to actually change who is flying the plane when things go wrong.
Wow. Okay, well, welcome to this custom-tailored deep dive, everyone. Whether you are an aspiring gas trader, maybe a quant, a risk manager, or a scheduler who's sitting on a desk right now, your mission today is practical survival.
Survival being the operative word there.
Exactly. We are extracting the core lessons from the Natural Gas Trading Desk Master Program. And just to give you the lay of the land, this is a massive sequence journey. It spans 9 modules and 120 chapters.
It's very comprehensive.
Yeah, taking you from market design and pipeline physics all the way through to ETRM technology and desk legacy. And today we are deep inside Module 1, which is running a gas trading desk.
Right, and specifically we are unpacking Chapter 9, which covers authority, overrides, and escalation.
So to really ground us in what we are doing today, we probably need to carry forward a couple of, fundamental rules from earlier in the program, right?
Yes, definitely. In Chapter 4, we establish this strict rule that there can be exactly one, and I mean exactly one, decide owner on a desk for any given position.
Right. The buck stops with one person.
Exactly. And then in Chapter 8, when we looked at the actual anatomy of how gas desks blow up, we saw that the critical link in the failure chain is, well, it's always ambiguous authority under stress.
The gray areas.
Right. So drawing on my decades of experience at Durga Analytics, where we've, built, run, and audited these desks across Europe and North America, we are going to look at how authority actually has to function when the market turns violently against you.
Okay, so if we want to understand how a desk actually survives that kind of violent market stress, we first have to unlearn this, I guess, deeply ingrained corporate myth.
Oh, the biggest myth in risk management.
Right, and that is the difference between notification and escalation.
Yeah.
Because, if a trader's position starts hemorrhaging cash and the system fires off an urgent email to the chief risk officer and the desk head, most people would just call that an escalation.
They would. Most corporate cultures treat that exactly as an escalation. But on a trading floor, it is merely a notification. You have an escalation process in name only.
Okay, so break that down for us.
Well, the difference is decisive when a desk is bleeding cash. When a risk trigger is hit, you have to run a very simple, ruthless test. After the automated process runs, you just ask yourself, has the identity of the decide owner actually changed?
Meaning, who is legally and functionally authorized to make the next trade?
Yes. If the same tired, stressed trader who dug the hole in the first place is still the one deciding whether to cut the position or hold it, you have not escalated.
You've just notified them.
Exactly. You've only notified. Notification just means information moved from one inbox to another. Escalation means authority formally moved from one human to another.
Wow, that is a massive distinction.
It is. Because a notification will not stop a desk from continuing down a disastrous path. Because the person walking that path hasn't actually been relieved of command.
Okay, let's unpack this a bit more.
Yeah.
Let's look at the triggers themselves. The mechanisms that actually set off these alarms. We need to draw a hard line between discretionary triggers and conditional triggers.
This is where most desks get it wrong.
Right. So a discretionary trigger seems to be essentially asking the trader for their opinion. It's like installing a fire alarm in a building that only rings if someone looks at the smoke, evaluates their own lung capacity, and then decides, yes, I believe this is a real fire.
That analogy captures the absurdity of it perfectly.
That's crazy, right?
It is. I mean, a classic discretionary policy reads something like this: escalate to the desk head if the position becomes concerning, or if market conditions become irregular.
Concerning is such a vague word.
Right. Think about the psychology of the human being who's actually expected to execute that policy. Under severe stress, the person inside the position is the absolute least objective person in the room.
Because they're panicking.
They are exhausted, their adrenaline is spiking, and formally escalating feels like admitting defeat.
Yeah.
You are basically asking them to voluntarily surrender.
Which nobody wants to do.
Exactly. Discretionary triggers systematically fail in the exact moments you need them the most.
Which brings us to the alternative, right? conditional triggers. These fire automatically based on observable data, totally independent of how anyone feels about the market.
Yes. A conditional trigger relies on a hard math equation. It says, escalate when realized loss exceeds 40% of the monthly budget in a single session.
Boom. No feelings involved.
None. Or escalate when days to exit exceeds 5 at the current stressed average daily volume. The moment that mathematical threshold is crossed, the system just fires.
And crucially, it instantly revokes the trader's decide authority.
Yes. It takes it away and hands it to the desk head or the CRO, basically someone whose judgment hasn't been completely degraded by the trauma of watching the screen flash red for 3 hours straight.
Okay, let's put a literal, verifiable price tag on why relying on human judgment is so dangerous here. Walk with me through this real-world example from a U.S. desk.
So, we're looking at a position of 320,000 MMB2.
Right. So in this specific scenario, the desk had a discretionary trigger. And mathematically, it should have fired at 0920 in the morning.
But it was discretionary.
But it was discretionary, so because the policy required a subjective judgment call from the trader, the escalation was delayed, the trader hesitated, hoping the market would revert.
Like they always do.
Exactly. So escalation didn't actually happen until 10:00. That is a 40-minute delay.
And in gas markets where prices can swing wildly on just a single weather forecast, 40 minutes is a lifetime.
It's an eternity. Over that specific 40-minute window, the market moved 0.62 USD per MMB2 against the desk's position.
Ouch. Yeah, the math is brutal. 320,000 MMB2 multiplied by a 62-cent adverse move, that is a direct realized cost of $198,400.
Almost 200 grand.
That is the literal invoice for a single instance of a 40-minute human hesitation.
So while losing 200 grand in under an hour is incredibly painful, there is a secondary compounding cost here that seems even more fatal to the desk's survival.
Oh, absolutely. The lost money is just the visible symptom, right? The fatal operational cost is what happened during those 40 minutes.
Right, because the desk head was completely blind.
Exactly. Because the information hadn't moved, the desk head couldn't step in to reduce the position, execute a hedge, or even institute a trading halt.
They were just sitting in the dark.
Completely in the dark. And because authority hadn't moved, the trader who was now acting out of sheer desperation actually added to the losing position at 09.4.
Wait, what? Oh, wow.
Yeah, trying to average down and basically trade their way out of the hole.
They doubled down? That is a classic panic move.
It is. And delaying escalation permits desperate decisions that the escalated authority, a calm desk head, would have instantly blocked.
It just proves why your trigger must move authority, not just send a warning email.
Exactly.
So you automate the triggers to take away the trader's hesitation. But traders are resourceful, right? If an automated system stops them from trading, and they believe the system is wrong, they're going to find a way around it.
They absolutely will.
So how do you govern a trader manually overriding the system? Because overrides have to be the most sensitive authority on any trading floor.
They are the absolute most sensitive. But we have to acknowledge a reality of the gas market here. Desks must have overrides.
Really? You can't just ban them?
No, you can't. The physical reality of natural gas pipelines will always eventually diverge from what your energy trading and risk management system, your ETRM, thinks is happening.
Ah, okay. The map is not the territory.
Exactly. Forward curves go stale at illiquid delivery points. Models break during extreme weather. Operational emergencies occur. You will need price overrides, model overrides, limit overrides.
So they're a necessary evil.
Yes. The question for leadership isn't whether to ban them. The question is how you govern them so they don't destroy you.
Which brings us to the 4 absolute rules for override governance.
Yeah.
Let's walk through these. Number 1, never self-approved. The person benefiting from the override cannot be the one who authorizes it in the system. You simply cannot grade your own homework.
It is the fundamental baseline for preventing fraud.
Makes total sense.
Rule 2. Overrides must always be logged with a specific reason using free text, not a drop-down menu.
Oh, interesting. Why not a drop-down?
Because if you give traders a drop-down menu, 99% of the time they will select the vaguest option, like system error or other, and then you just get garbage data that you cannot audit.
Right, other hides everything. Okay, rule 3. Always time-bound. An override must have a hard expiration date. Because a permanent override isn't an exception anymore, right? It's just a system defect that the IT and risk teams are too lazy to fix.
Bingo. If it doesn't expire, it becomes the unreviewed law of the desk.
And finally, Rule 4 frequency must be a monitored metric. You have to track how many overrides are happening per month, per person.
Yes. If a trader's override count starts spiking, either your ETRM system is fundamentally degrading or your trading culture is degrading. Both require an immediate audit.
Wait a minute, let me challenge you on that last point, because
Yeah.
if I pull the monthly log and I see that one single trader is responsible for, let's say, 60% of all the manual overrides on the entire desk, my immediate instinct as a risk manager is that this person is hiding massive losses.
Sure.
Like they are cooking the books. Why isn't that an automatic firing offense?
Well, it is a totally natural instinct to assume misconduct, but it might simply reflect the reality of their specific book composition.
So
Imagine a trader whose mandate is to cover highly illiquid European hubs, or maybe constrained U.S. physical pipeline points where market data is incredibly sparse.
Okay, so the data is just bad to begin with.
Exactly. The automated system curves for those points are going to be genuinely wrong on a daily basis. So if the system is marking a position at a price that doesn't actually exist in reality, the trader is forced to override it just to make the desk's P&L accurate.
Huh. So how do you tell the difference between a trader doing, vital system repair to reflect reality and a trader who is just smoothing out their P&L to protect their bonus?
Context. You have to contextualize the data. You compare their override frequency against other traders managing similarly illiquid books. And most importantly, you commission an independent price verification and IPV on a sample of their marks.
So you bring in an outside check?
Yes. You send a third party to verify the broker quotes. You must frame the investigation as a system quality question first. Because if the ETRM curves are genuinely broken, that trader is actually keeping the desk alive.
Oh, wow. I didn't think about it like that.
Right. Accusing them of fraud without running an IPV first will destroy desk morale instantly.
That is a critical distinction to make before just, walking onto the floor and pointing fingers. Now, to see these concepts in practice, we need to look at how different markets actually break down, because the master program covers both European and North American markets.
Which is vital because structurally they fail in completely different ways.
Right, which means they need completely different escalation designs.
Yep.
Let's start with Europe. The binding constraint that usually kills a European desk is liquidity stress, massive margin calls.
Exactly. Let's build a practical example of escalation under a margin call. So imagine a European desk holding a short hedge position of 4 million megawatt hours.
Okay, 4 million.
They entered this position at 38 euros per megawatt hour, but the market rallies and the current price is now 42 euros. They are out of the money by 4 euros per megawatt hour, which means they have already posted 16 million euros in cash margin to the clearinghouse.
Okay, I'm tracking with the math so far. Now, let's say the desk's total committed liquidity, like the absolute maximum cash the Treasury Department will let them use, is 120 million euros. We want to design a conditional trigger that fires and revokes authority when the stress hits exactly 50% of that committed liquidity.
Right, so 50% of 120 million is 60 million euros. Now, the risk team typically writes the rule in the manual like this: escalate when the margin call hits 60 million euros.
Makes logical.
But that is a critical design flaw. You have to convert that margin number back into a market price.
Oh, I see. You're translating a Treasury problem back into a trading screen problem. Let me write this down and do the math.
Go for it.
Okay, so our trigger is 60 million euros. We divide that by our 4 million megawatt hour position. That gives us a 15 euro adverse price move. Our starting price was 38 euros. So 38 plus the 15 euro move gives us 53 euros per megawatt hour.
Perfect. You've just designed a vastly superior control. The escalation trigger must be set as a hard market level 53 euros.
Because it's easier to see.
Exactly. When a trader is deep in the red, they cannot be expected to continuously calculate their total margin utilization in their head. But price is continuously observable. It flashes right in front of them on the screen.
Right, they just look at the screen.
So you set the alert directly in the trading system. The moment the market ticks to 53 euros, authority moves to the desk head. No math, no hesitation.
That turns a theoretical risk policy into something a human being can actually use under fire. But let's look at what happens when these rules are ignored. We have an industry case study from Europe about an override that mutated into standard operating procedure, didn't we?
We did. And keeping with the source, this is a constructed composite drawn from European regulatory and audit commentary over the years.
Okay, good context.
So in this scenario, a desk holds 265,000 megawatt hours at a highly illiquid European hub. The automated ETRM curve is stale, it's not reflecting reality. So the desk correctly introduces a manual price override to mark the position to a legitimate broker-quoted level.
Which is perfectly valid, as we discussed earlier.
It was valid on day 1, but they violated Rule 3. The override was not time-bound. It had no expiration date.
Uh-oh.
Yeah, it was quietly approved in the monthly risk meeting, then the quarterly meeting, and eventually it just became a standing, permanent override.
Just baked into the system.
Exactly. Over the next 2 years, it was automatically applied to the book 400 times without a single review.
Wow.
The underlying defect in the ETRM curve was never fixed because the override acted like a Band-Aid, making the bleeding totally invisible to senior management.
I think of it like driving a car with a slight pull in the steering alignment. At first, you just hold the wheel a little to the right to compensate. It's a manual override.
Right.
But if you never take it to the mechanic, you eventually stop noticing you're even doing it. Until 2 years later, you realize you've drifted entirely into the oncoming lane.
A perfect analogy, because an independent price verification eventually audited this desk and found that the standing override had drifted far, far away from actual broker quotes. It had defaulted to these overly optimistic desk-estimated levels.
How far off was it?
Well, the verified real-world mark was 32.15 euros. But the standing override had them marking the book every single day at 34.60 euros.
That is a 2.45 euro difference per megawatt hour. On a 265,000 megawatt hour position, they were overstating their P&L by 649,250 euros.
Nearly 650 grand.
And the wildest part is nobody intentionally committed fraud to get there.
No, drift did the damage, just one small, unreviewed step at a time. A standing override converts a temporary, valid judgment into a permanent, unreviewed practice.
It's dangerous.
Very. An expiration date on that override would have forced the desk head to make a conscious redecision and ultimately forced the IT team to fix the broken curve.
All right, so Europe fails through liquidity constraints and override drift. Let's cross the Atlantic. The North American gas market fails under completely different pressures. Over here, it's driven by physical operational deadlines and pipeline nomination cycles.
Yes.
And those pipelines do not care about your stress levels or your P&L.
They absolutely do not. U.S. operational escalation is entirely constrained by cycle deadlines that are set in stone by the pipeline operators. Therefore, your escalation design cannot be based on price alone. It must be time-boxed backwards from the physical deadline.
T-minus scheduling.
Exactly. We refer to this as T-minus scheduling.
The timeline runs from T90 minutes down to T0. So at T90, the scheduler checks to confirm supply. If there's a volume mismatch, at T60, they notify the trading desk to fix it. At T30, if it's still unresolved, authority formally escalates to the desk head.
That's the standard progression, yes.
But the most fascinating part of this framework is the T10-minute row.
T10 minutes is the safety net most desks fail to build, and it is the only thing that saves you from total catastrophe.
Paint the picture for us.
Imagine you are 10 minutes away from the physical pipeline cutoff. You are short on gas. If you do nothing, you default on your physical delivery obligations. The pipeline operator will hit you with massive penalty fees, and they might cut off your access entirely.
Which is a disaster.
Right. But the desk head is on a plane and completely unreachable. What do you do?
If the trader is paralyzed and the boss is missing,
Right.
you need a pre-authorized default action.
Exactly. The scheduler executes a pre-authorized default instruction, for example, a standing order to automatically buy replacement gas at whatever the current index price is just to balance the position.
Whatever it takes.
Whatever it takes. But the critical governance rule here is that the standing delegation of authority must be signed and filed during peacetime, before the day it is actually needed.
Right, because if you're making it up on the fly.
An improvised delegation of authority at T10 minutes isn't a procedure, it is sheer panic.
Let's look at the U.S. operational case study to see this T-minus schedule in action during a major winter reliability event. And again, this is a composite based on real winter events.
Right. So in this scenario, a U.S. desk has a physical supply obligation. They have a conditional escalation threshold hard-coded to fire if there is a 5% supply mismatch inside the T60-minute window. At T58, the scheduler's confirmed volume data feed shows a mismatch. The trigger fires automatically. No human judgment, no hesitation.
Authorities instantly ripped from the trader and handed to the desk head.
Exactly. The desk head assesses the freeze-off on the pipeline and immediately buys replacement supply at the receipt point. The time is now T42.
Cutting it close.
Very close. And because physical supply is tightening, it costs them $11.20 per MMB2, which is a massive $224,400 premium above their planned cost.
Okay, nobody wants to eat a $250,000 loss. I mean, if that trigger had been discretionary, I can easily see a trader hesitating, delaying the escalation, just hoping the price would drop before the deadline.
And that hesitation would have annihilated the desk, because overnight, the cold weather event deepened into a historic freeze. Prices at that specific physical point spiked to $96 per MMB2.
$96.
Yes. If they had waited, that exact same replacement volume would have cost them over $3.2 million. By trusting the cold, data-driven trigger at T58, the desk head took a painful hit but avoided a $2.88 million catastrophic loss.
Wow. That is two incredibly contrasting realities. In Europe, a perfectly correct manual override decayed into a massive phantom profit because it lacked an expiration date. In the US, a correct automated trigger held the line because it required zero human willingness to act.
The contrast is exactly why we teach both.
It proves that you have to design risk controls that work when people are exhausted, distracted, or just financially terrified.
Yeah.
Because that is the only environment in which they will actually be tested.
Which brings us to the most important part of this program, how you, the listener, sitting on a desk right now, can actually apply this on Monday morning. The master program includes an applied build for every single chapter, and today's build is an escalation trigger register.
All right, it's time to open up a fresh spreadsheet. Step 1, list every single escalation trigger currently written into your desk's policy manual. Step 2, aggressively classify each one. Is it conditional, based on hard math, or is it discretionary, based on human feelings?
And step 3 is where you will face serious resistance from your traders.
I bet.
For every conditional trigger, you must document the exact observable data feed it fires from. If you cannot point to the specific data feed on the screen, I assure you, it is a discretionary trigger in practice. I don't care how beautifully the legal department wrote it in the manual.
That's a great test. Step 4, document who holds the decide authority before the trigger fires and who holds it after. Because if those two names are the same, you do not have an escalation process. You just have an expensive notification system.
Exactly right.
And finally, step 5, add time-boxed rows for every physical operational deadline, ending with that vital pre-authorized default instruction at T10 minutes.
So once you build this register, you have to test it against reality. Run your newly designed triggers against the last 12 months of your desk's actual position and P&L data. Count how many times they would have fired.
Backtest it.
Yes. If a trigger never fires, your math is miscalibrated and the control is useless. But if it fires twice a week, your traders will suffer from alarm fatigue and start ignoring it entirely.
And here is a quick career tip for anyone listening. Calibrating a risk trigger to balance safety against false positive alarm fatigue isn't just elite desk management. It is a brilliant, highly practical talking point to bring up in your next job interview.
Oh, absolutely.
Because it shows leadership that you understand how human beings actually interact with risk systems in the real world.
It completely separates the theoretical spreadsheet managers from the practitioners who actually know how to run a durable trading desk.
So, to synthesize our survival mission for today, notification is not escalation. Moving information around the company is great, but moving authority is what saves the desk. Triggers must fire on hard data, not the fragile psychology of a losing trader.
And manual overrides are a necessary reality of the gas market, but they must carry a strict non-negotiable expiration date to prevent systemic drift.
Well said.
This foundational understanding of governance sets up our next step perfectly. Next time, we move into Chapter 10 of the Master Program, which is the Senior View of Gas Desk P&L.
Looking forward to it.
The override governance we learned today directly dictates whether the final profit and loss number your desk reports is actually real. So in Chapter 10, we will learn how to decompose that number and why the unexplained component of the P&L is the very first thing a veteran desk head investigates.
I can't wait to dig into that unexplained P&L. But before we wrap up today's deep dive, I want to leave you with a final thought to mull over.
Let's hear it.
Think back to that airplane autopilot we talked about at the beginning. If a standing override on your ETRM system never expires, and it eventually masks the fact that your underlying pricing curves are fundamentally broken, who is actually flying the plane? Who truly controls your desk's reality? Is it the physical gas market, or is it the trader who simply refuses to let their override expire? Something to think about. Until next time, keep digging deeper.
So, in the sources we're diving into today, there is this honestly terrifying premise.
Oh, it really is.
Yeah, if you are sitting in the senior chair, you're running a natural gas trading desk, the absolute most dangerous month your team can have is not the month where they lose money.
Right.
The most dangerous month is actually the one where they make like 3 times their profit target.
Which runs completely counter to how literally the rest of the corporate world operates. I mean, in a normal business, beating your target by 300% means, well, everyone gets a massive bonus and the board is just thrilled.
Exactly.
But on a natural gas desk, a massive, unexpected profit is often the first symptom of a terminal disease.
Yeah, a huge red flag.
If you don't know exactly where that money came from, you are likely sitting on a ticking time bomb.
And that is the mystery we are unpacking today. So, welcome to this deep dive. For those of you following along with the broader syllabus, we are continuing our journey through the Natural Gas Trading Desk Master Program.
Yes, the big one.
Right, that 9-module, 120-chapter sequenced journey taking you from physical market structure all the way to desk leadership. We are currently in Module 1, zeroing in on Chapter 10, which is titled The Senior View of Gas Desk P&L.
A very critical chapter.
Absolutely. And I'm joined by a natural gas trading and risk management consultant from Durga Analytics, who has spent decades building these desks, designing the ETRM systems, and navigating these exact blow-ups across North America and Europe.
It is a privilege to unpack this with you. And, my goal today is to speak directly to the practitioners listening, the aspiring traders, the originators, analysts, and the ETRM professionals.
We're glad to have you.
Thanks. If there's one thing my time at Durga Analytics has taught me, it's that a single aggregate profit number like, say, walking in and saying, we made $5.4 million this month, is completely useless to a desk head.
Wait, completely useless?
Yes. It tells you absolutely nothing about survival. So, our objective today is to look at a profit and loss statement the way a senior leader does, deconstruct where the money actually comes from, and build the analytical engine that keeps your desk solvent.
Okay, let's start right there with this illusion of the aggregate number. I mean, when a junior analyst runs the end-of-month report, they look at the bottom line. It's green. $5.4 million.
Right. Time to celebrate, they think.
Yeah. But if I'm the desk head looking at that number, my first thought shouldn't be to pop champagne. My first thought should be, prove to me this is real.
Exactly. You demand proof through decomposition. A senior manager reads a P&L attribution report bar by bar, moving from right to left to isolate the specific economic drivers of that final number.
Okay, so breaking it into pieces.
Yeah, we break the profit into its mechanical components. So the first component you look at is flat price. This measures profit generated purely from the outright level of the gas market moving up or down. If your flat price bar is large, it means the desk took directional risk. They were basically betting on the overall market direction.
But hold on, if flat price covers the overall market moving, where does the profit come from if my specific desk is just trading, say, the price difference between two pipelines?
That brings us to the second component, which is basis.
Okay.
Basis measures the profit from locational spreads changing. Like, if you are buying gas in Pennsylvania and selling it in Boston, you don't really care if the global price of gas goes to the moon.
Because you're hedged on the absolute price.
Right. You only care that the price spread between Pennsylvania and Boston widens in your favor. If your mandate is to be a basis desk, this specific bar is where you are supposed to be earning your money.
Okay, so we have overall market direction, and we have geographic price differences.
Yeah.
What else makes up the profit?
Well, you also have curve shape, which isolates the profit coming from seasonal spreads, steepening or flattening.
Like summer versus winter gas.
Exactly. This tells you if your storage positioning is working. So, for example, if you are injecting gas in the summer to withdraw in the winter, you want that winter premium to grow. And then you have time decay.
Wait, let me stop you there. For the listener who maybe isn't an options trader or a quant, what does time decay actually mean mechanically? How does time itself make or lose money?
Good question. Think of time decay as the expected cost of holding a position open as the clock just ticks.
Literally just the passage of days.
Right. If you hold physical gas in a storage cavern, you are paying daily lease fees and tying up capital. That is your carry. Or if you buy a financial option, you pay a premium for the right to exercise it later.
Oh, I see.
Yeah, every day that passes without a massive market move, that option becomes slightly less valuable simply because there is less time left for a price spike to actually happen.
That makes perfect sense. The clock is always ticking.
Always. Time decay isolates the P&L impact of simply moving one day forward on the calendar, assuming market prices didn't move at all.
Okay, so what are the final pieces of the explained profit?
You have new trades, which isolates the day one value on deals executed strictly within that specific month. And you account for FX, which is the currency translation impact, if you hold books in a non-base currency.
Right, if you're trading across borders.
Exactly. So once you have calculated all of those, flat price, basis, curve shape, time decay, new trades, and FX, you arrive at the absolute most critical component on the entire report.
Which is?
Unexplained P&L.
It's like looking at the final score of a basketball game versus looking at the box score.
That's a great analogy.
Right. The final score tells you who won, but the box score tells you if you won because of, like, sustainable three-point shooting or because the other team accidentally scored in your basket a few times.
Yes. And as a desk head, you obsess over the box score. That unexplained bar is the very first number you look at before you even glance at the total profit.
So what is it exactly?
Unexplained P&L is simply the plug. It is the mathematical gap between what your models predicted should have happened based on the market moves and the actual closing value of your book. It directly measures how well you understand your own business.
Let's break down how we actually interpret that gap, because I assume not all unexplained profit or loss is created equal.
No, definitely not. There are three main signatures you look for. The first one is small and random.
Okay, meaning what?
Meaning, if your unexplained P&L bounces around between positive and negative and it stays within like 1 to 3% of your gross moves, you just ignore it. Attribution is an approximation, so minor statistical noise is totally normal.
Right, it's never going to be down to the penny. What if it's large but still bouncing around randomly?
Then you have a modeling finding. The math is telling you that your model is missing a risk factor.
Like what?
Well, maybe your portfolio has exposure to daily temperature volatility in a specific region, but your valuation model only looks at monthly averages. The market is moving the value of your real-world book, but your model is just blind to it.
Wow, okay. And the third signature?
The third signature is persistently one-signed.
Uh-oh.
Yeah. Let's say your unexplained P&L is negative every single month. That is not a modeling quirk. That is a critical control finding.
Because it's a trend.
Exactly. It means economic value is physically leaking out of your desk somewhere the attribution system does not see.
Okay, let me push back on this on behalf of the listener for a second.
Go for it.
If I am running a desk that is making, say, $10 million a month, why should I care about a tiny negative unexplained residual of, like, $20,000 bucks? In the grand scheme of things, isn't that just a rounding error?
It's like a restaurant manager who thinks their food costs and revenue are perfectly in line because the daily total looks fine, but they're completely missing that the register software has a tiny rounding error that is systematically undercharging every 10th customer.
I see.
The golden rule of P&L attribution is that the sign pattern over time matters vastly more than any single month's magnitude. A small leak that sits perfectly within your risk tolerance threshold is a massive red flag if it happens sequentially.
I want to see this applied to the real world because that makes it so much clearer. The master program uses two major worked examples here, making a clear structural contrast because the European and North American markets tend to fail in very different ways.
They really do.
Let's start with Europe and this concept of a good P&L hiding a liquidity crisis.
Okay, we will look at a European desk that reports 7.5 million euros of total P&L for the month.
Okay, nice.
Yeah, 2.1 million is realized, 5.4 million is unrealized. You present that 7.5 million figure to the board, it is highly profitable.
Everyone's happy.
But, and here's the catch, the desk's cash generated for the month is negative 14.2 million euros, and the margin posted at the clearinghouses is negative 19.6 million euros.
Wait, what? How does that happen mechanically? How do you have 7.5 million in recognized profit, but you are hemorrhaging almost 20 million in actual cash?
This is the normal, dangerous profile of a hedged book, where margined financial instruments are used to hedge unmargined physical assets.
Unpack that for me.
Sure. Imagine you buy physical gas and put it in European storage for the winter. That physical gas is an asset, but it is not traded on an exchange, so nobody calls you for daily cash margin on it.
Right, it's just sitting in a cavern.
Exactly.
Yeah.
But to hedge your price risk, you sell financial futures.
Okay, so if the market price of gas suddenly spikes across Europe, what happens?
Well, the value of your physical gas and storage goes up significantly. That generates millions in unrealized profit on your P&L.
Sounds great so far.
But your financial hedge, those futures you sold, loses value. And because those futures are exchange traded, the clearinghouse demands cash margin today to cover that loss.
Oh, wow.
So your P&L looks phenomenal because your physical asset appreciated, but you cannot cash that physical asset in until winter. Meanwhile, your Treasury Department has to wire 19 million euros in hard cash to the exchange this afternoon just to keep the hedges alive.
Which means profit without cash consumption is only half the story.
It is the half that doesn't cause insolvency. A desk reporting P&L without showing the associated liquidity drain is basically flying blind.
That is terrifying. Okay, the chapter gives us a second European case study about the hidden leak we discussed earlier. And the source material notes this is a composite scenario drawn from European audit and regulatory commentary, right? Not one identifiable firm.
Right.
Walk us through the math of a persistently negative residual.
Picture a European desk where the monthly attribution shows an unexplained P&L averaging negative 0.18 million euros per month.
Okay, pretty small.
Right. That is roughly 4% of their gross moves, well within their risk tolerance threshold. Nobody checks it. But it is negative in 11 out of 12 months.
Let's unpack the statistics there.
Right.
Why is 11 out of 12 so damning? I mean, couldn't that just be bad luck?
Not according to the binomial test probability. If the unexplained residual was truly random market noise, essentially just flipping a coin, the probability of getting a negative result in 11 out of 12 months is about 0.6%.
Wow. Barely 0.5%.
Yeah, it is a statistical near impossibility for that to happen by chance. It means your coin is loaded. In this composite case, after 2 years, an operational review traced this residual back to an unmodeled fee accrual and a systematic capture timing error on their flow book.
So by ignoring that tiny monthly bleed because it was under the magnitude threshold, what was the actual total damage?
Over 2 years, 4.32 million euros leaked out of the desk.
Ouch.
Tolerance thresholds test magnitude. They do not test sign. Running a time series plot of your unexplained P&L and applying an annual sign test is a trivial control, but it is literally what separates a durable desk from a failing one.
So Europe showed us how a desk can bleed to death slowly from 1,000 tiny leaks or face a massive liquidity crunch while looking profitable on paper.
Yes.
Let's shift to the North American market because there's a much faster way to blow up a desk.
Yeah.
And that is when your traders make a massive profit, but for all the wrong reasons. This takes us back to the hook of our deep dive.
Right, exactly. So we're looking at a U.S. desk that reports $2.88 million in aggregate P&L for the month. Their mandated plan was $0.95 million.
They tripled their target.
They tripled it.
On paper, that looks like a massive win. But if I'm the desk head, looking at the decomposition we talked about, my stomach just dropped. Where did that extra $2 million actually come from?
It did not come from their job. Their mandate, what the board actually allocated capital for them to do, was to trade basis. But the decomposition reveals that the basis component only generated $0.35 million against a plan of $0.80 million.
Wait, so the mandated strategy underperformed drastically.
Exactly, meaning they failed at what they were hired to do.
So what generated the $2.88 million?
$2.90 million came from unmandated directional flat price exposure.
What does that mean?
They had residual risk from customer flow that they just failed to sweep and hedge. They essentially left a massive unauthorized directional bet open on the book, and the overall gas market just happened to move in their favor.
Right.
Furthermore, their unexplained P&L was elevated at negative $0.42 million, so they didn't even have a firm grasp on the risk they were holding.
They took a massive gamble they weren't authorized to take, and they just got incredibly lucky.
Which is why this is the most dangerous month a desk can have. If senior leadership celebrates this $2.88 million and pays bonuses on it, they are institutionalizing a fatal behavior.
They're rewarding rogue trading.
Yes, they are teaching the desk that taking unmandated, unsized directional risk is the way to get rich.
So what do you do as a leader? You recognize the money because the cash is real, but you immediately drop the hammer on the risk controls.
Right.
You only reward them for the $0.35 million they made on mandate.
Exactly, the required discipline. You have to be ruthless about that.
Yep.
Now, the second U.S. case study deals with a different kind of illusion. Day one profit on a structured book. And again, this is a teaching composite reflecting broader industry patterns, not a specific firm.
Okay, let's define day one profit mechanically. If I execute a trade at a price that is intrinsically better than what my own valuation model says the market fair value is, I get to recognize that difference as profit today on day one. Is that right?
In a highly liquid, transparent market, yes. Because your model is calibrated to observable, independent prices on an exchange. But This desk is originating structured supply arrangements at highly illiquid regional points in North America.
So there's no exchange to check it against.
Right. There are no independent market prices to verify against, so they are valuing these complex trades using their own internal basis model.
It's like grading your own homework. You set the assumptions for what the gas is worth, you execute a trade that beats your own assumptions, and you declare a massive profit.
Exactly. And over 18 months, this desk recognizes $6.8 million in day one profit. They get paid out on it.
Of course they do.
But then a severe cold weather event hits, and the regional basis reprices based on actual physical flow constraints. The realized actual economics of that entire book end up being only $1.15 million.
Meaning $5.65 million of that recognized profit was entirely phantom.
Yeah, it was an 83% overstatement.
You graded your own homework, gave yourself an A+, took the allowance, and then found out 18 months later at the final exam that you actually failed the class.
The governance standard here is deferral. In an illiquid market, day one profit doesn't mean you outsmarted the market. It just measures the gap between the execution price and your own model's internal assumptions.
Right. Your model could just be wrong.
Exactly. You do not recognize that profit on day one. You defer it, releasing the profit slowly over the life of the trade, only as observable data in the real world confirms your model is actually correct.
So we've seen how ignoring the decomposition leads to hidden leaks in Europe, and how rewarding the aggregate number leads to phantom profits and wild gambles in the U.S.
Yes.
How do we actually build the mathematical system to stop this? Section 5 of the chapter details the applied build for a P&L attribution engine. Let's walk through that.
Sure. To construct this engine, you need 4 pristine inputs: your opening and closing positions, your opening and closing forward curves, the new trades executed in the period, and your FX rates.
Okay.
The methodology relies on revaluing the opening book successively. You move one factor at a time, holding all the others constant, and you record the change in P&L.
I'm going to stop you there because the chapter emphasizes that the order in which you move these factors matters deeply because of something called cross terms. What mechanically is a cross term?
A cross term is the mathematical overlap when two variables change at the same time. Let's do a simple example. Say your opening position is 10 units of gas priced at $1.
Okay, total value is $10.
Right. Tomorrow, your position increases to 12 units and the price jumps to $2. The new value is $24.
So your P&L changed by $14.
Okay, following the math. Now, if you try to attribute that $14, you have a price effect and a volume effect. The price went up by $1 on your original 10 units. That's $10 of profit. The volume went up by 2 units at the original $1 price. That's $2 of profit. But 10 plus 2 is only $12. Where are the missing $2?
Oh, the missing $2 is the new price acting on the new volume. The extra $1 in price applied to the extra 2 units of volume.
Precisely. That overlap is the cross term. If you move price first in your engine, the cross term gets bundled into your volume explanation.
And if you move volume first,
If you move volume first, the cross term gets bundled into your price explanation. Neither is inherently wrong, but you must thoroughly document your ordering convention and keep it entirely constant.
or else it's chaos.
Yeah, if you change the order of calculation from month to month, your period-to-period comparisons become mathematically meaningless.
And how do we test that the code for this attribution engine is actually functioning correctly?
The acid test. You run the engine on a historical period where absolutely no new trades were executed and there were 0 FX movements.
Okay, a totally static period.
Under those strict conditions, only flat price, basis, time decay, and curve shape should show non-zero values. If your engine spits out a value for new trades when no trades occurred, you have a hard bug in your code.
That's a great test. So for the analysts and quants listening right now who are looking to, get hired on a top-tier gas desk, what is the ultimate interview detail they should drop?
Mention that you don't just look at the magnitude of unexplained P&L. Tell them you track unexplained P&L as a time series and that you apply a binomial test on the sign over a rolling 12-month period to detect systematic leakage.
Oh, that's good.
Saying that proves you understand the profound difference between a harmless modeling artifact and a lethal control failure.
So bringing it all together, running a durable gas trading desk requires extreme discipline in separating true economic value from accounting illusions, liquidity traps, and phantom model marks.
Absolutely. The aggregate number is vanity. The decomposed components are reality. And that bridges us directly into the next step of the master program.
Right. Chapter 11.
Exactly. Everything we discussed today, attribution engines, day one deferral, cross terms, it all depends entirely on the data underneath it. A P&L attribution is only as good as the trade capture 4 layers beneath it.
Which is why we need ETRM systems.
Right, that is why Chapter 11 examines the ETRM system not just as software, but as the foundational control mechanism for the desk.
It all connects. Well, as we wrap up this deep dive, I want to leave you with a final thought to mull over. We've talked a lot about models, marks, and assumptions today.
We have.
Look at your own desk's reporting tomorrow morning. If you stripped away all the numbers that represent internal model assumptions, like the unrealized marks, the illiquid day one profits, and you only looked at the hard realized cash flowing in and out of the treasury, how different would your star trader's track record actually look? Think about it. We'll see you next time. You know, when we picture high-stakes energy trading, we always tend to picture, like, the exact same Hollywood scene.
Oh, absolutely. The screaming on the phones.
Right. A trader screaming into 2 phones, 6 monitors flashing red and green, billions of dollars changing hands in a split second. We imagine this incredibly precise, almost omniscient level of control over the market.
Yeah, the illusion of total awareness. I mean, people assume that the millisecond a trade happens, the firm's central nervous system instantly registers the exact financial risk it just took on.
But then you step into the actual engine room of a natural gas trading desk, and that illusion just completely shatters.
It really does.
So you realize that a major firm might actually be flying completely blind for hours at a time, entirely unaware of what it truly owns or, the risks it holds. So welcome to today's custom-tailored deep dive.
We are plunging straight into the bare metal of the natural gas trading world today.
Exactly. Specifically, we are looking at how trading desks use software to track their risk, maintain control, and in some pretty terrifying cases, how that software spectacularly fails them.
It is a fascinating subject to dissect because it really strips away all the high-level economic theory and looks at the functional plumbing of how a trading floor actually operates on like a random Tuesday morning.
Right. And our source material for this deep dive is just incredibly comprehensive. We're pulling from a masterclass designed specifically for working gas trading professionals.
Yes, the Natural Gas Trading Desk Master Program.
Yeah, and for those who need a quick reminder, rather than just walking through a table of contents, I'll just say this program is massive. It's a sequenced journey across 9 modules and 120 chapters.
It takes a professional from the absolute basics of market infrastructure, how physical pipelines and storage facilities work, all the way through trading playbooks, advanced valuation, credit, execution, ETRM systems, regulation, and up to desk leadership.
And it's all designed to teach professionals how to run a durable desk that actually makes money and, well, survives.
Exactly. Every module is built around real markets, real numbers, and these desk-ready applied builds.
So today, we are focusing our lens on a very specific, critical vulnerability covered early in the program. We're zooming in on Module 1, specifically Chapter 11, which is called ETRM, as a control system for gas.
Right, looking at how a firm's trading software basically dictates its survival.
Okay, let's unpack this, because for most people, even those working in finance, an ETRM, which stands for Energy Trading and Risk Management, is thought of as just a piece of software.
Right, a glorified calculator.
Yeah. You assume it's essentially a fancy database where the traders type in their deals so the back office can generate invoices. But Chapter 11 completely redefines that view.
It really does. It argues that the ETRM is the absolute boundary between a firm's market exposure and its actual awareness.
And that mental shift is basically the foundation of everything we're discussing today.
Exactly, because if a trader executes a deal on the phone with a broker, the firm is instantly exposed to the market, but the firm itself, the risk managers, the automated systems, they have zero awareness of that exposure until it is successfully logged into the system.
So that makes the ETRM a critical control mechanism, not a filing cabinet.
Exactly. And to understand how fragile this is, we have to look at the architecture. It's built as a stack of 6 distinct layers, and data has to flow perfectly through all of them.
Let's break those layers down, because understanding that flow is key to understanding how these desks actually blow up.
For sure. So layer 1 is deal capture. This is the origin point.
Right.
It is the exact moment a trade, whether it's a complex physical storage contract or just a simple financial hedge, becomes visible to the firm. Then layer 2 is position keeping.
Okay, and that's where the system aggregates all those individual deals, right, across different delivery points, currencies, and tenors. And just to clarify for anyone outside the weeds of finance, when we say tenors, we just mean the length of time left until a contract expires. So aggregating a 1-month contract with a 6-month contract.
Correct. And then we move to layer 3, which is valuation and curves. This is where you mark the book to market, comparing what you bought the gas for against what it is actually worth today.
Makes sense.
Then layer 4 is risk computation. This is where your sophisticated analytics live, your exposure limits, your sensitivities, and your value at risk, or VAR.
And VAR is simply a statistical measure estimating the maximum potential loss a portfolio could face over a specific time frame, right?
Exactly. Then the physical reality sets in with layer 5, which is scheduling and nomination.
And this is totally unique to commodities.
Very much so. It is where financial intent turns into a physical obligation to move actual gas through a steel pipe. And finally, layer 6 is settlement and attribution.
Figuring out if the cash hitting the bank account actually matches the profit you thought you generated.
Spot on.
So the source material introduces a concept here called the propagation principle to explain how these 6 layers interact. Basically, every single layer consumes the data from the layer directly above it.
Right.
So if I'm visualizing this, I think of it like a massive multi-stage water filtration system.
Oh, that is the perfect analogy.
Thanks. I mean, if the very first filter, layer 1, deal capture is cracked and letting in mud, it literally does not matter how technologically advanced your purification filters are at the bottom for risk computation.
No, not at all.
You are still drinking poison water. A trading desk might spend $10 million on state-of-the-art risk analytics software and hire brilliant quants to run it. But if they put it on top of a poor deal capture process, they are just decorating a broken foundation.
Exactly. If your deal capture is wrong, your position is wrong. If your position is wrong, your valuation is wrong.
Right.
Which means your risk limits are operating on pure fantasy, and your final cash settlement is going to fail. A defect at the top propagates all the way down the stack.
And the reason generic systems fail here is that they are often ported over from equities or maybe basic financial commodities like oil.
Yeah, they assume a trade is a simple, discrete event like buying a share of stock. They just aren't built for the continuous, highly physical nature of natural gas.
So in theory, a cracked filter at the top poisons the data. But what does that delay, what the source calls capture lag, actually cost a desk in real dollars?
Well, this is where we move from theory to the trading floor. The source provides a highly practical worked example. Capture lag is simply the time between a trader executing a deal and that deal actually showing up in the ETRM.
Let's walk through the math they provide. We have a mid-sized desk executing 850 trades a day.
Okay.
They have an average capture lag of 47 minutes on a book of about 2.1 million MMB2. And an MMB2, a million British thermal units, is just the standard measure of heat content used to price natural gas in North America.
Right, and because the market is actively moving during those 47 minutes while the trades just sit on a notepad or in a queue, the system is valuing the firm's book using stale data.
And the financial bleed on that is shocking. The source assumes a tiny intraday revaluation error of just over 1 cent, specifically $0.011 per MMB2.
Barely a rounding error to most people.
Exactly. But if you apply that tiny error to that volume over that 37-minute average lag, it generates a direct, quantifiable financial cost.
Yeah.
It creates a monthly revaluation error of $23,100.
Yeah.
That is 23 grand a month just evaporating because of a software delay.
What's fascinating here is that the $23,000 loss is actually the absolute smallest problem on that desk.
Wait, throwing away $250,000 a year is the small issue.
It is the only issue that is easily quantified in a neat dollar figure. The systemic danger is vastly more dangerous. It is what the source calls the compounding argument.
Okay, walk me through that.
Think about all the automated controls a modern gas desk relies on to survive. Escalation triggers, risk limits, automated stop losses that automatically liquidate positions if losses cross a threshold.
Right, the safety nets.
Exactly. Every single one of those automated controls consumes position data. If your capture lag is 47 minutes, then your entire automated defense system is running 47 minutes blind.
Wow. So if a geopolitical event happens and the market suddenly crashes, your system won't even try to stop the bleeding for almost an hour, simply because it doesn't know you're bleeding yet.
Yeah, you might have the best escalation triggers in the industry, but they are firing 47 minutes late. And if we connect this to the reality of how markets actually behave, you shouldn't even be looking at the 47-minute average.
What should you look at?
You need to measure the tail of the distribution.
The extreme outliers.
Yes, a desk might average 47 minutes of lag on a calm Tuesday, But what is their 95th percentile? It might be 3 hours and 40 minutes.
Oh, wow.
And those extreme lags don't happen randomly. They happen on days with massive volume and massive volatility. The tail inevitably occurs on the exact days when the desk's position matters the most.
And when they can least afford a blind spot.
Precisely. A nearly 4-hour blind spot during a major market event isn't just an operational error, it is an existential threat to the firm.
I mean, if the official multi-million-dollar ETRM system is lagging by hours on the busiest days, how do traders actually cope? They can't just cross their fingers and stop managing their risks.
No, they build shadow systems.
Shadow systems.
Secret, undocumented Excel spreadsheets doing the job that the official software is supposed to be doing. Every single gas desk in the world has them.
Okay, I have to push back on this, though. We are talking about the highly regulated world of finance.
Sure.
Aren't undocumented secret spreadsheets that manage millions of dollars a massive compliance violation? If a desk head finds out traders are managing risk on rogue Excel files, shouldn't management just ban them immediately and fire whoever built
Banning
it?
them is a very common managerial reflex, but it is actually a terrible idea.
Really? Why?
Because it completely misdiagnoses the problem. This raises an important question. Why do these shadow systems exist in the first place? Traders don't build complex spreadsheets because they enjoy doing extra data entry.
Fair point.
Shadow systems are a highly rational response to genuine gaps in the official software. If the ETRM cannot calculate a specific physical risk, or if it takes 4 hours to update, the trader has to calculate it somewhere else to survive the trading day.
I see. So if you issue a blanket ban, you don't solve the software gap.
No, you just push the behavior somewhere even less visible.
Drive it underground. Okay, I see the logic there, but the source material is very clear that these shadow systems carry massive structural risks.
Oh, the risks are severe. First, there is no audit trail. An analyst changes a cell reference last month and nobody knows who did it or why.
Right.
Second, you have key person dependency. One brilliant quant builds a massive, complex macro to price a specific storage asset, and when they go on vacation, the whole file breaks and nobody on the desk knows how to fix it.
The source also highlights silent formula errors, like a trader drags a VLOOKUP formula down a column, misses the last row by accident, and suddenly the firm is exposed to $1 million physical risk that looks perfectly hedged on their screen.
Yes, and beyond the sheer financial risk, there is the operational drag, the reconciliation burden.
Because eventually, someone in the back office has to make the secret spreadsheet match the official system of record.
Exactly. The source provides a great metric for this. Imagine a desk with 34 material shadow spreadsheets.
Okay.
If each one takes half a day of manual checking every month just to reconcile against the official record, that equates to 17 full-time equivalent days per month.
Wow. So the firm is essentially paying one full-time employee just to stare at two screens and force the numbers to match.
Literally.
So if banning them doesn't work, what is the constructive approach?
You inventory every single one of them. If a desk cannot produce a list of its shadow spreadsheets, it literally does not know how it computes its own numbers.
That makes sense.
You inventory them, you rank them by materiality, paying special attention to any spreadsheet that feeds a formally reported risk or P&L number, and then you treat that count as a metric of system health.
So if your shadow system count is rising, your ETRM is diverging from what the business actually needs.
Exactly.
Which brings us to the core technical issue. Why do these generic, off-the-shelf commodity trading systems fail so consistently when it comes to natural gas?
Because natural gas is physically unique, and its physics break generic software models. To understand this, we need to look at the program's system adequacy ladder. The source categorizes trading desks into 5 obligation rungs.
Let's walk up that ladder.
Sure. So rung 1 is a purely financial desk. They just trade paper derivatives. They only need basic trade capture, mark-to-market, and standard risk limits.
Okay.
Rung 2 steps into physical trading, but only at highly liquid hubs. Rung 3 involves trading at specific pipeline points.
Getting more complex.
Yes. Rung 4 involves firm supply to actual end users, which requires daily obligation tracking. And finally, Rung 5 is asset-backed trading, where the desk is actually managing physical storage facilities and transport assets.
So if I am running a Rung 5 asset-backed desk, but my firm bought an ETRM system that was only designed to handle Rung 3 pipeline complexity, I am not just partially covered.
No, you are totally uncovered for the riskiest, most operationally complex activities your desk engages in.
Let's make this concrete with the example they provide for the North American market, which focuses entirely on volume fields.
Right.
In a lot of generic systems built for standard equities, a trade has one volume. You bought 10,000 shares of Apple. The system says 10,000. But in physical U.S. gas, there are three distinct volumes for a single trade.
Yes. You have nominated, which is what the desk requested from the pipeline operator, let's say 26,000 MMNPU.
Okay.
Then you have confirmed what the pipeline actually accepted, maybe 24,500. And finally, scheduled what actually flowed through the physical meter, let's say 23,880.
And a generic system that only has a single database column for volume basically has to conflate those numbers.
Yeah, it usually just overwrites the nominated volume with the confirmed volume.
But help me out here. If I am a hotshot trader focused on generating millions in profit, why do I care about semantic differences between requested and confirmed volumes? That sounds like a back-office paperwork issue.
It sounds like paperwork until you look at the market mechanics. Let's look at the math you just laid out. You nominated 26,000 MMB2, but the pipeline only confirmed 24,500.
Right.
That 1,500 MMB2 variance is not a paperwork error. It is a highly valuable trading signal.
Wait, really? A signal for what?
It tells the trader that the physical pipeline is constrained. It is full. That variance is an early warning indicator that the price spread, the basis at that specific physical location, is about to blow out.
Oh, I see.
If your system only holds one volume field, it silently deletes that variance. The signal is destroyed, and the trader is flying blind into a volatile pricing event.
So the software deletes the market intelligence because it simply doesn't have a database column for it. That is wild.
And the source drives this home with two side-by-side composite case studies. They are incredibly instructive because they show exactly how systems fail in Europe versus North America.
Always good to compare the two.
Yeah, the two markets have different structural flaws, and they require different controls.
Well, let's dive into this tale of two failures, starting with the European case study. The source calls this the system that couldn't see the unit.
Right. So in this composite scenario, a European gas desk expands its operations. They move from trading exclusively at the Dutch TTF hub to also trading at the British NBP hub.
Okay?
The ETRM they use is rigid. It only supports one unit of measurement per commodity. For natural gas, it expects megawatt hours or MWH. But the British market doesn't trade in MWH, it trades in pence per therm.
A completely different unit of measurement.
So the system forces a conversion at the point of entry. The moment the trader enters the therms into the deal capture screen, the software uses a rounded static conversion factor, 0.0293, and stores only the converted MWH figure in the database.
It completely throws away the original native price and volume that the trader actually negotiated,
Exactly.
which violates a massive rule of data architecture.
Yeah.
The source points out that the correct conversion factor isn't 0.0293. It is actually 0.0293071.
Yes.
And it seems like an unbelievably tiny difference. But let's do the arithmetic. On a standard position of 480,000 therms, the rounded factor gives you 14,064 milliliters.
Okay.
The correct factor gives you 14,067.4 milliliters. That is a 3.4 milliliter discrepancy on a single mid-sized position.
It sounds small, but remember, this is a systematic bias.
Yeah.
It is not a random rounding error that fluctuates up and down.
It never cancels out.
Exactly. It pushes in the exact same direction on every single trade, every single day. Across a year of active trading, it accumulates into a massive, persistent divergence between what the firm system says they own and what the external broker statements say they own.
And because the system threw away the original native price, the back office can't even resolve pricing disputes on settlement. So what happens? The desk builds a shadow spreadsheet to track the native therms.
Of course they do.
And eventually the spreadsheet and the official system diverge. The desk is just bleeding unexplained profit and loss every month, and the risk department is tearing their hair out trying to find the leak.
Yeah, the core lesson here is so simple, but so critical. Store exactly what was traded, then convert for display. Conversion is always lossy.
That is a great rule.
Okay.
But that's the European failure mode. Small, systematic, persistent data degradation. The North American case study is structurally entirely different.
Oh, completely. It is massive, event-driven, and completely invisible until it explodes.
This is the U.S. salt dome storage example. A U.S. desk is holding a physical salt dome storage facility, which puts them at rung 5 on that adequacy ladder we talked about.
Right.
But their generic ETRM models storage simply as a summer-winter financial spread. It has absolutely no concept of an inventory state. It doesn't know if the physical cavern is full, half empty, or entirely depleted.
This is where treating physical gas like a generic financial instrument becomes catastrophic. Think about what a salt dome actually is.
Right, it's a massive cavern hollowed out of an underground salt formation. The gas itself provides the structural pressure.
Yes. Generic systems built for stock shares have no concept of this. A share of Apple stock doesn't get harder to sell just because you have fewer of them. Gas does.
Wow, okay.
The desk hedges a nameplate volume of 2 million MMB2. From the risk system's perspective, looking at the financial spread, they are perfectly hedged. But then a massive cold snap hits the U.S. in December.
The desk draws down the physical inventory to meet the soaring winter demand. But because of the physics of a salt dome, as the volume drops, the physical pressure inside the cavern drops.
Yep.
And when the pressure drops, the deliverability drops.
So the gas is still physically in the cavern, but the physics of the pressure won't let you pull it out fast enough to meet your daily obligations.
So, out of the 2 million hedged MMB2, they can only actually deliver 1.51 million. Operations discovers this physical constraint, not the risk department.
Right, the risk system still thinks everything is perfectly balanced.
That's terrifying. They are suddenly short 490,000 MMB2 in the middle of a winter storm. Let's do the brutal math on this one.
Go for it.
Because they're short during a massive demand spike, they had to buy spot cover in the open market at an exorbitant $22.40 per MMB2. But the value of their financial hedge was only $4.62. That results in a net cover cost of $8.7 million.
An $8.7 million loss because a software platform designed for generic finance modeled a highly physical, pressurized underground cave as a simple line item on a spreadsheet.
That contrast is incredible. The European failure was like a slow leak in a tire, small, systematic, and persistent. The U.S. failure was a blowout at highway speeds, massive, event-driven, and entirely invisible to the risk managers until the moment of impact.
Both failures stem from the exact same root cause, right? The control system could not accurately represent the physical reality of the commodity.
Which sets up the final section of this chapter really well, the applied build. This is where the masterclass brings the theory directly to the listener's desk. It provides a build-it-yourself exercise to test if a firm is vulnerable to these exact failures.
It is highly actionable. First, you assess your book's obligation rung from 1 to 5. Then you list the minimum system requirements for that rung and mark them as met, partially met, or absent.
Okay, simple enough.
If you are a physical desk managing transport and your system is failing rung 3 requirements, you have a major structural problem.
Okay.
Next, you inventory your shadow systems. What exactly do they compute? Who maintains them? Do they feed formally reported numbers? Finally, measure your actual capture lag. Not what the policy manual says it should be, but the actual distribution of delays, specifically focusing on that 95th percentile tail.
But the ultimate test they provide is brilliant in its simplicity, I think. Go to your desk, pick one single reported risk or P&L number, and try to trace it back through every single layer from settlement up through scheduling, risk, valuation, position keeping, all the way back to the raw deal capture.
If we connect this to the bigger picture, the rule they set is unyielding. If you cannot complete that trace in under 1 hour, that failure is the finding.
Meaning your ETRM is no longer a control system.
Exactly. It is just a black box generating numbers you cannot verify. And if you cannot verify the origin of your numbers, you don't actually have control over your risk.
Let's bring this all together. We started by looking at the ETRM not as a database, but as the boundary of awareness.
Right.
We saw the propagation principle in action, how a cracked filter at deal capture poisons the sophisticated risk calculations down below. We quantified the hidden costs of capture lag and the operational drag of those shadow spreadsheets.
Yeah, 17 FT days is a lot.
Seriously. And we looked at 2 devastating composite case studies. The persistent danger of rounded unit conversions in Europe, and why ignoring the physical physics of a salt dome in the U.S. is a recipe for an $8 million disaster.
It really reinforces the core philosophy of the program. Trading natural gas requires a profound respect for the physical reality of the commodity, and your technology stack must reflect that reality perfectly.
This flows naturally into Chapter 12, which closes out Module 1. That chapter looks at the ultimate stakes, a historical review of desks that failed versus desks that survived. The source notes that performing the exact system assessments we just discussed is one of the clearest predictors of a desk's long-term durability.
Right. A desk with a clean, accurate control system survives the volatility. A desk flying blind on stale data and rogue spreadsheets eventually hits a wall.
Which leaves us with a final, somewhat terrifying thought for you to chew on as you head back to the trading floor. Imagine this scenario. If your firm's primary ETRM system, silently froze its risk calculations for exactly 2 hours during tomorrow's peak trading volatility, would anyone on your desk actually notice? Or are your shadow systems already running the show?
That is a question every desk head and risk manager should be able to answer immediately.
Thanks for joining us for this deep dive into the bare metal of gas trading. We'll catch you on the next one.
When you picture a catastrophic failure on a trading desk, you probably have this really dramatic scene in your head. Like alarms are blaring, screens are flashing red all over the
Oh,
place.
yeah, totally. People shouting across the trading floor, some massive black swan event just crashing down out of nowhere.
Exactly. But as natural gas trading and risk management consultants here at Durga Analytics, we spend a lot of time looking under the hood of these actual operations.
Right, and the reality is so different. When you look at a gas desk right before it blows up,
Hmm.
what you actually find is just, well, silence. It's totally calm.
Yeah, the P&L looks phenomenal. The traders are getting their bonuses. Everything seems perfectly fine structurally, right up until the exact second it violently isn't.
Which is terrifying, honestly.
It really is. So we have a big question for you today as we dive into this material. Why do highly profitable gas desks blow up?
And I'll give you a hint. It is almost never because the traders were simply, bad at trading.
Which is an incredibly important point. So if you are running, building, or supporting a gas trading desk, whether you're an originator, a quant, a scheduler, or an ETRM professional managing those massive risk systems, understanding the silent decay is completely crucial for your survival.
It really is the difference between a durable desk and one that just implodes.
Right. And just to ground you in where we are on this journey, we're looking at this through the lens of our Natural Gas Trading Desk Master program.
Yeah, this is our sequence journey across 9 modules and 120 chapters.
Mm.
We cover everything from market structure and physical pipes to curve construction, risk, and, desk leadership.
Exactly. And it's all built around real markets, verified arithmetic, and desk-ready applied builds. So today is actually a massive milestone for us.
Right, we are finally at the capstone of Module 1. We're diving into Chapter 12, which is lessons from failed gas desks.
Right. Module 1 is all about what a gas desk is actually accountable for and how it runs. So today's mission is to basically synthesize everything we've covered in the first 11 chapters.
Yeah, things like desk mandates, the obligation ladder, those escalation triggers. We're taking all of that and figuring out what durability actually requires in the real world.
So if a lack of trading skill isn't what's killing these desks, I mean, what actually is, the chapter lays out this really fascinating concept of the desk life cycle.
Right, it says every single desk goes through 4 distinct phases. You have build, peak, drift, and finally decay.
And it's kind of wild how predictable that curve is, right? Like phase 1 is the build phase, usually those first 3 years.
Exactly. You're setting up the desk. The ETRM controls are designed specifically for the actual business you're doing right then, and everyone actually knows the reasoning behind those controls.
Because the people who built it are sitting right there.
Yep.
And then you hit phase 2, the peak, which is roughly years 3 to 8.
Yeah, your systems are perfectly matched to the market, and performance is just super strong.
But the text points out this massive trap right here. Because performance is so strong, management just assumes it's because the traders are absolute geniuses.
Right, they completely ignore the fact that they just have an excellent structural fit between their systems and the market.
And that arrogance leads right into phase 3, which is drift. Now, I want to pause here and push back on this a little bit for you listening.
Go for it.
If a desk starts failing in years 8 to 12, isn't that just because gas markets get, crazier? Like volatility spikes, new LNG infrastructure comes online, global supply chains break.
Yeah, you'd think so.
Right. Doesn't the market just become fundamentally harder to trade? Why call it drift?
So that is actually the most common misconception in our entire industry. We always assume the threat is external or exogenous. But the primary claim of this chapter is that decay is endogenous.
Meaning it comes from the inside.
Exactly. Think about the mechanics of how a trading firm actually operates. Markets evolve continuously, right? They're fluid. But your control frameworks, your limits, your ETRM settings, those only change discreetly.
Right. Somebody literally has to sit down, write a ticket, convene a committee, and actively change the system.
Exactly. So you have a very fluid reality pushing up against a rigid control structure.
It honestly reminds me of a house settling over time. Like
Right.
the market is the ground shifting beneath you, but your ETRM controls are the concrete foundation.
That's a really great analogy. Concrete does not bend.
Right. The tension just builds and builds quietly in the dark, even if the paint in the living room looks totally fantastic.
Yeah, and here's how that tension builds on the desk during that drift phase. The original architects of the control framework, the people who poured the concrete, they leave the firm.
Right, they get poached or they retire.
Yeah, and their successors inherit these controls, but they don't understand the why behind them. They just see a limit set at some random megawatt-hour threshold.
So as the market shifts, those ORD controls just start getting in the way of perfectly legitimate new trades.
Exactly. And what do smart, highly compensated traders do when an outdated system gets in their way?
I mean, they bypass it, they create a workaround.
Yep. Every single manual override,
Right.
every new shadow spreadsheet built in Excel on some trader's desktop, it's a totally rational, local response to a rigid control.
But in aggregate, that pushes you right into phase 4, which is decay. This is 12 years and beyond. The controls are calibrated to a market that just doesn't exist anymore.
Right, and working around your own risk system becomes your standard operating procedure. Which brings up the most terrifying observation in this whole chapter.
Oh yeah, this part was wild.
Desks do not fail the moment a structural defect appears. They fail because the defect is present, highly detectable, and it remains incredibly profitable for months or even years.
The market literally rewards the bad structure.
Yes, and if you understand that, you understand why these blow-ups are just so massive. When a model calibrated to a vanished market finally snaps, it fails by a multiple.
Right, you aren't just losing one day's P&L, you are stepping off a cliff that you've been blindly walking alongside for 5 years. So how do we actually spot that we're walking near a cliff? If the P&L looks great, how do we diagnose this endogenous decay?
Well, the module breaks this down by contrasting the anatomy of failure with the habits of durability. They look at 11 case studies, 6 European and 5 North American.
And the recurring features of the failed desks are shockingly consistent, aren't they?
They really are. One of those common failure modes is hedging the wrong risk simply because it's easier to execute. We saw this with the Winter Storm Uri basis blowouts in 2021.
Right. And for those who might not trade North American power and gas, Uri was that catastrophic Texas freeze where physical gas demand just skyrocketed.
Yeah, wellheads literally froze solid.
Exactly. And regional prices disconnected violently from the national benchmark at Henry Hub.
And in those case studies, desks chose hedging instruments based on what was liquid and easily available on the screen instead of what matched their actual locational exposure.
So they hedged the benchmark, but their real risk was the locational basis.
Right. And when Uri hit, the benchmark basically did nothing, but the basis exploded and they just got crushed.
Let's unpack another failure mode from the text, which is sizing to conviction instead of sizing to the exit. That sounds like a trader psychology thing, but it's really a mechanical failure, isn't it?
Oh, absolutely. It means treating liquidity as a constraint rather than a constant. Sizing to conviction is when a trader looks at a fundamental model, becomes 100% sure prices will go up, and just buys a massive position.
They're entirely focused on being right about the market. But what if they are wrong?
That's the trap. If they're wrong and they need to cut that position to stop the bleeding, they suddenly discover the market only trades a tiny fraction of their volume a day.
So it's going to take them days or weeks to exit.
Exactly. And their own frantic selling will just drive the price down further against them.
Wow. So sizing to the exit means capping your position based on how fast you can liquidate in a stressed market, regardless of how confident you are.
Yes, exactly. You have to respect the math of liquidity. We also see desks failing because of ambiguous authority. Nobody ever runs the ambiguity test to see who actually owns a decision.
Right. So when escalation triggers are vague, authority just drifts. And when the market dislocates, two different senior managers think the other one is handling the liquidation.
And nobody is actually at the wheel, which leads us to the staggering arithmetic of discipline. The module aggregated the losses from these case studies, and the total was roughly $107 million in mixed currency.
That is massive. And that Uri basis exposure loss alone was what, 31.57 million US dollars for just one desk?
Right, so they lose nearly $32 million because of a bad structural setup. Compare that to the cost of actually detecting the flaw before it blew up.
Oh yeah, the detection cost is basically zero, right?
It is practically free.
Right.
The detector for that specific basis loss was literally just adding a point enumeration in their mandate. Just a bullet point defining exact delivery locations.
So detection is incredibly cheap, but failure is incredibly expensive. The ratio is just absurd.
Totally. Every single detector we teach like running a daily residual sweep or testing unexplained P&L for its sign, is either free, fully automatable, or just a couple days of work for a quant.
Wait, let me stop you on that specific one because it sounds super technical. Testing unexplained P&L for its sign.
Sure.
I know unexplained P&L is the difference between what our model predicted we'd make and what the bank account actually says we made. But what does testing for its sign actually mean?
It means looking at whether that unexplained variance is consistently positive or consistently negative.
Okay, so like if my P&L is off by $1,000 a day and it's randomly up one day and down the next.
Then that's just market noise or, rounding errors.
Right, but what if I'm bleeding exactly $1,000 every single day?
Then the sign is consistently negative. And that is not a rounding error. That is a structural leak.
Wow, okay.
Yeah, you have some uncaptured fee accrual or maybe a pipeline tear if your ETRM isn't modeling, and that'll just compound until it becomes a massive hole in your books.
Okay, so if these detectors are so cheap and the math is so glaringly obvious, why on earth don't desks use them?
Simply because the financial benefit of a detector is invisible. It's the disaster that didn't happen.
Right. But the cost, like the daily administrative friction, is highly visible to the traders every single day.
Exactly. Which brings us to the habits of durable desks. The chapter points out that durable desks are not magically defect-free. They just find and close their defects faster, using something called a prevention register.
Okay, I have to play devil's advocate here because I've spent time on trade floors.
I know you have.
If you hand a highly caffeinated, super busy desk head a form and tell them they need to start maintaining a register to record near misses, like mistakes that cost the firm literally $0, they are going to laugh you out of the room.
Oh, 100%.
It feels like pure HR busy work, doesn't it?
That is the standard pushback.
Yeah.
And honestly, it is completely rational objection if you only view risk through the lens of realized financial losses. But here is the fundamental mathematical problem with that view. Realized losses only show you the cases where every single layer of your control framework failed simultaneously.
Ah, I'm tracking with you now. It's survivorship bias in reverse. We only study the bullets that hit the engine, but we completely ignore the hundreds of bullets that hit the armor and bounced off.
Exactly. Near misses are the only unbiased, statistically significant sample you have of how your desk's controls actually behave in the real world.
That makes so much sense.
Plus, without a prevention register, a desk head can never mathematically prove the financial value of the disasters they successfully avoided. It converts unrecorded anecdotes into a visible, auditable metric.
So if a trader catches an ETRM error before execution, you don't say, good job. You write down the trigger, the action taken, and the exact dollar amount of the loss you avoided.
Yes, because otherwise senior management just sees the friction of the risk process without ever seeing the millions of dollars it saved. It changes a desk head's legacy entirely.
Okay, well, it's one thing to talk about theories of endogenous decay and prevention registers abstractly. It's another to see it hit the actual bottom line.
Right.
Let's look at two concrete case studies from the chapter, one North American, one European. And we should note clearly for you listening that both of these are constructed composites drawn directly from public governance commentary.
Yeah, they reflect very real market practices. Let's start with the North American case. It perfectly illustrates that slow endogenous decay we unpacked earlier.
This was a U.S. desk trading regional gas basis, right?
Right. They performed incredibly strongly for 7 years with a really well-designed control framework. They were at the absolute peak of their life cycle.
But then phase 3 hits. Drift.
Exactly. In years 8 and 9, the two senior quants who designed that framework leave the firm. And their successors inherit the controls, but not the reasoning behind them.
Meanwhile, the physical market evolves. A major new piece of pipeline capacity comes online, and it fundamentally changes the physical flow of gas in their region.
Yeah, it makes the flow bidirectional. But their ETRM system was hard-coded to assume gas only flows from point A to point B.
So the system physically cannot model the new reality of the market. What happens next?
The traders just start routinely working around the system. Over 5 years, the number of manual overrides where a trader just forces a trade through rose from roughly 4 per month to 31 per month.
That's a 675% increase. Just massive drift.
Yeah, and at the same time, because the ETRM couldn't model the new pipeline, the traders built their own tracking tools. The number of shadow spreadsheets on the desk grew from 6 to 29.
And let me guess. Because shadow spreadsheets and system overrides aren't hard P&L numbers and they don't explicitly breach value at risk limits, nobody in senior management was paying attention.
But that is the ultimate tragedy of this case. Both of those leading indicators were measured and available the entire time. They rose monotonically for 5 solid years.
But they were just considered system quality metrics, not
Yeah.
real financial risk limits.
Exactly, so they weren't on the chief risk officer's dashboard.
And what was the final result?
In year 13, a moderate basis event hit the market. It wasn't even a generational storm. But because their actual risk was hidden in 29 different unaudited Excel files, they just couldn't see their aggregate exposure.
So they took a massive hit.
Yeah, it produced a sudden loss of $18.4 million. That loss was 5.9 times their value at risk limit. Their own risk framework had mathematically described that size of a loss as literally impossible.
That perfectly highlights the danger. Nothing dramatic happens for 5 years, just a slow, quiet creep of overrides, and then boom, an $18.4 million crater.
Exactly.
Let's contrast that with the European case study, which is basically a masterclass in durability.
Right. This composite is based on a desk trading Northwest European natural gas hubs, like the TTF in the Netherlands. They had a strictly enumerated mandate that had to be formally reissued and signed every single year.
And crucially, they enforced a strict 30-day expiry on all system overrides.
Yes. If a trader had to override the ETRM for the exact same issue 3 times, they didn't just accept it as the new normal. They raised a formal system change request to write new code and fix the underlying defect.
And they actually used a prevention register. They logged 94 near-miss entries against only 11 realized incidents over 6 years.
So they had this massive data set of how their controls were actually functioning.
So how did that rigorous, somewhat bureaucratic discipline pay off when the market actually dislocated?
During the massive 2021 to 2022 European gas crisis, when prices just went entirely parabolic, this desk did something remarkable. They cut their gross exposure by roughly half.
Wait, they cut it from 3.2 million megawatt hours down to 1.6 million months before the worst of the price spike even hit.
Yes.
Hold on, I need to understand the mechanics of that decision. Did they just have a brilliant macro trader who perfectly timed the top of the market?
No, and that is the most important lesson here. The trigger to reduce their exposure was completely conditional, and it fired automatically based on a physical liquidity metric, not a market view.
So the market was becoming too illiquid to safely size to the exit, and they just followed the math.
Exactly. Nobody had to be a genius. Nobody had to be right about where prices were going. They just followed the strict arithmetic of their pre-agreed liquidity constraints.
Let's run that arithmetic, because the numbers in the chapter are staggering. To cut that exposure, they had to cross the bid-ask spread in an already choppy market.
Right. They paid a spread of 0.85 euros on 1.6 million megawatt hours.
So they actively chose to pay a known immediate cost of 1.36 million euros right out of their daily P&L just to step aside and get safe.
Yes, which is incredibly painful to do in the moment. But the subsequent adverse price move over the next few months was 46 euros per megawatt hour.
Oh, wow. So if they had held that volume, the resulting loss would have been 73.6 million euros?
Exactly.
So they willingly paid 1.36 million to avoid losing nearly 74 million. That is a 54x return on the cost of the risk reduction.
That's incredible. Why doesn't every single desk operate this way? Because of the culture of how we measure success. Because that desk spent 1.36 million euros to step aside, they actually underperformed their annual profit budget that year.
Wait, let me get this straight. They objectively saved the firm from a catastrophic 73 million euro hole, but on paper, they missed their budget target.
Yes. But, and this is the absolute key to their durability, the firm formally assessed the desk head as having performed exceptionally well, despite missing the budget.
Wow, they actually had the rare cultural ability to separate the assessment of a decision from the financial outcome of the year.
It's profound. The prevention register meant that the 1.36 million cost wasn't viewed as a dumb trading mistake.
Yeah.
It was recorded, quantified, and audited internally as a highly successful preventative action.
If a firm can't say out loud that a desk missing its budget was the result of excellent risk management, that desk will inevitably drift right back toward dangerous behavior.
Exactly. Separating the quality of the decision from the immediate financial outcome might be the hardest psychological shift to build in any trading organization.
So we've seen the catastrophic cost of ignoring drift and the massive ROI of structural discipline. How do you, the listener, apply this to your own desk tomorrow morning?
Well, this brings us to the Chapter 12 Applied Build, which is a 10-question durability checklist.
And this checklist is basically a practical diagnostic tool derived from everything in Module 1.
Hmm.
But its value relies entirely on your willingness to be brutally honest about your operations, doesn't it?
Oh, absolutely.
I love the mechanics of this. It's like getting an oil pressure warning light on your dashboard.
Yeah.
If the light is flashing, you don't just put a piece of black tape over it because your speedometer says you're doing 80 miles an hour.
Right. Ignoring the sensor just guarantees the engine block seizes up. So let's highlight a few of the key diagnostic tests from this checklist.
Let's do it.
First is that ambiguity test we mentioned earlier. Look at your desk's decision rights matrix. Does every single critical decision row have exactly one decide owner?
Right, because if two people own a decision, no one owns it, and authority becomes ambiguous exactly when you can least afford it. What about question 5 on the liquidity constraint?
That directly attacks the sizing to conviction failure mode. The question asks, is your maximum position size explicitly constrained by your required days to exit under stressed market liquidity?
If you can't exit the position in a reasonable time frame without moving the market against yourself, your position is too large, regardless of how confident your price forecast is.
Exactly. And we already covered the sign test for unexplained P&L, checking if your system leaks are consistently negative rather than just random noise.
So let's say I run this 10-question checklist on my desk tomorrow morning. I'm guessing most desks aren't getting a perfect score.
No, a desk answering yes to all 10 questions out of the gate is incredibly rare.
Mm.
But that isn't the point.
The goal isn't immediate perfection.
Right. The goal is knowing exactly which of the 10 questions your desk currently fails. A desk that accurately maps its own defects is in materially better condition than a desk operating under the illusion of perfection.
So if I find a bunch of no's, what do I fund first to fix it? Where do I even start?
Well, if you're looking at symptoms of early drift, say you have rising ETRM override counts, you might need a full system capability assessment to figure out what the system is failing to model.
But universally, what's the strongest answer?
The absolute strongest answer for what to implement first is the prevention register.
Because it costs practically nothing to start today.
Because it costs almost nothing, its value is entirely cumulative over time, and most importantly, without it, no other risk remediation you attempt will ever be visibly worthwhile to your senior management.
You literally have to prove the value of the disasters you avoid.
Exactly.
Okay, we are wrapping up Module 1, and I want to leave you with a final provocative thought. It has to do with how we consume information in this industry.
Yeah, the gas trading world spends a lot of time reading postmortems of spectacular desk blowups. We read the news articles and we treat them like, dramatic historical gossip.
Which is entirely the wrong way to read them. The one habit worth carrying out of Module 1 is this. When you read about a massive market blowup in the news, don't ask, what did those traders do wrong?
Right, because that limits the lesson entirely to them. It lets you off the hook.
Instead, ask yourself, which of these 10 durability questions would that failed desk have answered no to? And then, terrifyingly, ask that exact same question of your own desk right now today.
That single reframing takes a news anecdote and converts it into an active protective control for your own survival.
That perfectly summarizes the governance frame we've spent Module 1 building. We now know what a gas desk is accountable for, who decides, how endogenous failure actually occurs, and how cheap it is to detect those defects early.
But notice we haven't yet talked about the physical pipes, the storage caverns, or the actual molecules of gas.
Exactly, and that is very much by design, because these governance and structural failures translate across any market. But now that we have the rigorous framework built, we need to apply it to physical reality.
Yeah, we have to ground it in the real world.
So in our next deep dive, we kick off Module 2 with Chapter 13. We are going straight into the physical market structure, looking at the massive design differences between European balancing regimes and North American capacity rights.
And we'll be unpacking exactly why the TTF and Henry Hub behave so radically differently.
It is where all of this theoretical governance finally meets the unforgiving physical physics of the natural gas grid.
I really can't wait for that one.
Me neither. Until then, take a hard, honest look at your desk's foundation. Is the fresh paint just hiding the settling concrete? Run the checklist. We'll see you in Module 2.